viewers. Today we are going to resume with our series financial reporting, and basically today we are going to look at IAS 23 borrowing costs. And as we discussed in our first video about the standard IAS 23 borrowing cost, we try to look at some of the things that are within the standard, what the standard suggests, and some of the key terms that are very important as far as IAS 23 is concerned. One of the things we try to look at the definition of the borrowing costs. We try to know what are they. Then we see the recognition criteria for borrowing costs. Then we try to look at the commencement. When do we start to capitalize borrowing costs? Then the other one we looked at, when do we suspend capitalizing borrowing costs? And the last one, the cessation, or when do we stop to capitalize borrowing costs? Then we try to look at the measurement of borrowing costs that are eligible for capitalization. Those are the things. Now we are going to be looking at the computations, what we can be able to pick depending on the different questions that we are going to be following. And today I picked a question from November 2019, and that's going to be question 3, November 2019. So as a precursor of what we actually discussed from the previous video of IAS 23, we tried to look at the definition of the borrowing costs, and we said these borrowing costs, we are mainly focusing on the interest. I know there are so many items as we discussed in the first video, but here our emphasis is going to be on the interest component that is capitalized, because we all know the interest that is expensed in the normal course of business, but this interest is the one that we are going to be capitalizing or adding back to the cost of the qualifying asset, or the cost of the asset that has been purchased or constructed. And when you try to look at that, we are bringing in issues of qualifying assets. And basically, qualifying asset is mainly the asset that will take a substantial period of time to get ready for its intended use or sale. And that's basically what a qualifying asset means as far as IAS 23 borrowing cost is concerned. Then we spoke about the recognition criteria, and these criteria, we are looking at the conditions that are supposed to be met for someone to start capitalizing borrowing costs. Then the other item is trying to look at the commencement. When are we going to be starting to capitalize our borrowing costs? And mainly we had conditions that are supposed to be met, and we looked at when the company incurs the expenditure on the asset, when we incur the borrowing costs, and when the company is undertaking activities that are necessary to prepare the asset for its intended use or sale. That's basically what we tried to look at in the previous video. We looked at the suspension, that we suspend borrowing costs. We suspend capitalizing borrowing costs as when there is no active development of the asset is taking place, and it must be for an extended period of time. Even though the extended period of time is not defined in the standard, but at least for these construction works, you find that if maybe you've been constructing roads, been constructing buildings, those activities are taking a very big time for them to get ready for their purpose. And basically that's how we try to look at the suspension of capitalizing the borrowing costs. But I never wanted to go through all of what we supposed to, or what we covered in the first video, but I was just giving you a brief highlight of what, if you haven't watched the first video, you will get when you actually complete the whole video. So the question for today is basically all about getting the practical knowledge, because we got the theoretical aspects in regards to the IAS 23 borrowing costs, and we actually analyzed what is covered as far as financial reporting paper is concerned. And when you try to look at this question 3 of November 2019, and try to go through the question, and we are saying that PAL Limited is a company owned by a foreign investor who decided to invest in Uganda 3 years ago because of the government incentives given to investors. The company acquired land in Namamve Industrial Park to start up a factory making plywoods for both local market and export to Kenya. Then part 1, they are saying in order to construct the factory worth shillings 2 billion, the company obtained a loan from Bcom Bank on 1st April 2018 with a fixed interest rate of 10%, which was immediately paid to its bank account. Meaning this, they got a loan of 2 billion to construct a factory where they are going to be making these plywoods, and the money was actually disbursed to its bank account. So the construction started and was paid for on 1st July 2018. Then they are giving us a continuation that prior to the commencement of construction, 10% of this loan was invested to earn 5% interest. So it means before they started the construction, they invested 10% of, and they earned interest of 5% of the interest, meaning it was 5% of the 10% of the loan. So they are considered the delay to commence construction was due to delay in approval of the plan by the government, saying that the construction of the factory was in progress at the end of the financial year ended 31st March 2019. So let's try to look at this. Part 2 is not all what we wanted, because we wanted only that part 1, because it is the one that is related to the standard we want to discuss today. As I told you, I choose these questions depending on what we've actually done, because we did IAS 20 and we did the sum computation. So part of it is under IAS 20, that government grants and disclosure of government assistance. But our interest here is the IAS 23 borrowing costs. They are saying, when we try to look at the required, they are saying in accordance to IAS 20, government grants and disclosure of government assistance, and IAS 23 borrowing costs, part A, distinguish between government assistance and government grants and explain the required disclosures of government assistance. That we handled it very well when we were doing IAS 20, except for the disclosure requirements. Those ones I told you to make research about them. They're asked once in a while, so we discussed some of those. Then part B says, explain the arguments in support of the income approach in recognition and measurement of government grants. That one we discussed it, and I told you those arguments or the advantages in favor of the income approach other than the capital approach we discussed them, but my emphasis for today is part C, which carries 12 marks and says advise the management of PAL Limited on how to account for the above transactions for the year ended 31st March 2019, and clearly showing extracts of its financial statements. Basically, they're talking about the whole transactions, but remember, in this item, every part this was part 1, part 3. Each of them has different standards that are taken there. So you explain and do what is needed. But our emphasis here is on this part 1, that bank loan. So when we try to discuss more about the measurement of borrowing costs, try to look at the two methods that are used when we are accounting for these borrowing costs. We said we have the specific method where we take a single sum of money that has been gotten maybe from a given financial institution and has been used solely for the construction or buying of a given asset or a given qualifying asset, as we elaborated what the qualifying asset was. And the other one was the general borrowing, where we try to get money from different sources and we try to have a mixture of funds that has been gotten from different banks or financial institutions. And what happens with that analysis, we try to look at loans that have been gotten at different interest rates. So if the interest rates are going to be many, how are we going to be accounting for that? And that's basically what general borrowing does. But for today, it's going to be a specific borrowing, because when we try to go through the question, we saw that the money, the 2 billion, was got from the bank, meaning it was only one bank where they got the money, and they are specifically using that money for the construction of a factory. So that alone confirms that what we are dealing with. So basically, that what we've been discussing has been the precursor of what actually part 1 of this standard was narrating, and want to see the application of all the aspects we discussed in the part 1 of IS 23 borrowing costs. So now when we try to go back to the question, we see that the company obtained a loan of 2 billion. Now this one, I'm just giving you the analysis of the question, because my emphasis was basically we try to look at the question, we read through the question, then we do the analysis of the question together before we get the solutions. So let's try to look at what we have and we make a summary out of it, then we provide the solution at the end of the day. So we said the company obtained a loan of 2 billion on 1st April 2018, and that loan was at an interest of 10%. But we have that before the construction, 10% of the loan was invested to earn 5% interest. They used 10% of the loan and they invested it somewhere where they are earning some interest income of 5%. So they continue to say that the delay was due to the delay in the approval of the plan by the government, and the construction was in progress at the end of the financial year ended 31st March 2019. So from what we have actually analyzed, we are seeing that the interest is actually a borrowing cost, or it is falling into the IS 23 borrowing cost. So now our task is going to be to determine the borrowing cost that we are going to be capitalizing. And the method we are going to be using is going to be the specific borrowing, because we are seeing that the 2 billion which the company obtained, it was specifically for the of a factory. That's what we actually discussed. And we are saying that what now we need to identify which areas of the standard this question is testing. Because if you are to answer this question very well, you need to know that having read what the question says, what are we actually trying to get, or what is the end point of the question? What are the key items that the question is requiring us to do? And I told you that some of the things that we are going to be testing as far as IS 23 borrowing cost is concerned, we are going to be testing either it is going to be a commencement, a suspension, or a cessation. Those are the three items that we are going to be testing whenever you have a question about the IS 23. Because when you try to look at the things that we need to compute, we need basically to know when, if at all we are going to be capitalizing, we need when are we going to be commencing or starting to capitalize. Then we need to know when to stop and when to suspend financials by lessing them from the gross profit. But cessation is all about stopping. That from that time we are stopping. It may be, you may say that maybe the construction has been finished. The road is now constructed, or the building is now complete, and people have actually started occupying it. So from there is nothing like capitalizing, because everything has been done, and we've actually used the money we've borrowed to construct the building, and the building is now existing. So those are the things. But now when we went through this question, we are seeing that this question is testing the commencement of capitalizing the borrowing cost. Since we are being given different dates, because we are seeing that this loan was acquired or was given to PAR Limited on 1st April 2018. And we are seeing that these guys, they want us to look at the figures that are going to be for the financial year ended 31st March 2019. Of course, when you try to look at that period, it is a 1 year from 1st April 2018 to 31st March 2019. That's 1 year. So we need to look at, since basically what we are trying to look at is the interest. Interest most of the time is bit time apportioned depending on the month, because when you are paying interest is on the depending on where, from which date you got the loan. If maybe you get your loan during the year, you will not be paying the same interest like the person who has actually got the money at the beginning of the year. So interest is more or less time apportioned, and when you try to look at this question, you need to be very careful with that they have given you. You may find that some of these loans are obtained during the year, and others are obtained beginning, and others are obtained maybe in the previous years. So you have to be careful about the dates that have been given in the question. So having understood that we are testing the commencement, then what you have to remember, all the major emphasis here is that we start capitalizing borrowing costs when the expenditure on the asset is being incurred. These are the conditions which we spoke about earlier when we began the tutorial. So when these expenditures, the asset, are being incurred. Secondly, when the borrowing costs are being incurred. And thirdly is when the entity is embarking on the activities necessary to get the asset ready for its intended use or sale. This third point is very important because it is one of the points that most of the examination questions are going to be testing, because they will give you scenarios whereby the person has actually gotten the money. Like in this same question, you may see that the company got the money on 1st April 2018, but they started the construction at a later date. they started construction on 1st July 2018. So it brings a kind of questioning, when are you going to be starting to capitalize because of the different dates that you have? So what will give guidance is this point 3, which says that the entity is embarking on the activities that are necessary for the asset to get ready for its intended use or sale. And these activities are going to be technical or administrative, but they are beyond the control of the organization. Because if they are within the control of the organization, then those ones can be sorted. So they may not cause any delay. Like for instance, in this question, we're seeing that they delayed the construction because they got the man on 1st April, but they started the construction on 1st July. But they said the delay was of the plan. You know, for any construction work, most of these construction sites, you get them from whether the district engineers, whether from any government agents that for approving the building plans. When the building plans are not yet provided, then you can't start the operation. So it means these activities that the organization is going to be doing, they should be relevant to the existence of the asset we are going to be constructing. And these are going to be the outside, they're like the external environment. The company has less influence about them. So from there, we are seeing that these activities, since the approval of the plan was very important as far as construction was concerned, it means when we are trying to these borrowing costs, we are going to start from 1st April 2018. Because for that 3 months, from April to July, the company was doing the that are necessary for the construction to begin. So it means for that period, the capitalizing borrowing cost should be done because the entity was still embarking on activities that are necessary for the construction of the factory. So that's basically what we can get from that. I hope those who didn't understand, we provided in the first video of this IS 23 will be able to pick something that is in extra of what they actually learned from there. But then let's try to go to the Excel and we try to make some summary. We analyze the information in terms of the figures that we have. We do the computations and we see what we can do. So when you try to go to the Excel, this is the same question. I just analyzed it. I just copied it and pasted it here. So we try to go to, it is November 2019, question 3. Maybe we can try to zoom a little bit, be able to see what we are doing. Can now proceed. And we want to get a small summary of what we are going to be analyzing. Summary. What we have, we are seeing that we got a loan. We have a loan that we acquired on 1st April 2018. It was 2 billion. It's 2 billion, 123. Those are 2 billion. Then we are seeing they have given us that money, but at an interest rate. The interest rate is 10%. They said it is 10% per annum. Then we have we try to look at before the commencement, the prior to construction. Prior to construction, we are trying to look at the key terms that are really important. We've seen that we had an approval. We are waiting for approval of the plan by the government. Then the second item, of course, we had even an investment. Before we started the investment of 10%, actually it was 10% of the loan. Those are the items that we had. So that's what we have, but maybe to add you something that is in excess of what we actually discussed, someone may be wondering, how do the investment comes in? What happens with these construction works? Since we say they are going to be taking a very substantial period of time or a long period, because most of the times these standards, they don't specify what a substantial period of time is, but at least something that is exceeding 2 years or 1 year. It's something that is a bit long term. So when you are doing these investments, and these investments, since they are going to be taking a lot of time for them to get done, it means when we borrow this money, before we start the construction, because we are not going to use the whole amount as we borrowed, like the whole 2 billion as we used it, and we use them at once. This money is going to be used progressively. We just use it, maybe we can say for this first month, we buy materials, we buy this, we buy this, we buy this. We keep reducing the money, but we use that money in a portion. So part of the money may be invested, and the other, when it is invested, of course, when you invest the money, you'll be getting something, and that something you are going to be getting will help us to reduce on the borrowing cost, because it's like, if say you've been acquiring an asset, you were paying 10 million, but this gives you a discount. This discount will reduce the cost of the asset, and when you reduce, you actually end up paying less. So it is the same scenario here. This investment income we are going to be earning of 5%. We will reduce on the borrowing cost that we are going to be paying to the organization where we borrowed. Because we borrowed 2 billion, we invested 10% of the 2 billion, and we earned some interest, of which that interest we've earned will reduce on the amount we are going to be paying back as interest. So that's the logic there. So we have the interest income. This is now the interest income you are going to be earning, or interest earned. You can call it interest earned or interest income, but the percentage was 5%. 5% of the 10%, 10% of the loan. So that's the summary of what we have. So back to the question. The question says, advise the management of PAR Limited on how they can account for the above transactions for the year ended 31st March 2019, clearly showing the extracts. So when we try to look at this information we have, this is what actually we need for the question to get done. But since the question says we are supposed to advise, as we discussed earlier, that these questions of this magnitude, questions that start by saying advise, what it means is that these questions needs us to advise the company, and they're expecting the advice from the standard by first explaining what the standard says according to a given scenario in the question. They may, like the way they have given us, you first explain what actually we first analyzed, to the extent that even the person who doesn't have accounting background, when that person explained that, or when that person has actually got what the standard says, can be able to make an informed judgment. So that's basically questions of advising. They are requesting us to do more on theoretical aspect, because first of all explain what the standard says, then we do the computations. Of course, we add in the figures, but not doing only the computations as we're making these advices. So our solution is now going to start with get the solution. Since we said, so we first by analyzing what the standard says, and we are saying that we just say according. Now we are basing on what the standard says. According to this 23 borrowing costs, let me put it in bold figure so that you can be able to see. An entity, or you can say PAR Limited, will commence, because we said it's going to be we are looking for. The question is testing. Commence capitalizing borrowing costs when it incurs expenditure on the asset. Now these we are now giving the conditions. The second one, when it incurs the borrowing costs, and finally when it undertakes activities necessary to prepare the asset for its intended use or sale. So now we say PAR Limited capitalizing borrowing cost on 1st April 2018. 1st April 2018. 1st April 2018 when they obtained their loan. Cause between April and July, they were acquiring approval of the plan from the government, which is necessary for the construction to take place. You can even stop there. That's something that explains that you understood something, because that's what the standard says. That will be enough. At least we've actually explained what is needed before we actually begin the computation. So having done that, then we try to look at now the borrowing cost. What is the amount of the borrowing cost that we are going to be capitalizing, the actual borrowing costs actually we incurred. So we need to understand now the movements that occurred in terms of the period when we got the money and when we are reporting. Remember, they told us in the question that they got the money on 1st April 2018, but we are reporting as of 31st March 2019, and we say that is a 1 year. So if it is a 1 year, then there is no need for us to be time apportioning that borrowing cost or the interest that we are going to be capitalizing. But if we say the loan was gotten maybe in May, and we are accounting for 31st March 2019, we would have considered only 11 months. But since it is a 12 months period, so that one we don't time apportion it, we just take the whole interest as we are going to be calculating it. And how are we going to be calculating the actual interest that has been incurred? We are going to be taking the 10%, which was the interest, we multiply by the amount we got, which is the 2 billion. So that's basically how we are going to be getting the borrowing cost. The borrowing cost is more or less the cost, the interest, even though it has some other aspects, but here we are concentrating on the interest alone. So we are going to be getting the 10%, we multiply by the 2 billion. So when we are done with that, we will be getting 200 million. 1, 2, 3, 3. So that shillings 200 million, that's going to be the interest. But remember, the interest we've got, we are not going to be time apportioning it. But we had the other portion that before they started the construction, we had the approval of the plan, but in the same sense, we had an investment. So we are seeing when we invest some of the money, we will be some interest from that investment. And the amount is supposed to be deducted from the borrowing cost that we actually going to be paying to the organization or to the bank that gave us the money. So if it is so, then let's try to look at how are we going to be computing the interest income we earned from the investment. And we are seeing that from the above information, the other summary we made, we are seeing that the investment income is going to be 5% of the 10% amount, because that's what they told us. So if you try to compute the interest income or the earned is 5%, we multiply by, it's now the 10% of the 2 billion. In other words, it is just the 5% of this 200 million. So this will give us 2.5. That is, sorry, it will give us, because when you get 5% of this, but remember this amount of money was, the interest income was earned, it is before the investment. So if it is before the investment, it means that this money is going to be for only 3 months, because we got the money on 1st April 2018, but this actual investment started in July. So it means from 1st April 2018 to 1st July 2018. That's when the actual thing started. So this is the period of 3 months. So this one is supposed to be multiply this figure by 3/12. The whole answer we get from this. So multiply by 3/12, and we'll be getting that 2.5. So that's it for the interest income. And we try now to compute the net borrowing cost that is supposed to be capitalized. So our borrowing cost, the borrowing cost that we are going to be paying equals to 400 million less 2.5. This will give us 197,500. So now the amount that is going to be capitalized. It's the amount we are going to be capitalizing. And how are we going to be capitalizing? Now we try to look at the double entry. Because the double entry, we are going to be debiting the asset account, or that factory we are constructing. Since we are adding back, this one is supposed to be added to the cost of the asset, the cost that we actually so far spent. Because when you are doing this construction, this building is not yet complete. So part of the total cost we have actually put in there, then we will add back this interest on the cost that we will actually so far have, because the asset is still in progress. Remember, it's supposed to go for different years. So what this means is that we are not even going to be depreciating this asset, because we can't depreciate it when it is not yet complete. It is still at a given. We will add this 197,500 to the estimated figure of the expenses that we have so far incurred on the construction, which will give us the total cost of the work completed to date. So even in the income statement extract, we don't need to actually to present it, because within the income statement, the figures we would have taken there would be for interest. We expense it, but this interest is now being capitalized, so it's not supposed to be taken to the income statement. Even the depreciation is not there because the asset is not yet complete. So we can't depreciate something we don't know its full value. So we can't depreciate it. So it means the only extract we are going to be having is maybe it will be only the factory itself, the cost that we have so far accumulated. So let's try to look at the double entry. The double entry is here. We are going to be with debit. We said we debit the asset, that's the factory. This factory, it may be falling under PPE, or it may be falling under investment income, depending on what this factory will be used for. But according to the question, they told us they are going to be using it for making what? Making plywoods. It means if it is going to be used for making plywoods, then it's going to be falling under PPE. So we may put PPE because the purpose is already known in the question. So we are adding that figure 197,500. Then we also credit. Now what we are crediting here is going to be the interest. The interest. This interest is not supposed to be taken to the profit and loss. So if this interest was paid, if at all the interest wasn't paid, it will be interest payable, meaning we still have a liability of 197,500 because they didn't tell us that they actually paid it. But if they had paid it, then we could put here bank because we could use the bank to offset that interest. So that's basically what this question wanted us to do. Having known this, then for the extract, that one is very easy. You just do non-current assets, you put PPE, you put the cost that we've actually so far, but even in the question, they have not given us the cost that we have actually so far incurred. We add this, the whole sum will be the PPE. Then maybe in the current assets, what? We put this interest payable. It is in current assets because this interest is going to be paid in 1 year. So that's why it is for only 1 year. That's why it is presented in what? In current liabilities, not assets. So that's basically what we are required to do in that question. And that brings to the end of our presentation, and recommend you guys to subscribe to the channel so that we can be able to learn more and more as we grow the channel. So that's it for today. The next one is going to be how we are going to be dealing with situations where we've got money from different sources and they have different interest rates. And that's what will be summarizing the IS 23, and you shall be looking at the other one because the other one is more or less straightforward. We just use these weighted things as we did them in Chuti. So they are going to be very easy, just getting the weighted averages, and we'll be able to get the single rate that we are going to be using to multiply with the costs that we have actually incurred so far to be able to get the total borrowing cost. So that's it for today. It's an end to this. So I'll see you guys in the next episode as we try to tackle the general, because this has been the specific. So we'll try to look at now the general borrowing, and we'll see how we can be able to do that. Thank you.
Good evening, viewers. Today we are proceeding with our series on impairment of assets, that is IS 36, impairment of assets. And before we go any further, I wanted to first give you some of the items that are not considered, or we look at the scope. But we are going to look at the scope in the other way around. We are going to see the things that are not supposed to be included within, or that are not catered for under IS 36. Then the rest will be, because they are very few, they are around 9 or 8. So when we get those ones away, we can be able to understand. One of them we have inventory. Inventory is supposed to be catered for under IS 2 as we saw it earlier. Then we have constructive revenue from construction contracts, that is. Then we have the biological assets, IS 41. Then we have assets that are held for sale, that is IS 5. We have deferred tax assets, that is IS 12. We have financial instruments, those are bonds, shares, that's IFRS 9. We have assets from insurance contract. We have assets that arise from employee benefit, that is IS 19. We have investment properties, that IS 40. And basically those are the ones which are out of the scope of IS 36. So the rest, just know they are supposed to be included. So when we try to look at impairment, is basically the loss in value of assets. These are just loss in value whereby the carrying amount or the asset is higher than the recoverable amount. You have an asset which costed let's say 10 million, but what you can only get from the market is 8 million, meaning that difference is going to be the impairment. We said, like when we are talking about the intangible asset, we said even the players, they can lose the value, they can go for impairment. Someone is not performing well, we find that the person bought 100 million, and I gave an example of, let's say, Pogba, Lukaku, the likes, those likes. But at the moment when you try to get some money that can come out from after selling those players, you find that they are not worth it. They give you the money you give out if you've kept some somewhere for each year of their contracts. But that's basically what we can talk about. Maybe to give you some brief definitions which we are going to be using within the scope. One, carrying amount. We said we've been talking about the thing. Carrying amount is the amount that is owed, is the net book value that is found in the balance sheet, which is the value in use that appears in the balance sheet. That is the net book value. It comes as a result of getting the cost with less accumulated depreciation and impairment losses. Of course, we are going to be seeing them. It is impairment because I had reserved this since it had its own standard. So that's how we get then maybe about depreciation. You are spreading the asset over its useful life. You'll be writing off at least every year. You'll be writing off a certain amount, but the whole cost is spread throughout its useful life of the asset. Then the other one, we spoke about the recoverable amount. Recoverable amount is actually the amount you can get from the fair value you can get from the market less the cost to sell. That is basically the recoverable value. Basically, this standard says it gives it in two ways. It is either the fair value you're going to get from the market, you less the cost, and those costs to sell, they may be in terms of transport, because when you are selling the asset, you incur transport, taking it to the market, advertising, commission to sales agent, and all that. You less it. What you remain with will be the amount. Then the other way is talking about it in terms of the value in use. Here we are meaning the entity specific value. That's another term you can use if at all you don't call them value in use. But if we are saying that if at all you are not going to sell this asset, how much can you get from the asset after looking at the cash flows that asset throughout its remaining useful life of that asset. So that's basically what we are talking about, the value in use. So as per this standard, the standard says if you are to recognize the recoverable amount, you should recognize either the fair value less the cost to sell, or the value in use, but you take the one which is higher of the two. If you get the fair value less cost to sell and which is higher than the value in use, of course we are going to be seeing how we are computing these figures. Of course, you get the estimated market price, you less the cost of sale. Then the value in use, of course, you look at the cash flows we are expecting to get from the asset if at all we are not going to sell it. So if we are getting those future cash flows, remember we are just expecting to get them in the future. It means we have to look at their present value now. What is its present worth? Meaning we are the component of discounting, like what we did in the first video, because we looked at how to discount these cash flows and we looked at how we determine the present value. Hope you can be able to remember those ones. If at all you see it is a bit confusing or challenging, you try to go through the first video. We started with the elements and the measurement bases for financial statements, because we spoke about them and we did some computations so that it wasn't just for fun, but it was going to be useful into our presentations. So having known the items that are supposed to be out of the scope, then maybe the last one I can talk about is the cash generating unit. And we said these cash generating units, they are just the small, they are small identifiable group of assets that can generate income on their own. They don't like they are not these other assets which get incomes through maybe waiting for the production to occur, and they see how much they can get from there. But this one, you can get the cash flows independently from them. They are identifiable. We said identifiable. They are capable of being sold or rented out separately. So those are the things we are going to be looking at, as far as the terminologies we are going to be looking at in the due course. So we can try to go through the notes and we see what we have. We are saying impairment refers to the fall in value of the asset, and that is its carrying amount being higher than the recoverable amount. We spoke about the recoverable amount, and we are saying the carrying amount refers to the value of the asset in the balance sheet, what we normally record as the net book value of the asset in the balance sheet. So the recoverable amount, we are saying it is the higher of the fair value less cost to sell, or the price from the sale of the asset less cost to sell, or the value in use, that is the present value of the future cash flows expected from the asset. If they are future cash flows, it means we want to know how much are they now. We discount them and we get their present worth. That will be the value in use. We compare which one is higher, then we take that as the recoverable amount. So having seen those ones, then we can look at the measurement. We can look at how we measure these impairment losses, and we'll be able to understand. Of course, you know the recognition criteria is that to recognize that there is an impairment, it means the asset has reduced value. That one is, we get it from the definition. Then we are saying that when the cost of the asset exceeds the recoverable amount, then that difference will be taken to the profit and loss. The reason why we are taking it to the profit and loss is, one, we are using fair value. I said earlier that the only thing we take to OCI or the statement of other comprehensive income is that those are the revaluations actually not realized, but this one they are realized because we are comparing with the market value. That's basically what you can pick from the market currently. That's why the differences are to be taken to the profit and loss account. That's in the names of impairment loss. By debit, we debit the profit and loss, then we create the asset. The reason why we are creating the asset, because the assets are to be reducing in value. Because by all means, when we are recording these assets, we have to record them at their recoverable amount, whether it is high, whether it is low. It's supposed to be recorded at their, if we do to record at new fair value remeasurement, or whichever figure we shall be getting as the recoverable amount. So having known those ones, we can proceed maybe to the next slide, and we'll try to look at what is there for us. We have a simulation, of which this one I'm not going to let me take you through the computations, that will be able to, but this one is only testing about that, but you know how to get this. I taught you how to get the present value. You can get this, but I've given you the impairment is this, and the recoverable amount is this. Of course, we say the recoverable amount, we compare the fair value, and they are saying here, maybe to give you just a brief view, they are saying the mass has a carrying amount of 900,000. I did not put you can put any whichever country you are watching it from. It has a carrying amount of 900,000, and it is estimated to generate cash flows. These are the ones we are going to get, the cumulative cash flows of it is 220,000 per annum for every year from year 1 to year 5. It means we are done 220 for every year for 5 years. And now they are saying the fair value, this one is supposed to be the fair value. So the fair value less cost to sell is 660,000. They have given us the discount rate, and they are saying they want us to know whether the asset is impaired or not. What we said is that we discount, first of all, we discount this amount, but since we are getting a constant amount, we are going to use the annuity tables. Sorry, the annuity factor. Either you may use the annuity table, you get the what will be the annuity for the 5th year, then you multiply by this, you compare the figure you are going to get from this with this. And when since here I took the recoverable amount to be 773, it means this amount was higher than this. So it means we take the higher, which in this case we took this, meaning this amount was higher than this one. You get this, you multiply by the annuity factor, or you can discount it yearly and you use the discounting factor, then you sum up, you get the present value, you compare with this. Then having got that, you compare this value with this, because this is the carrying amount at this date. Remember, we were not given years. If we were given years, we could take in the depreciation component, but we were not given. So you just compare with this. If you compare this amount with this, you'll find that we have a loss, because this is 700 something and this one is. When you get the difference, it will give you this. How do we account for this? We treat it as an expense. But subsequently, we are saying that when the asset is impaired, it will be subsequently carried at the recoverable amount, whether high, whether lower. So it means even if the carrying amount was this 900,000, but we are going to record it in the balance sheet as 7 this, because it is our recoverable amount. Then we take, by taking this to the profit and loss, it means even if you don't do any transaction, by the time you will take this amount to the balance sheet, the net profit that you will take to the equity section will be already less by this figure. So our thing will be balancing. Hope you can be able to memorize that. Then we can try to look at, I was dodging that simulation, but we can see how we see we can look at something that is a bit new, and it's not new. We talked about it when we were talking about IAS 16, that is accounting for revaluation and impairment. There happens a scenario whereby that this asset was previously revalued upward, or we had a revaluation gain, and now the asset which increased in value for a certain time. Maybe we can use this very example here. It will be able to guide us before even we go through the explanation. We are saying that an asset had a carrying amount of 10 million on this date, but on that date it was revalued at 20 million. On that date, meaning on 1st January 2020, it was revalued at 20 million. It means we had a revaluation gain of getting this difference from this. We get a revaluation gain of 10 million. So the implication is, now when they went for an impairment review, because they are saying an impairment review on 31st December, meaning at the end of the year, the asset was revalued and the amount was only 8 million. Meaning this asset previously it had a gain, because previously we recorded it's 20 million. But as for now, we are recognizing a loss. At the end of the day, we are recording 8 million. So how are we going to be treating this? What we do in the explanation, we can get. Remember in the first scenario when we got the revaluation gain, we said we debit the asset because the asset is increasing. Debit the asset by 10 million. That is the difference, because it had 10 million as the carrying amount. So when you added the 10 million, it reached to 20. You debit the asset by 10 million, then we credit the OCI, or the statement of comprehensive income, by the 10 million. So by the end of year, we had a revaluation, did a revaluation, and the asset was impaired. So what will happen, we will first of all depreciate this asset to get the carrying amount for the asset as out of this. Then we compare. When we compare that, we will be able to get the value. So when we did the impairment, we found that this asset has reduced. Of course, here you may not depreciate the asset because you have not been given the useful life. You may take this as this. You leave alone the depreciation because you are not given the useful life of the asset. But if it was there, you'll be able to depreciate the asset, and you make sure you reach to the carrying amount as of this. But since it was not given, you just base on this and you get the difference. This one will be its carrying amount, then this is the recoverable amount, meaning we shall be able to get the 12 million as our impairment. But what will happen? How are we going to record this? Remember the other 10 million, we took it to the OCI. What we do, that impairment, first of all, it has to be compensated from that valuation gain. By doing the complete reversal, what we do, the time we created the OCI, now this time around we are going to debit OCI, but we debit it with the amount, the valuation gain which we had previously of 10 million. So this 10 million we shall debit the OCI by 10 million, then the balance is shall be taken to the profit and loss as an impairment. Meaning when you are creating the asset, of course we create it by the 12 million because it has lost value. It was 20 million, now it is 8 million. Hope that one helps. And when we do these computations, you'll be understand more of this. But what I want you to get is this theoretical aspect. Then we can talk about how do we account or how do we treat the impairment of the cash generating units. We said these cash generating units, they are small identifiable group of assets for which independent cash flows can be identified and measured. We can get their money. They can generate their own money, and we can probably measure that amount of money. So how do we how do we account for they have been impaired or not? We are saying that if it is not possible to determine the value in use of the asset or the cash flows from the asset, then a group of assets combined together, that's to form the cash generating units. And we are saying a cash generating unit is the smallest identifiable group of assets for which independent cash flows can be identified and measured. Remember, this is a group, it's a cash generating unit we are putting in. There are so many items. How do we deal with it? When a cash generating unit is impaired, the impairment loss will be allocated to the asset in the following order. This is the order we follow. First of all, we first give the impairment to those assets which are completely damaged. You may get scenarios where they are saying that, let's say a certain motor vehicle involved into an accident and it got damaged, or there are so many scenarios which they may use for you to be able to identify the damages that have reached to the asset, that have gone to the asset. While we are first giving, because those are the ones which are almost destroyed. So we first the impairment. Then the other one we give to goodwill if there is any goodwill that is allocated for that cash generating unit. Then the last one, whatever is remaining, because you may find that the impairment, let's say, is 15 million, and the damaged items they are taking, let's say the damaged items maybe they were for 5 million, and maybe goodwill that was allocated was 10 million, and you find that you are not remaining with anything. If you are not remaining with anything, then these other ones you just leave them. But if the is remaining, if let's say these ones are taking 5, the other one, the goodwill is taking 5, then that 5 that is remaining to make the total of 15, which was the impairment, you just get that and distribute to the remaining assets on a pro rata basis. Pro rata basis means you are going to distribute according to the cost, their cost, and maybe the total. those that are remaining, each one total. Then you multiply by the remaining impairment. These ones I was just giving a brief items that are not supposed to be part of the standard. And we have a simulation. This is a simulation, a simple one you can look at. Then we have a trial number, October 2021, question 4. Let me finalize with this. I hope it's the one that is winding up our topic of impairment. Then when you do these simulations, you'll be able to get more and more, because when you are seeing figures, it will be easy for you to understand. But you need to get these concepts. They are very important. We are saying the reversal of impairment. What do we mean by saying the reversal of impairment? What happens is that there are certain scenarios whereby the asset was previously impaired, but at this time now, instead of being impaired, it is now having a gain. How do we treat that? The other one, remember, was a revaluation gain, but this one now we can't use a revaluation loss, because here the assets are going to be, it's more or less the assets are impaired. So if the assets are impaired previously, and now we are registering something that is different, how do we treat it? We are saying this arises when the recoverable amount of an asset that was previously impaired is now higher than the carrying amount. The reversal of the impairment is recognized in the profit and loss. The reason why we recognize in the profit and loss is because we are dealing with the recoverable figures, and we say these are fair value figures, so we put them in the profit and loss. And we are saying if the original loss was debited to the OCI, like the same way we did for the revaluation, if at all it was previously debited to the OCI to reduce the previous revaluation gain which you had, then we do the reversal by crediting the OCI. We are going to look at a question and we'll be able to understand most of the things, but maybe there is a note which we are saying a reversal of impairment, however, take the value of the asset above, should not take the value of the asset above what would have had if the original impairment did not occur. What we mean here is that when you look at these assets, if the asset was previously impaired and now it is increasing in value, what are we going to be recording in the financials? We are saying it shouldn't take more value which it would be having before even it got into that scenario of being impaired. So those are the things we are going to be looking at when we do the question. And we are saying impairment loss on goodwill is not reversed. Of course, you can't, if goodwill is impaired, you don't reverse, because at the end of the day, goodwill, there is no way you can say I'm recovering the lost name. There is no way you can do that. That's why we are not reversing goodwill. Let's meet in the next video where we are going to be talking about this, but there is a simulation. We are going to look at it in the due course, and we'll be able to understand more about it. But I urge you guys to subscribe to the channel so that we can be able to learn more, because when I start these simulations, you'll be able to pick a lot, and I will be explaining more and more when you are seeing the figures. Thank you.
Good afternoon, viewers. It's your tutor CPA Charles Cafe, and today we are going to look at the simulation 5, and it's under IS 36, impairment of assets. We've been talking about this impairment of assets from the start. Of course, we tried to look when we were in IS 16, IS 20, IS 41, and others. We tried to look at the impairment of the asset, but now we are going to talk about the practical computations that are going to help you understand and appreciate the theoretical aspects that we discussed in our first video that introduced this standard of IS 36. And from the beginning of this video, we made sure that at least we try to make you remember some of the items that we are going to be dealing with. And I wanted to first give you a precursor of what we discussed from the first video. That was the theoretical aspect that was highlighting all the items that are going to be covered within the IS 36 impairment of assets. But here we are going to be looking at the key terminologies that are used within the IS 36. We try to look at the measurement. When we finish the measurement, of course, measurement of impairment loss, we shall look at how we can account for revaluation gains and impairment of the asset. Scenarios whereby in the first year we had a revaluation gain, but in the next year the asset is going to be experiencing an impairment. And of course, we shall look at the impairment of cash generating units, those where we determine where we try to look at how these cash generating units are going to be impaired. We try to look at some of the things that we can't estimate their value in use and how we can be able to determine their impairment. So the last part or the last bit of the standard, will be talking about the reversal, of which the reversal of impairment, where maybe we had an impairment first, then in the preceding year you find that the asset is going to be having a gain or is not going to be impaired. So those are the things that we are going to be looking at. But as far as computations are concerned, we are going straight to the measurement of the impairment, and we try to look at some of these ways how these assets are going to be impaired. And basically, when we try to look at some of the key terminologies that are used within the standard, and we said what is impairment, we need to first know what impairment is. We need to know the value in use. We need to know the recoverable amount. We need to know the carrying amount, because those are the figures those are the terminologies that we are going to be using as far as when we are doing computations for this IS 36. So impairment is basically the fall in the value of the asset so that its carrying amount is higher than the recoverable amount. Actually, what this means is that when these assets are going to be less, let's say the cost or the amount we have in the balance sheet, that is the carrying amount, is higher than the amount we can actually get from the asset. And the recoverable amount, actually, if I may start with the carrying amount, carrying amount, we said that is the value in the balance sheet. It's not all the same that the carrying amount is going to be the same as the net book value, because when we're doing financial accounting, that is level 1, we try to look at the net book value in a sense that it is the cost when we have less the accumulated depreciation, and that was something that was giving us the net book value. But in this paper of financial reporting, I want us to deviate more from that aspect of saying that carrying amount is always the same as the net book value, because in this financial reporting paper, you find that some of the standards are using different models. Like in IS 41 uses cost model and fair value. So you may find that the actual figures that are going to be in the balance sheet for someone who have actually used the fair value is going to be different, either fair value or the revaluation. So when you're talking about the carrying amount of any asset, we are talking about the figure that we have in the balance sheet. It's not going to be that all the time the company is going to be using the cost model, so that we get the cost minus the accumulated depreciation. So I hope you can be able to get that difference between the carrying amount and the net book value. There are some are related, but there are some bit of differences as we specified. So that's basically the carrying amount, the value in the balance sheet, or the value of the asset in the balance sheet. Then the other one is the recoverable amount. These key terminologies are very important because we are going to be using them interchangeably. You will find that if you don't talk about the carrying amount, you may find we are talking about the recoverable amount, because we are going to talk about them until we finish all the computations that are within the standard. So it's better you get them from the start. And for those who need more clarity on them, make sure you try to watch our first video, because we took time and we explained everything because we knew where we are heading. So the recoverable amount, of course, the standard defines it as the higher of the fair value less cost to sell, and that's basically the price to be received from the sale of an asset. But that price, we look at it and we less the cost that we are going to be incurring. In other words, it's what we are going to be receiving from the market after deducting what we incurred to make that sale. For example, if let's say you wanted to sell an asset, maybe a computer, but you get a broker or you give to this sales agent, you pay them a commission. That commission is supposed to be deducted from whichever amount you are going to be receiving from the sale of that laptop, and what remains there is actually what we call the fair value. Then the fair value less cost to sell. Then the other item is the value in use, because they are saying it is the higher of the two. The two items, we have the fair value less cost to sell and the value in use. Value in use happens in a sense that if at all you are not going to sell this asset, if at all the asset is not going to be sold and you are going to use it in the business. So we are trying to look at what is going to be the amount we are going to be generating from the use of that asset. Remember, we only recognize these assets when they can transfer economic benefits to the entity. So since they are going to be providing economic benefits in terms of money to the organization, we try to look at what's going to be the amount that we are expecting to receive from that asset for different years over its useful life. So we try to look at that figure, that's the value in use, or the actual amount we are expecting to receive from the use of an asset. So that amount, since that amount is going to be in the future, we need to discount that figure to its present. And how do we do that? Of course, we get the discounting factor that will be given the question. We discount that future sum of money and we make it present. Because the reason why we are making that figure present, because we want to compare it and we make sure we record certain figures in our financials. That's basically what actually we are going to be looking at. So if you want to know the impairment loss, whether the asset has been impaired, you compare two things. You compare the carrying amount of the asset, and you also, you compare the recoverable amount. And we said the recoverable amount is the higher of the fair value less cost to sell and the value in use. So we can now try to look at the question and we see what the question wants us to get. This is simulation 5, and it's basically we are trying to look at the impairment of the asset or the impairment loss. And we said impairment loss is just a fall in the value of the asset where the carrying amount is higher than the recoverable amount. So we are saying that the machine has a carrying amount of 900,000 and is estimated to generate cash flows of 220 per annum from year 1 to year 5. Its fair value less cost to sell is 660,000, and the discount rate is 15% per annum. Then the question says determine whether the asset is impaired or not. So this question says determine whether the asset is impaired or not. What that question brings to whoever is going to be solving the question, you get two things. Of course, you have to first explain what impairment is before even you do the computations, because we are trying to narrate, or we are trying to explain to people who don't have any accounting background. So we need to first explain what happens if someone says that the asset is impaired. You need to, first of all, first narrate what happens, or what do you mean by impairment. Then from there, you can try to put in the figures so that someone can be able to get exactly what impairment means, and they can also be able to make a decision whether to sell off those assets, whether to do whichever information they wanted to do with the asset, depending on what you have actually computed as the outcomes. So let's try to look at the solution. Of course, I gave the answers, we gave the impairment, and we gave the recoverable amount. But this was just a guidance for someone who actually first listened to our audios, the theoretical aspect, so that when you are going through this question, if you don't get these values correct, you find that you have to rewatch the video again and be able to understand so that you can solve these things out. But for now, let's try to look at how we can be able to solve this. So before we compare these values, of course, we said when you are determining whether the asset is impaired, we have to first of all know the carrying amount and the recoverable amount. So that's why I'm saying before we compare these values, we know that the asset is impaired when the carrying amount is higher than the recoverable amount. So now we are trying to look at the value in the balance sheet. If that value in the balance sheet is higher than what we can recover from the asset, then it means that the asset is now impaired. So that's the emphasis I wanted to make, because if at all you don't understand some of these key terms, you may not be able to get what we are going to be solving. And we are seeing that from the question, we have been given the carrying amount as 900,000, and the recoverable amount, we said it is the higher of the fair value less cost to sell and the value in use. But we say the value in use, we get it by discounting the future cash flows, and then the fair value less cost to sell, we said we try to look at there are certain costs. You may find that they have just in the question they have just given you the, because here they gave you the fair value less cost to sell was 660,000. But in the other questions, you may find that they have just given you the fair value of the asset. Maybe it was 700. And you find that they are giving that the cost they incurred to sell or to realize that fair value, that market price, is maybe 40,000. So when you deduct, you'll be able to get the 66,000. So if you are given this information in parts, you've been given the cost that they incurred to sell these assets, you make sure you first do that analysis before you start to recognize those figures. So they went ahead to say that it is estimated to generate 220 per annum from year 1 to year 5. And those are the future cash flows we are expecting to receive every year. So we need to discount those cash flows, and we'll be able to get their present value. If you're expecting to get 200,000 maybe in 1 year's time, in year 1, or towards the end of year 1, what will be the worth of that 220 in year 0, or at the start of the year? Because they are saying we are going to be receiving that same amount, 220, for 5 years. So we are now trying to look at what will be the worth of that sum of money we are going to be receiving in the future today. So that's what we call the discounting, and we shall learn more when we try to go back to check the financial management videos and be able to learn more of what this discounting means. So now we need to know how we can convert these future cash flows we have received and we turn them into our present values. We said we are going to be now, we said there are two options. You may go by discounting each cash flow you are going to be receiving every year, or you may decide to use the annuity factor. And the annuity factor is just a sum. It is just a sum of all those discount factors from year 1 up to year 5. It gives you a sum of those discount factors, and we just multiply that annuity, we multiply by that annual cash flow, if at all these cash flows are going to be uniform. Uniform means you are going to be receiving the same money every year for the next 5 years. But if these cash flows are different, if maybe you are receiving 200,000 today, next year you are receiving 220, the other year you are receiving 230, make sure you discount everything using the discounting factor, not the annuity. Because if you use the annuity sums up all the amounts or all the discount factors for those period, and you'll be able to get only one digit that can be able to, and when you multiply with that uniform cash flow, you'll be able to get the same answer as someone who computes for every year and at the end of the day sums up all the figures. So I hope you have actually got that. We are going to try to see how we can be able to convert these values into our, we'll be able to see how we can convert these figures, and we see what we can be able to get. So let's try to go to Excel and we try to see what we can do, because it's where we are going to be able to compute some of the things and be able to understand as we see what we are doing. When I open here a small spreadsheet, let's try to wait a bit and we see how it displays, and we'll be able to see what we can do. We can try to enlarge a bit. So we can try to make summary of what we have, because I'm seeing here in the question we have the machine, they have given us the carrying amount. So if they have given us the carrying amount, we can start with that. The carrying amount, we have it, carrying amount, and the carrying amount was 900,000. I did not put any currency sign because people are viewing from different countries. So you can be able to add whichever currency, whether dollars, whether Ugandan shillings, but I've just given you the figures, and the rest will be upon you to decide which currency symbol to use. But what my emphasis is basically for you to get the basics and you'll be able to do the computations. Otherwise, that's what I want you guys to be getting. So let's also try to look at the recoverable amount. Remember, we said we are comparing two figures, and our recoverable amount, of course, we said it is going to be the higher of the two. Is going to be now the higher of A. We have the fair value less cost to sell, which they gave us as the fair value was given to us. It was 66. Then we have also to look at the value in use. We computed these things when we were doing the first, actually our first video was all about doing these present values, and we said this is going to be discount, we get the present value, and it's going to be, since we are going to be receiving uniform cash flows, we said we are going to be using the annuity factor to multiply that figure by our annual cash flows. So the annuity factor is got by using this formula. We gave these formulas, so don't get scared, because these things we did them when we are doing the first number we handled. So it is 1 minus, we open bracket, it is 1 plus R, and we said our R, that R represents the discounting factor, and we try to divide all of it, we divide by, this is to power, it is 1 minus 1 plus R to power n, and n is our number of years. Then when we have got that, we divide the whole thing by R. We said our R is the discount factor. They have given us the discounting factor, so it will be 1 minus, open bracket 1 plus R, and our R was given to us as 15%, so it is 15%, close the bracket, that one is to power. Our N was given to us as 5 years, because they said we are going to be receiving that money for 5 years. Then the whole of it is going to be divided by 15%, divided by 15%. So when you try to compute that, you'll find that you'll be getting, this was supposed to be negative power N. Sorry, there is a negative here. In the formula, it's supposed to be negative power N. Even this one will be power negative 5. So this will be able to give us 3.352. And that's the annuity factor. We said for us to get our present value or value in use is going to be equaling to the annuity factor, which is 3.352. We multiply that figure by flows. And our uniform cash flows, they were 220,000. So this will give us 737,440. And this is the figure that we call the value in use. I said you put whichever currency sign you want. Let me have taken that one. I've not given it any currency symbol, but you are supposed to provide one. So they told us everything is going to be, our recoverable amount is going to be the higher of the two. Either it is going to be either the recoverable amount, or it is going to be the value in use. So when we try to look at this, we are seeing that this is going to give us the higher is going to be 737,440, which is going to be our recoverable amount. This is therefore the recoverable amount is 737,440, which is the higher. So now what we are going to be doing is we are going to be comparing with the carrying amount and the recoverable amount. We can bring here our carrying amount, and our carrying amount was 900,000. So now if you try to compare these two values, we can be able to determine whether the asset is impaired. It means that the amount we can actually get from the market is only 737,440. But the carrying amount or the value in the balance sheet is 900,000. It means the asset has reduced in value. And that deduction is what we call the impairment loss. And the loss is going to be the difference between 900,000. It's going to be the difference between 900,000 we less the 37,440. That will give us a difference of 162,560. And this is going to be our impairment loss. That's the figure for the impairment loss we actually got. So having done that, we are now looking at how we can be able to get which figures we are going to be taking to the balance sheet using the subsequent measurement. Because we said when an asset is impaired, the recoverable amount is what's supposed to be taken to the balance sheet. Even if it is lower than the carrying amount, we take the recoverable amount or the revalued amount. And that's basically what we are going to be doing. We are seeing that the asset is impaired since the carrying amount of the asset, since the carrying amount of 900,000 is higher than the recoverable amount of 737,440, hence giving us the impairment loss of 162,560, and this can be taken to the profit and loss. Of course, this impairment loss goes to profit and loss and is deducted as an expense. So the double entry here, they are going to be, we are debiting profit and loss by 162,560, and we are crediting the asset because the asset is going to be reducing in value. So we can try to write it here. Maybe we are going to be debiting the profit or loss account by 162560. And the other one we are going to be crediting, because here we credit the asset by 162560, showing an increase in the what? So showing a reduction in the value of the asset. But in the profit and loss, it goes there as an impairment loss. Here you can add in. It goes under expense, but it's supposed to become in the names of impairment loss. So that's it. And that's what the question wanted us to do. But remember, I gave you the first thing you were supposed to first start with here. You start with the narration explaining what impairment is as we actually discussed it. And that's basically what the question wanted us to do and be able to find whether the asset is impaired. So this last bit of it, you have also to write, you make a comment, because the question was asking to determine whether the asset is impaired or not. So you make a comment that the asset is impaired because the recurring amount of 900,000 is higher than the recoverable amount of 737,440, giving us an impairment loss of that. You explain that, but you make sure you don't be too wordy. Explain something brief, but it can bring out the whole idea of impairment. That's basically what we can do. But in the next video, we are going to also look at the same thing of impairment, but this time around, we are going to be looking at the accounting for evaluation gain and impairment of the asset. And we are trying to look at when an asset that was previously revalued upwards, or which had a revaluation gain last year, but this time around, this year, it is getting impaired. How do we treat that? Those are the things we are going to be finding in the next video that we are going to be dropping very soon. Thank you guys for watching, and urge you guys to make sure you subscribe to this channel. We'll be able to get the information that we need, and we'll be able to understand as we also help the channel to grow, so that we can be able to share knowledge. You make sure you comment. If there's something that you didn't understand, please put it in the comment box, and we'll be able, you can try to email me, you can WhatsApp me, and we'll be able to clear everything out, as it will help you understand more and more. Thank you for now. Share these videos to others so that they also get what you have actually got. So it's bye for now until we meet in the next video that's going to be coming very soon. Bye-bye. Good evening, viewers. Today we are going to resume with our series financial reporting, and our emphasis for today is going to be on how we account for the valuation gain and and impairment loss. This is now the third video about the IAS 36 impairment of assets, and the first one was about the theoretical aspect. We did the second one, and it was showing how we can be able to identify whether the asset is impaired. And we did the computations. We showed how we treat the impairment loss, the financial statements, and now we are looking at instances where an asset that had a revaluation gain in the previous year, and that revaluation gain was taken to the OCI, or statement of other comprehensive income, and that is the part that comes immediately after the net profit. And at the same time, that same asset in this very year, on the current year, the asset is going to be suffering an impairment loss. And we are looking at scenarios whereby if that happens, then how are we going to be treating, or which figures are we going to be taking to our financials as far as recording those assets in our balance sheet is concerned. So today the main question is going to be about the basics. We get the basics, and it's going to be our simulation 6, where we are going to be looking at that scenario where we have a revaluation gain in the previous year, but in the current year, the asset is going to be impaired. We want to see where we are going to be recording these values. And without wasting more time, hope we go to the question and we try to pick what we can be able to understand. Saying that an asset had a carrying amount of 10 million on 1st January 2020, and they are saying that on that same date, it was revalued to 20 million. So if the asset had a carrying amount as of 1st January 2020, but when they did the revaluation, or when they revalued the asset at that same date, found out that the recoverable amount is going to be 20 million. And they are saying that an impairment review on 31st December 2020 revealed that the recoverable amount was 8 million. And the required says show how the asset will be accounted for in 2020. From that question, we are saying that an asset had a carrying amount of 10 million on 1st January 2020, and on that same date it was revalued to 20 million. And from that point we can see that there was a revaluation because the asset was the carrying amount of the asset was 10 million. Remember we said for a revaluation gain to happen, the carrying amount is going to be less than the recoverable amount. In other words, we are going to be having, if you are to sell off this asset, we are going to be getting a lot of money other than, or which is in excess of the recoverable of the carrying amount. That's how we get the carrying the revaluation gain, where the carrying amount is lower than the recoverable amount, because we are seeing the recoverable amount is 20 and the carrying amount is 10 million. But make sure when you are comparing this information, you make sure that the information you are comparing is at the same date, because if say that these assets were depreciable assets, you may find that if they give the carrying amount on a different date, you have to look for the depreciation to make sure that you get the exact carrying amount on the same date when they did the evaluation to be able to give a right figure. So now we are seeing that we have that revaluation gain of 10 million, because it will be the 20 million minus the 10. So that gives us that difference of 10 million as the gain. And how we record these gains, we always debit the asset, because the asset is increasing in value. We debit it by 10 million and we credit the OCI, that is statement of other comprehensive income. And it is that part that comes immediately after the net profit has been computed. So it means in the income statement, that thing is shown after the net profit. Then in the balance sheet is presented as an equity component, as a revaluation surplus and the equity section. Now for the asset, if you are to take the figure as at that same date of 1st January 2020, you will find that the amount you're going to be taking in the balance sheet will be the 20 million, because we will be taking the of the asset at the recoverable amount, not the carrying amount that the asset had. So we are seeing that even again from the question, we are seeing that we had an impairment. The impairment was done as of 31st December 2020, and it revealed that the recoverable amount was 8 million. It means the other one was 1st January 2020, and now we are looking for 31st December 2020. That's a difference of 1 year. So if it was a depreciable asset, you would have to compute the depreciation expense, but that depreciation will be computed on the revalued amount. Since the asset wasn't specified whether it was or non-depreciable, then we don't need to compute the depreciation from here. So from that last bit, we are saying that again, we are saying that the asset is now going to be reduced in the value. Remember, the carrying amount, the new carrying amount, which is the valued amount, is 20 million. But as of 31st December, they are saying that the recoverable amount now changed to 80 million. It means there is a general fall in the value of the asset, which is accounted by an impairment loss. So since we are incurring an impairment loss, because the carrying amount is higher than the recoverable amount, we say that we are having an impairment loss. So having known that this carrying amount of 20 million is higher than the recoverable amount of 8 million, it means it creates a difference. And that difference is going to be the impairment, which is 12 million. So what will happen is that this 12 million we've got today, we will not record the whole figure because the previous gain that was registered for the year for the beginning of the at the beginning of the year we had a gain. So if we had a gain there, it means we have to first of all this loss we've got to make sure that we first reverse the previous gain we got. What happens is that this gain we got, we took our income statement and we added to our net profit that we got for the year. But in the normal business, we shouldn't be in those gains because at the end of the day, they are not realized. So what we do, this loss we've got, the impairment loss of 12 million we've got, we shall use them to offset the gain we got last year, which was 10 million. So the balance of the 2 million is what will be taken to the profit and loss as an expense in regards to the impairment losses. But the 10 million will make sure it cancels the gain we had in the previous year, and that's how everything is supposed to be recorded. But what you have to note from here is that if at all we had a revaluation loss last year, and today we're having an impairment loss again, then it means we are not going to be reversing anything because all those items, the revaluation loss and the impairment loss, all of them are going to the income statement as expenses, or they are deducted from our gross profit. So there is no need for that adjustment. That's why we don't talk about it. The only challenge is that if the asset had a gain in the previous year, and now it is going to be having an impairment loss. So let's go to our Excel and we try to do the computations, but that's what we should be getting from the analysis of the question they have given to us. So when we go to the Excel, we are going to just summarize what we actually discussed. So we are seeing that we have the carrying amount. Let's start with the carrying amount we have. And the carrying amount is on the date of is on 1st January 2020, and the value is 10 million. And we are seeing that even the asset was revalued, then the revaluation devalued to 20 million. 20 million, we are going to difference. We said we are going to be having a revaluation, and this revaluation gain is going to be the difference between the 20 million minus the 10 million, which will give us a difference of 10 million. Remember, this was revalued at the same date, which is 1st January 2020. Since we've got that, we said we first register this one as a debit to the asset account. show that the asset is going to be increasing in value by 10 million. Then we credit, first we credit the OCI, that is other comprehensive income. And this one is going to be in regards for our evaluation gain of 10 million. Then this asset now will be carried at that same date. The asset will be carried at the revalued amount. Can put it here. The asset will be carried at the revalued amount of 20 million. That's what we will be using to account for subsequently accounting that asset. And now, after doing the impairment review on 31st, then the impairment review, it was there on 31st December 2020, and we found out that the recoverable amount as of that date, recoverable amount as of 31st December 2020 was, but our carrying amount as of the same date, our carrying amount still remained the same cost was still at 20 million because we didn't have any depreciation which would have reduced this carrying amount of 20 million. But if we had the depreciation, we'll deduct it from here. But since we never had, then it means we compare this and that, be able to get our impairment loss. And that impairment loss is as a result of getting the 20 million less the 8 million, which will give us 12 million. And this 12 million is our impairment loss. Evening viewers, today we are going to resume with our series, financial reporting, and our emphasis for today is basically we are going to look at the impairment of a cash generating unit, and we are looking at it having seen the first two videos that we did, and we looked at how we determine impairment, an asset, and we also looked at scenarios where we had a revaluation gain in the previous year, and this year we are experiencing a revaluation loss, an impairment loss. We did that, and here is just a continuation of what, you may need to know as far as impairment of assets is concerned. And this is going to be all about impairment of a cash generating unit. And basically, when you try to look at a cash generating unit, it is just a terminology that has been given to a group of assets that we can't easily attribute individual cash flows to it. In other words, we can't easily determine cash flows or the value in use. We can't determine the value in use, and the only way we can do is by grouping these assets together as one asset, since we can't easily determine the amount of money that can be contributed by each item within the group of assets. This is just a continuation because we had done the first video which gave out the theoretical aspect, but here we are just giving us a precursor of what actually we discussed. But to make the thing very simple, to put this matter into something that is very lively, we may try to look at an example. If let's say we have a school and that school has buildings, and within those buildings we have chairs, we have chalks, we have all these small furniture that have been used by the school in order to provide education services to students. It becomes very hard to determine how much of the school fees that has been paid by a candidate that is going to be contributed by this building. If let's say maybe it is the building, you are trying to look at what is the percentage of the money we've actually received, and it has been attributed by the building or by the furniture, because you can't it is hard to trace how much furniture contributed to the school fees someone is going to be paying. Let's say maybe you've been paying maybe tuition for CPA. You'll find that it is a bit hard if at all maybe you are attending online classes. You'll find that they have a projector, they are using a computer, they are using a tablet, so that you can be able to receive all the information. What we are trying to look at here, all those items that are going to be used in the study, maybe online classes, you find that you can't estimate if maybe the whole tuition maybe for studying financial reporting is maybe $50. You may find that if someone asks you a question that how much is the computer you are using, or the projector you are using, how much is it as far as or what is the percentage of the income that has been generated by the projector, what is the tuition they are paying, you can't easily identify the cash flows that are going to be belonging to that specific item. This means that these assets, they work as a team, and they be able to accomplish the work. Meaning even the money we are going to be receiving, the cash flows are going to be attributable to a group of assets. So that's basically what we are trying to look at here. And if maybe another lively example is maybe if you are running maybe a restaurant, you find that you have plates, you have fridge, you have maybe oven, you have maybe even these small furnitures that have been used within the restaurant. So it will be hard for someone to answer a question that how much is furniture contributing to the money they have given you at the end of the day, or the money you earn, how much, or what is the percentage that these furnitures are contributing to the money you are actually getting. It will be a bit hard. You find that if at all you don't have one, you can't operate. It means that these items, they work or they function together. Even the money you are going to receive, you receive it in a lump sum. You can't easily attribute one item that this one brought this and this one brought this. So that's basically what we are trying to look at here. And having understood that these items get their value in use, we said value in use is the present value of future cash flows, meaning you can't identify one item and you say that this is the cash flow that is coming from this one item. So if it is like that, it means we are going to be calculating the impairment as a group, or we are going to be getting a group impairment, and we'll try to look at some of these assets that we can't actually isolate their income or their contribution to the money we are receiving. So having understood that we are going to be receiving this money in a lump sum, and we are going to be looking at the impairment for a group which we call a cash generating unit. What you have to understand that is that when you are computing impairment of a cash generating unit, we have to compare the total carrying amount of the assets within the cash generating unit. If let's say these assets, we had maybe furniture, we had maybe computers and all that, plus the buildings, we add them up and we try to look at their total, and we compare their carrying amount. We say the carrying amount is the amount that is, actually it is those are the figures that are within the balance sheet. So when you try to compare all those figures, the total of the carrying amount with the recoverable amount of the whole figure of the cash generating unit, they will give you the recoverable amount of the cash generating unit. And you will also be needed to calculate the total, if at all it's not given, to calculate the total carrying amount of the cash generating unit. You compare that and you'll be able to see whether the asset is impaired. or not? Because we said an asset is impaired when its carrying amount is higher than the recoverable amount. In other words, the money we are to get, if at all we are to sell these assets, is less than the value or the carrying amount as at the time we are selling them. Meaning, if you are to sell them, you recover less than their value. That's basically the implication of that's when we are going to be having an impairment loss. And within this cash generating unit, we try to look at 3 steps. One is that we try to look at the total carrying amount of the assets in the cash generating unit. Then the second item is that we try to look at the total recoverable amount of the cash generating unit or the group of assets. Then the other one we look at is now a comparison whether the asset is impaired by trying to comparing the carrying amount of the CGU or the cash generating unit and the recoverable amount of the cash generating unit. When we have done that, then we look at now the impairment loss we've computed, and we try to make sure that we allocate that impairment loss in the following order, which I'm going to give you. There is an order we follow of how we are going to be able to allocate the impairment loss of a cash generating unit. And we said one of the item you start with is if there are any damages or destroyed assets. In this case, you find that the asset has completely gone off. Maybe the asset had an accident and it completely crashed down and you can't recover anything from it. So that's what we give as our first priority. Then the next one will go to the goodwill that has been given to the cash generating unit. If there is any goodwill, then we are supposed also to write off the goodwill. Then the last one is now the balance. We try to look at the balance that has remained on the impairment. If let's say we had impairment loss of maybe 10 million, but we had maybe an asset of maybe 2 million or 5 million that was completely damaged. We first remove that 5 million, then the balance of 5 million that is going to be remaining as the impairment loss, we remove on that balance, we remove again if there is goodwill. If maybe the goodwill was 2 million, we remove the 2 million and we remain with 3 million, meaning these 2 million plus the other 5 million of the damaged asset, they have now been written off from our impairment loss. Then the balance is what we use the remaining assets on a pro rata basis. A pro rata basis, it means we take the total of those values that are remaining or of those assets that are remaining. We get their sum, their total. After getting the total, then we start getting the individual item over the total. Then we multiply by the remaining impairment of 3 million. Based on that example we have given, we do for each and every item, excluding some of the items that are supposed to be excluded when we are computing impairment losses for cash generating unit. And for the scope of financial reporting, we are mainly to be focusing on 2 items. One is inventory, and this inventory, for it, we don't include it in our computations losses, because when we're in IS2, we try to value subsequently, we try to value inventory at the lower of NRV and cost. It is the lower of cost and NRV, or the net realizable value. So when we try to look at the lower, we make sure that whenever we go to the income statement, we less the changes loss in inventory. and that loss in inventory is always deducted as an expense. So if at all we have given that, we have already shown its treatment as far as standard of IS2 is concerned, then when it comes to impairment, we are not supposed to compute impairment for it. Then the other item we can talk about is accounts receivable. These accounts receivable, those are the debtors, the one we have at the end of the year, or that are remaining, that are still outstanding for the year. Then what happens with those accounts receivable is that whenever we have, or whenever we expect, we suspect that some of these debtors they are not going to be paying, we create a provision for bad debts, and that provision for bad debts is deducted as an expense in the income statement. So if it is done like that, then it means whenever we come to impairment, we are not supposed to reduce the accounts receivable figure, because we're taken care of it under those provisions for bad debts that we provide. Because basically an impairment loss is just a reduction in the value of an asset. Because you can't, since we have already reduced these accounts receivable with the figure of provision for bad debts, then at the end of the day, we are not supposed to be giving it an impairment loss, because we are going to be double deducting. Then the other thing that you will find at advanced financial reporting, the non-current assets that are supposed to be that are sold in the normal course of business. Then we have these financial instruments, or that even assets arising from employee benefits. Those ones we shall look at them when we go to advanced financial management. But even if they come here as items, make sure where there is impairment, you put 0, or we don't subject them to impairment, because other standards have already taken care of them, and we can't double deduct their amounts. Actually, that's basically the precursor what we can have as far as what we did, and as far as cash generating units are concerned. So basically, if at all you have not got it clear, you may try to review the first video we did. It was actually giving the theoretical aspect in regards to the whole standard of impairment, that is IS36. And for now, let's try to look at simulation 7, and we'll see how we can be able to put all the narrations we've been discussing into computations. So let's try to go through the question, and we'll try to see what we can do. I abbreviated this CGU as to mean a cash generating unit. So it says a CGU comprises of the following assets. We have the assets, we have their carrying amounts in millions. I said I didn't put the currency signs on most of my tutorials because people are watching from different locations. So you may use any currency you want, so long as you get the basics. That's very important. We have the buildings at 320, we have the motor vehicle, 40 million, we have plant and machinery, 60 million, we have goodwill, 80 million, we have inventory of 200 million. When you try to get the sum or the total, it is 700 million. The question says, during the year, one of the motor vehicle with a carrying amount of 20 million got involved in an accident and got totally destroyed. An impairment review estimated that the recoverable amount of the CGU, that's the cash generating unit, to be 550 million. Show how that's the required, show how the impairment loss will be allocated to the CGU. And we have also a trial number for October 2021, question 4. You may try to look at it. So let's try to go to Excel and we see what we can do. Basically, we try to add in something on as far as because I'm very sure if we try to do the computations, we'll be able to pick a lot than basing on the theoretical aspects. So let's load an Excel. Excel is okay. But now maybe to analyze, we are seeing that we have carrying amount of 700 million, recoverable amount we have, the recoverable amount we have 550 million, and we are seeing when we try to less that, the 700 minus the 550, we get 150 million. So our impairment loss is going to be 150 million. So we are going to be, my emphasis here is to make sure you know how to allocate the impairment loss, because computing impairment loss is okay. It's mainly what we started with, but my emphasis is on allocation of the impairment loss as far as the cash generating unit is concerned. So let's go to Excel and be able to see what we can do. So we have the carrying amount. Let's try to summarize the information. Carrying amount we have it as carrying amount of the CGU. CGU, I mean this CGU is a cash generating unit. Carrying amount is 700 million. Permit me to use M, not to write the whole of the figures. Then our recoverable amount of the CGU is 550 million. Remember we said whenever you're comparing, whenever you're determining whether the asset has been impaired, you compare the carrying amount and the recoverable amount. But we said the recoverable amount is the higher of the two things, the in use and fair value less cost to sell. But here, our challenge is we can't determine the value in use because we can't clearly estimate the individual cash flows. That's why here they will always give you the amount, but the main emphasis is to show how you can be able to allocate. So now we are seeing that the asset is impaired and the impairment loss is 150 million. It comes after deducting the 700 million, we less 550 million. This will give us 150 million. That's the impairment loss. Actually, these things, as we discussed them, that's how you narrate to them. If you are just computing these figures, you will not be able to score all the maxes. Like the way we've computed this 150 million, you will go ahead and put some writing, at least to explain to someone who doesn't actually understand. You try to explain that the asset is impaired, the CGU is impaired, since the carrying amount is higher than the recoverable amount. Actually, let me put it there so that you be able to follow that the asset, the CGU, I said this is a cash generating unit. The CGU is impaired since the carrying amount is more than the recoverable amount. And you may go ahead to put in something in excess that the impairment, of course, we have already computed the impairment. You say the impairment loss of 150 million will be allowed. Remember this one into the income statement will be allowed as an expense, in the income statement and allocated to the assets in the order actually that very order we discussed above. We said one, we start with the damaged products, damaged or destroyed assets, and the second item we start with next is the goodwill of the CGU, then other assets. Of course, other assets, they allocated other assets on pro rata basis. That's basically what we were supposed to do on pro rata basis. That's what the standard expects us to do. So we can try to put in a small table here and try to analyze the information we have. We are going to put this as we have the assets. When you have the assets, then we are going to be having the carrying amount. Their carrying amount. Then the next one, we are going to be having the impairment loss. Impairment loss. Then we also look at the carrying amount. Now this one is going to be carrying amount after impairment, meaning these are the figures we are going to be taking to our balance sheet. We have assets, we have the buildings, can go in their order. These we have the buildings, have the motor vehicle, we have plant and machinery. Let me call it them PPE. Permit me to use PPE, plant and machinery. Then we have goodwill. Then we have inventory. Of course, the last one is our totals. The carrying amount for building, they gave us 320 million. We're going to be using those, but just know all the figures are in millions. This one is 40, and plant and machinery we have 60, and our inventory is 200 million. When you sum them up, we have 700 million. So we try to look at now the impairment. The impairment loss is now what we are going to be dealing with. If you try to look at this question, when you go back to the question says during the year, one of the motor vehicles with a carrying amount of 20 million got involved into an accident and got totally destroyed. We said we start with those destroyed assets. Now the asset that was destroyed is worth the carrying amount. Remember, we are taking only the carrying amount of the asset. The asset was 20 million. So we may put it in the bracket because we are going to be lessing it from here. It is 20 million. But remember, these assets we had a carrying amount, all of them had a carrying amount of 40 million. Meaning, some of the assets are still there, so we have to add. But what we are going to be adding from here, we will get it from the pro rata basis. Because what will remain here, it means that asset is still okay and is still functioning. So it means the remaining here of 20 million, they are going to be allocated in the pro rata basis because they are going to be okay. Then the second item, of course, we look at the goodwill. The goodwill had 80 million with that 80 million. And this one is supposed to be deducted. So put it in 80 million. So what you have to understand from here is that some of these figures, if you add this one plus this one, those are giving you 100 million. If at all this goodwill was maybe 180 million, it means after deducting this one of 20 million, after deducting this 20 million, offset this. Remember, our impairment is 150 million. If let's say this one was 180, and we have already deducted the 20 million from here, it means we are remaining with 30. If this one was 180, we only take the 130 and we remove the rest. But of course, it is a bit rare for you to be given that question, but I'm just giving you what you have to get. It's not a must that you are supposed to go through all these items. You may find that the impairment they have given you is not much. Maybe the impairment was only 50 million. And after you offset this 20 million, you are remaining with 30. And you come to this one when it is already 80. So you give the balance, and this balance you will take it to the balance sheet. Of course, it will be given this side. And you end there. You ignore this one because you don't have the impairment you are going to be distributing. Hope you have got that. So we said this one is not going to be, so that one we can put a 0 and we put its carrying amount. We can actually transfer its carrying amount, 200 million. We say that one has no problem. We don't subject it to, because we have already dealt with it under IS2. Then, now since we have finished the damages, we've done the goodwill, now we are on this one, the pro rata basis. So the totals we are looking for, now we are looking for totals or the remaining impairment loss. Let's first compute that. Remaining impairment loss, our total impairment is 150 million, less what we've actually used. We've so far used 20 million plus the 80 million. That's what we so far used. This will give us a figure of 50 million. And now this 50 million is going to be our remaining impairment loss. We have also to compute the remaining assets. Now, they are the ones we are computing. Of course, the remaining assets will have a total of, we are adding the buildings, we did not tackle them, they are 320. We add the 20 million that is the balance from this motor vehicle, because we only removed the 20. We are still remaining with the 20 also. Then we also add the PPE, which is 60, and we also add, said inventory, we are not going to include it there. Hope you can be able to understand that we are not putting inventory there because it's not supposed to be subjected to impairment. We have already dealt with it. So those are the ones that are still remaining. So this will give us a total of 400 million. And this 400 million, now we are going to be computing the impairment loss for each item. Maybe this one we may put a table. Maybe you can put a boundary, can put this outside the pink borders. We'll be able to see what we are doing. So we try to look at now the building. Remember, we said these remaining assets, they are going to be treated using pro rata basis. And we say the pro rata basis will get the cost of the building, which is the individual cost, or the individual carrying amount, which is 320. We divide that figure by our total, which is 400 million. Total of the remaining, then we multiply by our remaining impairment loss of 50 million. And this will give us 40 million. And this 40 million is what we are going to be taking to our impairment loss. This one of 40 million, term in regards for buildings, it's going to be 40 million. Meaning if it is 40 million, on this one, we've now, on the 50 we've removed, now we are remaining with only 10. Because this plus this is already 180. Sorry, is 100 million plus this, that's 140. And we are only with that. So we go to the PPE. Need me to use that. PPE. PPE was 60 million divided by the total 400 million. Then we multiply by the figure of the impairment, the remaining impairment loss of 50 million. And give us, this will give us 7.5 million. And this 7.5 million is what we shall take to where there is PPE. This is 7.5 million. Then when you are done with that, then we have also to go to the next item, which is now the motor vehicle. This motor vehicle now is going to be the balance that remained, and that will give us a figure of course, we are remaining now with the 2.5. Because it was 10 million with the 7 million, meaning the 7.5, meaning we are remaining with that. So it is this where we are going to be adding the 2.5. And when you add the 2.5 plus the 20 million, you will be able to get 22.5 million. So now that 22.5 million is what we are going to be using as impairment. So we start lessing this one minus this one minus this. What you will get will be there. When we less 320 minus the 40, we are getting to 80 million. Then the 40 minus the 22.5, we are making the 17.5 million. Then when we go to 60 minus the 7.5, remain with 52.5. The last one, cost goodwill is 0. We are deducting 80 minus 80, that is 0. This will give us a total of 550, which is the recoverable amount which they gave us. So when you add the whole of these, you will be able to get 150 million. And that 150 million was supposed to be deducted since it was the total impairment loss. So when you deduct this 700 minus this, you'll be able to get this 550. So that's actually what they wanted us to do. And they wanted you to be able to show how the distribution is going to be done. Or then this one you can say impairment of a cash generating unit, that is CGU. And that one is done. Maybe to remove these grid lines. Yeah, you'll be able to see everything right there. So that's for now. Then in the next one, we are going to be looking at, actually it will be the one that is closing our impairment of asset, that is IS 36. This will look at the reversal of impairment. What do we mean by impairment? Reversal of impairment is mainly arises in a sense that the asset had a previous impairment loss, but this time around, the asset is not going to be impaired. It's going to be having a gain, or it has been revalued upwards. Meaning revaluing them upwards, it means that now the recoverable amount is higher than the carrying amount. So we have an income. So what will happen is that if the asset had a previous loss, impairment loss, and this time around it is having a gain, then we have a problem there, because we need you to, what the standard says, if the gain is to be there, then gain shouldn't be or shouldn't exceed what the asset or what gain the asset would have had if at all the impairment didn't occur. So those are we are going to get in the previous. So in the next video that's going to be dropping soon, and that's where I want you guys to make sure you focus a lot, because it's a bit tricky and we need to understand it, because it attracts the attention of these examiners, because it gives students a bit of a challenge of how you're going to be recording those figures. But it is very simple, so long as you watch it and complete everything, you try more numbers, then you're good to go. That's basically what I wanted to share for today. Make sure you subscribe, highlight, you can share these videos, you can comment. If there is something you didn't understand, make sure you ask. The WhatsApp numbers, they are there. You can get in touch with me and we'll be able to guide you through. So that's basically what we have for today. Till we meet again. Bye for now. Good evening, viewers. Today we are going to proceed with our series on financial reporting. And last time we had finished the impairment of a cash generating unit. And today now we are going to be looking at our last portion within the IS 36 impairment of assets. And probably this is going to be a reversal of impairment. This is simulation 8. We have, it's a question 8 among our study pack. Someone tried to ask where he was getting these simulations. These are within our study pack. And if you want the whole study pack for financial reporting, just try to check the numbers on the WhatsApp numbers that are down there. You'll be able to get in touch with me so that we can see how we can share this information to each other, so that you can also be able to follow on whatever we are going to be discussing. So before we proceed, we always try to get a precursor of what actually the theoretical aspect in terms of what we are going to be discussing every time we are tackling any item. Today our item in particular is going to be reverse of impairment, and that's going to be our last part within IS 36 standard. So this basically, as we discussed in our first video, we tried to look at this impairment in a sense that the recoverable amount of the asset, we are trying to look at maybe we can take an example. We try to look at a situation where we are going to be having an impairment loss, the asset that was actually impaired in the first place or in the previous year, and let alone we find that this asset is no longer impaired. And basically what that means is that now instead of the carrying amount being more than the recoverable amount, is going to be the other way around, whereby we are going to be having the recoverable amount being higher than the impairment, the carrying amount of the asset at a given date. So that's basically what we try to look at here. And when you try to put more lights on what we actually discussed in our first video, we try to look at that impairment happens when the carrying amount of the asset is higher than the recoverable amount. That's when we are going to be having impairment. So we are now looking at a situation where things are going to happen in the other way around, that the asset that was previously impaired is now going to be having is going to be having a gain or a revaluation gain, which comes in a sense that the recoverable amount of the asset is now going to be higher than the carrying amount of the asset at a specified period of time. I was saying you'll find that the recoverable amount of the asset is now going to be higher than the carrying amount of the asset. What will happen is that if we have the recoverable amount being higher than the carrying amount of the asset, we are now going to be having a gain, which is going to be treated as an income. And in the other sense, we are going to be having the value of the asset being increasing. In other words, if we have the recoverable amount being higher than the carrying amount, it means we are going to increase the value of the asset in the balance sheet. And that increase is going to be introduced in by the gain that we are going to be taking to our other incomes, or the OCI. That's where we take the revaluation gains. So what will happen is that if you are going to be having a reversal, and we've seen what a reversal means, it means that the asset that was previously impaired and this time around is going to be having a gain in the current year. How do we account for that scenario? Are we going to be recording incomes and the other way? Since are we going to be recording incomes, or we are going to be recording expense, because in the first place we incurred an impairment loss? So what will happen is that when this impairment loss happened in the previous year, and that year was closed, but as far as these computations are concerned, we are not supposed to be having these impairment losses. In a normal circumstances, they shouldn't be there. So what we try to look at here is that if at all we get these gains, the revaluation gains, what we do, we first of all recover what we actually charged from our income statement. Because remember, these impairment losses, they are going to be taken to the income statement and they are going to be deducted from the gross profit, which eventually reduces our net profit. So since we reduced our net profit by the impairment loss we got, it means if this year we record a gain of the same asset, we have to go back and try to reduce the figures, or we try to cancel out the figures that we had. So we are saying that when we have a reversal of impairment losses, we technically need to increase the value of the asset, hence recognizing a revaluation gain. And that gain is going to be treated as an income. But what you have to make sure you put into your understanding is that whenever we are increasing the value of the asset, we shouldn't exceed a certain limit. There is a limit that we are supposed not to exceed. And if we try to exceed it, it will give something that is meaningless. So we need to understand, and this is the very important aspect in the standard as far as reversal of impairment is concerned. What you have to understand is that when we have a reversal of impairment should not take the value of the asset above what it would have had if at all the original impairment loss did not occur in the first place. Because if at all we never had impairment, the asset would be having a different figure if at all the impairment loss wasn't there. But so long as this impairment loss is there in the previous period, and you find that in the current period we are experiencing a revaluation gain, what you have to put in mind is that when we are increasing that value of the asset, we shouldn't exceed what that asset would have had if at all the impairment of the impairment loss didn't happen. So what this means is that when you are computing for reverse of impairment, we always take two scenarios. The first scenario, we look at the time when the asset is impaired. We first of all compute the impairment loss that occurred in the previous period. Then the other aspect is that we are supposed to first of all compute the carrying amount of the asset, not taking into consideration the impairment. In other words, we assume that the impairment did not occur for that period. So we try to compute what could be the carrying amount of the asset if at all the impairment loss didn't happen. So we try to look at those figures and we make sure that whenever we are increasing the value of our asset because of having these gains, they shouldn't exceed that value where the asset would be if at all the impairment didn't occur. We are going to try to look at a practical question. That's when you'll be able to make sure you understand everything. And this we are now using what? We are using the simulation 8. So it's a basic one, but it will help us understand what we actually need to do. Because some of these standards or some of these aspects we are discussing, they are the ones that are feeding into the coming standards like the IS1 presentation of financial statements. You find that some of these items, they are feeding in there. They may bring it in an additional information and you don't actually know how to treat it. So it's better you, first of all, understand some of these aspects of different standards, because they are the ones that are going to help you push for these other coming standards as we're going to be seeing there. So we have this simulation 8. We may try to go through it and we see what we can have. We are saying that ABC Limited had a building with a useful life of 20 years and it costs 500 million, meaning the cost of the building was 500 million as of 1st January 2018. They are continuing to say on 31st December 2018, the building had a recoverable amount of 400 million. That was the first scenario. Then they are saying, however, 1 year later, on 31st December 2019, the recoverable amount rose to 510 million. Then the required says sure will be accounted for in 2018 and 2019. So basically, when you try to look at this question and we analyze what we have, the information we have, we are seeing that we have a building which costed the company 500 million on 1st January 2018. They have given us the useful life of the asset of 20 years, and they have also given us the recoverable amount as of 31st December 2018, 400 million. So what, if at all we want to understand some of these things before actually we calculate the number or give the solutions to this question, you may find that at least we have to first pause there and we try to understand what that statement means before actually we go to the next line. They are saying the carrying amount as of 31st December 2018 was 400 million. But the figure they have given us as the cost of the asset was 500 as of 1st January 2018. It means from 1st January 2018 to 31st December 2018, that is 1 year. It means the figures, the recoverable amount they have given us is for the end of the year, but the cost we have is at the beginning of the year, which we actually incurred when you are buying this asset. So what we have to understand from this point is that whenever we are computing impairment of an asset, we first of all look at the carrying amount of the asset at the same date where the revaluation took place. Because now they are telling us that the recoverable amount was as of 31st December 2018. So we need also to calculate the amount of that same asset at the date of 31st December 2018. If at all we are going to get good information or we are going to get good analysis. So what we have to understand is that we've been given the useful life of the asset, we've been given the cost, so we can now determine the depreciation charge that is going to be deducted from the cost, so as to be getting the carrying amount of the asset. So we need to determine the depreciation, and you know how we determine the depreciation by getting the cost, we less the salvage value if it is there, or the scrap value, we divide by the useful life or the estimated useful life of the asset. So those are the things actually we discussed in the first video of this standard, and we try to give even the computation of that, of how we do that. But remember, what you have to understand is that make sure that handling any question, you find out whether it is a depreciable asset or non-depreciable asset. Because if it was a land, then we would assume that the cost of 500 will be the carrying amount as of 31st, because land is not subjected to depreciation because it doesn't have the estimated useful life. So now what I have actually analyzed is that gives us what actually we need to first know in the first place, that the asset was impaired. Because if at all you just mere look at the figures, this one is 500 million, but the other one is 400 million. But we need to compare those figures as at of the same date. But this situation we have as of the whole question, what we are trying to look at here, we are trying to give, what we are trying to give is that we are dealing with the reverse of impairment. And we are saying that when we are reversing an impairment loss, we shouldn't exceed the value of the asset which it would have had if at all the asset wasn't impaired in the first place. So having noticed that we had an impairment loss, even though we have not computed it, but we are sure we are going to be having an impairment loss in the first place, because that's what we are actually trying to prove, and we see how we can be able to reverse it. The continuation says, however, 1 year later, it means if the useful life of the asset was 20 years, and they say 1 year later, it means now they are only remaining 19 years out of the 20 years. But you have to be careful. Don't ever assume that it is always like that. If at all the question had given you the estimated useful life as of 31st December 2019, you go with that, even if it is higher than what they gave you at first. Please note that if at all you are given the life, even say that the estimated life now was 25 years, yet in the first place they told it was 20 years, please go with what they have given you in the question. Because the reason why we have these useful lives, because we are just estimating. Imagine that asset was kept well, was serviced well, and everything was going on. You find that it is going to be lasting longer than the asset that has been just left there, which will maybe collapse even before the estimated useful life of the asset. So what we are trying to bring here is that the estimated useful life may be lower than what actually they have near the start. So don't get confused. What they have given in the question is what you use, even if it is higher or it is lower. Don't ever assume. But here they have told us the estimated useful life. So it's like they have said 1 year later. It means after 1 year. And after 1 year, if the years where they were the years, if 1 year goes off, it means we are remaining with 19. But it's not always the case, so you have to be careful. 1 year later, on 31st December 2019, the recoverable amount rose now to 510. Remember, as of 31st December 2018, the recoverable amount was 400 million. And that is the figure we are going to be taking to the balance sheet as of 31st December 2018, meaning it is going to be our beginning balance as of 1st January 2019. So you have to understand that. So if the recoverable amount moved up to 150 million, what we have also to compute is what is the carrying if the recoverable amount was 400 million. Now what is the carrying amount of the asset from now 31st December 2018 to what? To 31st December 2019. That's basically 1 year, meaning it was 1st January 2018 to 31st December 20. Sorry, this is 2018, this is 2019, then to 2019 also. Meaning it was 1 year. We have also to calculate the carrying amount by taking the recoverable amount, we less the depreciation for that 1 year to be able to get the carrying amount which we are comparing. But they have said whenever we are comparing the carrying amount with the recoverable amount, we should take into consideration that the recoverable amount shouldn't exceed what the asset would have had. In other words, this asset, if you find that if at all the asset was 500 million, and we get what the carrying amount that asset would have had as of 31st December 2019, you find that asset that amount is going to be higher than the carrying amount of that at that date. We are not taking what has been given in the question. We take what we have computed and what we are going to be seeing. I hope that analysis gives you a clear idea of what we are going to be doing. Basically, what we have been narrating is what we are going now to put into action. We'll be able to see what we can do and what we can be able to record as we are accounting for those two transactions. So we said we are going to be taking two scenarios, and we said one of the scenarios we are now going to first consider the impairment of the building as of 2018, because we want to account for 2018. And in 2018, that's when we have the impairment. That's when we had the impairment. So we may try to go into the Excel and be able to see what we can do as far as this question is concerned. So basically, if you open the Excel, and not forgetting that this one we actually agreed that this one is going to be the normal impairment. The normal way we've been doing the impairment is the same way we are going to be handling this question. So I don't expect this one to be a bit tricky for everyone. This is what we've been doing. So the first scenario, we're going to look at two scenarios. Scenario one is going to be around when you are considering impairment of the building. But now it is going to be at what date? We always determine impairment at the end of the year, meaning it is going to be as of 31st December. This is now 2018 for that first year. How are we going to be doing that? We agreed that they have given us the cost we incurred. We had the cost. This is as of 1st January 2018. 1st January 2018, and it was 500 million. But we also have the useful life. Useful life, they have told us it is 20 years. 20 years. So we can use that information that we have. Actually, they have even given us the recoverable amount. The recoverable amount, this now is as of 31st December 2018. And they have given us the value to be 400 million. So now we need to consider the impairment. Try to look at now the carrying amount. Here we are now looking at the carrying amount. The carrying amount as at 31st December 2018. This is now what we are looking for. And we said to get that one, it will be equaling to, this will be equaling to the cost of the asset. We deduct the depreciation for that 1 year. accumulated depreciation for that 1 year. That's how we are going to be getting those figures. Now this is going to be for only 1 year. And our depreciation, we said we can now compute it as at once. It will be 500 million, which is the cost of the asset. Less, can try to put this one in a bracket. We say that this is now going to be 500 million, which is the cost we divide by the useful life of 20 years. The useful life now of 20 years, this will give us a final figure of 475 million. 475 million. That's now going to be our carrying amount as of 31st December 2018. But they have given us the recoverable amount. The recoverable amount was 400 million as of 31st December 2018. So we need to know, is the asset impaired or not? And we said to know whether the asset is impaired, you'll find that the carrying amount of the asset is higher than the recoverable amount. What you can actually get from selling the asset is lower than the carrying amount. The carrying amount, it's more or less the estimated value as of that date. So we'll find that the asset is impaired and we will be getting the impairment loss. The impairment loss now is going to be the difference between 475 million we less the 400 million, which is now, this will give us 75 million, and this is going to be our impairment loss. That is the impairment loss of 75 million. And maybe you can try to put there a double entry. This is going to be deducted from the income statement as an expense. We debit our income statement or profit and loss. Let me use P and L. We treat this one, the loss, as an expense, which is going to be 75 million. And we are going to be crediting the asset for the building, because this asset is now going to be reducing in value, building by 75 million, since the cost of the asset reduced. So that's basically what we will be doing. And now we are going to be saying that subsequently, now which figures are we going to be taking to the balance sheet as of 31st December 2018? We are going to be having that the asset, let me not comment, the asset will be carried at the recoverable, will be carried subsequently. This is subsequent accounting, subsequently, not initially. Subsequent, this carried subsequently at the recoverable amount, and now the recoverable amount is 400 million. So this is now the figure we are going to be taking to the balance sheet as at that date. So now we have now completed the 2018. We've determined the carrying amount of the asset, we've determined the impairment, and you have actually done everything for year 2018. That's the normal thing we've been doing. So now let's try to look at year 2019 and we see what actually happened. This was 2018, so we try to look at now the year 2019, 31st December 2019. Because remember, we are counting for 2 years, 2018 and 2019. Now we are saying, we've seen that in 2019, the recoverable amount of the asset rose to 510. But we also need to determine the carrying amount of the asset as at of the same date, 31st December 2018. Because these figures, it rose to 510 million as of 31st December 2019. So we want to know what is the carrying amount of the asset, of that same asset in 2019. Remember, we said whenever we are computing the carrying amount of the asset in the next year, we use the recoverable amount, because that's going to be the amount that is going to be in the balance sheet. But this recoverable amount of 400 million is the figure that ended the year 31st December 2019. It means it's going to be our opening balance as of the year 1st January 2019. It means This 400 million is the figure we are going to be having at the beginning of the year. So we want to look at what will be the carrying amount of that asset at the end of the year. Meaning we are supposed to deduct the depreciation for that 1 year because it is from 1st January 2019, 31st December 2019. So when we do that, we will get this cost of 400 million, we deduct the depreciation for that year, and we make sure we get the carrying amount. But remember we said that whenever there is a revaluation or whenever there is change of the value of the asset, what we do, we use the recoverable amount to compute the depreciation. Even the useful life of the asset changes. They may either give us a low useful life or a higher, or they maintain the same. So there are 3 options. Be careful on that because that's where students get problems. Because if I told the asset, they give you a different useful life, you use what they had given you initially, you'll be wrong. So we try to look at the carrying amount, and we said we are going to be getting the carrying amount. Now this one is going to be as of 30th. This is now 2019, and this is going to be put by getting the cost, of which the cost will less the accumulated depreciation. Let me say the depreciation for the year, since it is only 1 year. Depreciation for the year, and the cost is, we said, is going to be 400 million. Now here we said here that we are going to be getting the cost or the recoverable amount with less any scrap value, and we determine the remaining useful life. The answer is it is remaining useful life, not estimated useful life, not what they gave you initially. Meaning, if we're going to be 1 year later, it means now the remaining useful life is going to be 19 years because it will be 20 years minus 1 year. So we are going to, since we don't have any salvage value, we take 400 million, we divide that figure by 20 years. These are now 20 years minus 1 year. And what we are going to be getting is going to carrying amount of the asset. If you do the computations and you fill in those figures, you'll find that the value is going to be around 379 million. If at all you try to round off and you round off those figures and be able to get an estimate of 379 million. And this is now going to be our carrying amount as of 31st December 2019. So having got that, then what we have to we are now going to look at the second scenario, because we said in the first scenario we try to look at when the asset is impaired, and we are done. So now the second scenario is going to be when we are not considering the impairment, or we assume that the asset was never impaired at all. Meaning whatever they had given us initially is what we are going to use, and we don't take into consideration the recoverable amount. But remember, we still have our carrying amount we have computed. So now we try to look at the scenario, the second scenario. Scenario 2 is now going to be mainly on assumption. We assuming the asset was not impaired. If now the asset wasn't impaired, and we are computing up to 31st December 2019. Now we want to know what would have been, or what would be the carrying amount as of 31st December 2019 if at all the asset was never impaired. So it means if the asset was bought on 1st January 2018, and we want to know the carrying amount of the asset as of 31st December 2019, it means what we are going to be taking into account is the depreciation for 2 years. That is 1st January 2018 to 31st December 2018, that's 1 year. Then 1st January 2019 to 31st December 2019, those are 2 years. So we are now still have the carrying amount as the figure we are trying to look for. We are now trying to look for the carrying amount of the asset meaning the building. Then this one is be on 31st December 2019. So that's the figure we are now looking for, especially after assuming that there was no impairment of the asset. So what would be that figure? It would be the cost. Of course, it will be equating to the cost of the asset. We deduct the depreciation, or actually this one is now going to be the accumulated depreciation, or the depreciation for 2 years. In other words, we are computing from 1st January 2018 to 31st December 2019. That's the period. So we had the cost from the beginning. We had the cost of 500 million when we bought the asset. 500 million, we deduct, now we compute the depreciation. The depreciation was going to be 500 million. We divide by 20 years, which was the useful life of the asset. But after getting this answer, we multiply this by 2 years. And this will give us a carrying amount of 450 million. Because it's going to be 500 million divided by 20, it will give you 25 million. 25 million will get 50 million. If you deduct 50 million from 500 million, you'll be getting 500. It's 450 million. So that's going to be our carrying amount of the asset. This is the carrying amount that this asset is going to be having if at all the asset wasn't impaired in the first place. So what the standard specifically means is that if we are to increase the value of the asset, it shouldn't exceed the 450 million. But surprisingly, we are seeing in the question that the asset, or the recoverable amount of the asset, rose up to 510. So it means we are going to ignore the figures that are exceeding 450. We will asset up to 450 million. And that is going to be our new recoverable amount. Sorry, that's going to be our new carrying amount. So if at all you try to take the other 510, you will be wrong. So I may put maybe as a point of emphasis, let me try to put figures here. As a point of emphasis, we are saying that the reversal of impairment will be up to the carrying amount. It will be up to the carrying amount of the asset it would have had if it had not been impaired in the first place. So it means even this same figure will be, in other words, it's the recoverable amount. So meaning that this recoverable amount cannot exceed 450 million. And the reason is very simple, because remember we had already deducted this impairment from the value of the asset. It was already deducted. If you try to take the recoverable amount as 510, you will be overstating these figures. So that's the logic that is there. And we now try to look at what figures are we going to be reversing. Now, the reversal of impairment mainly means what figures or which magnitude are we going to be increasing the value of the asset. It will be now 450 as our new recoverable amount. We deduct the carrying amount. Remember, we computed the carrying amount as of 31st December 2019 as 379 million. So when you deduct that, you'll be able to get 71 million. And this 71 million, how is it going to be entered for? We are going to be debiting because we are now increasing the value of we are debiting our assets, our building by the 71 million. Then we are crediting now our profit and loss. And crediting our profit and loss, it means we are going to be adding it to our other incomes after the gross profit. And by adding it, since last year it was deducted as an expense, if you put it under, or if you add it to the gross income, it means you are reducing the other figures that we first got. But it's only going to be reduced by 71 million, meaning the other remaining figure will be left there as an impairment, the 4 million, because it was 75 million, but we are now increasing it up to 71 million. It means even the balance sheet, we are going to be taking the 450 million, because that 450 million is now going to be our new recoverable amount that is going to be appearing in the balance sheet. This is now going to be reversal. This is in the same way we are doing the reversal of revaluation gains, or that if at all you understood that, then this one is probably something that is very easy for you to understand. If you didn't pick it well, make sure you try to go back to our first video. You try to look at that PPE and be able to see what we actually did there. Then maybe conclusively, we can try to see that this asset, the asset is now going to be carried. The asset for the building will now be carried at the new calculated recoverable amount of 450 million. And that's basically what this question wanted us to do. And we could be getting all the marks. But the emphasis here is that you have to make sure that the new recoverable amount shouldn't exceed what the asset would have had if at all the asset wasn't impaired in the first place. If you understand that principle, the rest of the reverse of impairment is something that is easy for you to pick from any complicated number. So that's basically what I wanted to share with you for today. Then that makes, or that ends our discussion on that. Then maybe something small about the IFRS 6 exploration for and evaluation of mineral resources. That one is basically something small. It's just more or less, if you understand the theoretical aspect, the rest of the computation is very easy, because it is just a kind of grouping. You group this and you actually you're just classifying this into the depreciable and non-depreciable, and that's all. So basically, that one I'll handle it, but it's at a later date. Permit me to go to IS 38, that is provisions, contingent liability, and contingent assets. That's something that is a bit wide, and we first handle that one at least, because the other one is very small. It is very easy to understand. You can just read in 30 minutes and you close everything out. But this one, we need to add on what we actually discussed. We discussed the theoretical aspect and all of it was complete. So what you have to understand is that the practicability of what we discussed. Make sure before you start these computations, you make sure you have actually watched these videos, because I make sure at least I first give you what we do in a standard, and I come out to be giving you each and every computation within the standard. And whenever I say the standard is complete, just know everything is complete, and from there you can be able to tackle any number from that standard. So that's basically that for today. IS 37 is our next one as far as computations are concerned, and question papers. Maybe to give you a reference on this one, what you can actually try out, September 2022, the question 3 was there. You check it out and be able to witness what I'm actually giving you, and be able to see that the things we are discussing here are the exact things that you find in the papers. Don't forget to subscribe, share to others, so that these guys can also have a benefit of actually what you have got. If you find something interesting, like the videos, comment, and put even suggestions of how how you can try to improve as far as the we are uploading are concerned, because this is basically for us to learn and we'll be able to improve in our financial reporting and all accounting aspects, finance basically. So thank you for the time and thank you for watching. Endeavor to subscribe, as this won't help us maybe to develop the channel only, but it will also help you to know when we actually drop other videos, because if you don't get those notifications active, you may find that you will miss out. We may upload videos and you actually know when we have added more videos. So it's bye for now, until next time.
Good afternoon, viewers, and today we are going to resume our series on financial reporting, and what we are going to look at today is IS 37, that is provisions, contingent liabilities and contingent assets. Basically, we are going to look at three things. One is a provision, the other one is contingent liability and a contingent asset. And how are we going to be accounting for them? That's also basically important. And before we proceed to the notices we have, one of the things you have to understand is that when we are talking about these provisions, basically I'm going to start with the provision, then later on I go with the contingent one by one, because they are separate and they are more or less correlated. So when I start with the provision, what you have to understand within this provision is that you can take an example. If let's say it is a manufacturing company, and that company, let's say, deals in tinned food, or it is dealing in electronics, and you may find that they have an arrangement with, let's say, the wholesalers, these people who buy items in large numbers. What will happen is that when these wholesalers are buying the goods, they come and they bargain on the price. Most of those items, they are not tested at the point of purchase. So by the time they pack the items and they take them, they deliver to their premises, I'm talking about the wholesalers, these companies, since the buyers, they are not testing those items before they take them, the company or the manufacturing company itself makes some provisions. In other words, it sets aside certain incomes that are going to be incurred maybe in repairing those defects that are going to be discovered by the wholesaler when the person is selling them, or maybe a retailer when they're selling them out. So how do we account for that money we are going to be setting aside, maybe to cater for those repairs, if at all some of the items that were sold have defects or have damages and they are going to be returned to the company for repairs? So a company, what it does, if at all there have been some warranties, you may find that these items are brought back and they do some repairs. So when they are doing repairs, they are of course incurring costs. So before you expect that you are going to be making 100% sales, at least you have to set some money aside to cater for those uncertainties that may arise as when you are processing those items, because not all the products we are going to be manufacturing are going to be coming out. So that's basically how we look at these provisions, and that's how they come into existence. But how do we account for them? How do we know that we have these provisions? Then the other one is, most of the times we've been accounting for bad debts and whatever, but when you're talking about this standard, we are not going to be going into that component. But what we can only pick from that is that a provision is an estimate. It's something that we just assume that it will happen. So even if we have made an assumption, doesn't mean that that assumption is going to be 100% true. But we are going to be the recognition. We are going to see the recognition criteria of how we recognize that at least from this scenario we can make a provision, or we can recognize and call it a provision. If something is not called a provision, then it means it is going to be just a liability. When you're talking about these contingent liabilities, we are talking about the liabilities. There is a possibility for them, these are liabilities or obligations that are going to be coming to the entity. But the logic is, are we sure that those contingent liabilities are going to be existing? Most of the times you find that if they are just one-off item, you find that maybe their percentages is not probable. You can't just make a decision and you say we are going to be having a contingent liability. It is the opposite is the one for the contingent asset. Of course, we are expecting some money to come in, but it's also, yes, we are expecting that maybe if at all we've got a case and we may end up winning the case. So when we win the case, we expect at least to be refunded back some money. So we expect that we are going to be getting something, but it's not probable that we are going to be having such kinds of items. So we are going to be looking at how are we accounting all that for that items. Then maybe the last one is when there is restructuring within the organization. We are changing the way we've been operating. We are maybe closing off some of the branches. How are we going to deal with the employees that have been working there? How are we going to do? Are we going to compensate for the terminations of their contracts? Are we going to make them redundant and they be there, we start incurring redundancy costs? So we have to make a provision if you have to go into the restructuring. But let's first go through these slides and we see what items are included in which item, and we'll be able to account for that. But that's basically an overview of what we are going to be seeing today. If we start by the provisions, according to the standard of IS 37 says that these provisions, they are liabilities of uncertain timing. It is uncertain timing or amount, but not saying it is uncertain timing and amount. No, it is only a situation where one thing can occur at a time. It may be that we don't know the time when those expenses are going to be incurred, or we don't actually know which amount are we going to be incurring for those uncertainties. So it is either of that. It may be we don't know the time or we don't know the amount, but it can't be both. So this is a liability of uncertain timing or amount. That is the definition according to IS 37, and that's basically what we can consider as far as provisions are concerned. So we try to look at what are some of the recognition criteria. How do you tell that we have a provision? One, and this one is very important, there are 3 criteria that we base on to confirm that we are supposed to recognize a provision in our books. And one, we are saying that there is a present obligation of an entity arising from past event. It is a present obligation. Remember, here we are talking about liabilities, meaning it is the company that is going to be spending out money to cater for those uncertainties that may be coming in the future, or whichever amount we are going to be paying. So if it is a present obligation of an entity arising from past event, meaning it is something that we already incurred. Let's say we have supplied the goods, but some of them are defects. The retailers or the wholesalers are going to bring those goods back, and we try to do the repairs, or we exchange and give them the new ones. So if we are saying that these obligations can be legal or constructive, it can't be both. It is either legal or it is a constructive. Something that is legal, it means it is arising out of the laws. It may be out of the law that you have a court case. It may be out of the regulations that it is the regulators who are engaging into the operations. It may be in terms of these contracts these companies are signing with other partners that you are going to be to be doing business with. You may find that we have, let's say, a contract with, let's say, the suppliers of certain items, and there are some legal obligations that may arise as we are doing our work. So we reach at an extent, and we say, if we expect that we are going to be incurring these costs of, let's say, one of the suppliers has taken us to court and we are expected to lose a certain amount, and we are sure that we can be able to pay that amount, then we can be able to recognize, and we say it is arising as a result of the legal practices. And the other one, it is constructive in a way that we are just looking at what are the things that management has done, or what are the things that are within our policies that are maybe arising, or that are causing those costs that we are incurring. Maybe we had an agreement with the, let's say, supplier, and the management agreed that we are going to be giving them maybe discounts, and we fail to honor that. Or we had certain repayment periods that we are violating with maybe the people who have supplied us, let's say, funds and other creditors. So these constructive ideas, they are just constructed by the management, or they are just within the policies. And the other one, it may be even the past actions. It may be the past practices. What have we been doing? Let's say we've been giving employees maybe their Christmas period, and we give them Christmas packages. These employees are going to be expecting that maybe at the end of every year we are receiving something. So you'll find employees are asking that whenever the year is about to end, they will be asking, are we going to be receiving this? Because the company used to do that, so people think that it's going to be there for forever, which means that thing is creating an expectation within the third parties, and it needs to be accounted for. And how are we going to be accounting for it? We are only going to make a provision that during the end of the financial year, or during the Christmas periods, we always give these out. Maybe you may find that the company has been doing some charity work. It has been donating some money to, let's say, certain organizations, and these organizations, they have been receiving that money maybe for the last 10 years. So it becomes a normal practice that even these people, they are going to be expecting for every year, they are going to be expecting that, because that's arising as a result of what the company has been doing for the past years. Maybe the last one we can talk about, maybe if the company has been maybe painting certain buildings, or giving road posters and whatever on maybe the road. On the road, maybe they have been painting the road for certain number of years, and the company is going to be expected that every year it's going to be doing that, because it became a practice that every year the company has been doing that for maybe some good number of years. So those are the items that we are going to be looking at. Even the examinations will be seeing that they will give you scenarios that, let's say, the company has been providing a certain amount of money to a certain foundation for more than 10 years. So this one, you just look at it that it has been there as a result of the management actions. You can say that we are going to be accounting for the provision, because the company has been doing that for the previous years. So that's basically some of the things you are going to be looking at. But make sure you understand this, because this is where most of the questions are going to be coming from. If it is not a legal matter, it is going to be a constructive matter, meaning it will be from the actions of the management, or the policies of the organization, or the practices. So that's basically one of the recognition criteria for recognizing a provision. The other one we can talk about is we are saying the standard says that it's probable that an outflow. Remember, we've been used of talking about it's probable that future economic benefits will float the entity, but this time around it is not an asset, we have a liability, It means that we are expecting a certain amount of money to be going out of the company to settle the obligation. We are saying the standard says it's probable that the outflow of resources from the entity will be required to settle the obligation. Meaning, since it is a liability that is going to be arising, we are not recognizing any income, but rather we are giving out money to settle those obligations. And we are saying, if you are looking at this standard IS 37, we have to understand the word probable. If something is probable, we said in the previous videos, we've been saying that something to be probable, it means it is exceeding 50%. The chances of something to occur exceeds 50%. So you'll find, let's say there's a certain item, it is just a one-off item, they are not a combined item as we are going to be seeing. You find that you will be given a question and it will be having some percentages. That maybe we have a 45% chances of the company winning the case. You may find that lawyers are giving us evidence that according to what is prevailing, we have 45% chances of us winning the case. So it means there we cannot make a provision because it doesn't exceed 50%. So if we have evidence that at least these obligations are going to arise, it means, and that percentage is exceeding 50% for a single item. This percentage doesn't work when the cases are many, or when there are so many things that are being combined at once. It is only for a one-off item. Maybe a customer has taken us to court and we are looking at the chances of us losing the case. Of course, if you are expecting to lose and the chances are more than 50%, we make a provision for that, so that by the time it happens, we have already catered for it. So that's basically what we are talking about, that it is probable that an outflow of resources from the entity will be required to settle the obligation. The last criteria for recognizing a provision is that we are saying that a reliable estimate of the amount of the obligations can be made. Remember, here we said that these obligations, these provisions we are giving out, they are just estimates. We are just making an estimate of what may happen. So we have to be also very keen about whether we can be able to determine the amount. If at all you can't determine the amount, then you can't recognize that as a provision, because which figure are you going to be recording in the financials? Remember, when you are preparing these financial statements, we put in the monetary values. So if you don't have the figures, we can't recognize this as a provision. So we are supposed to be able to determine these estimates and we can be able to quantify them. When we go to the next slide, it's all about the measurement. How, after knowing that after recognizing that the provision is there, which figures are we going to assigning to, how much are we going to be assigning to them when we are taking them to our financials? That's basically what we are going to be looking at under measurement. Saying measurement of provisions, and you are saying that these provisions, they are measured at the best estimate of the expenditures required to settle the obligation. We use the best estimate. How do we determine these best estimates? It depends whether it is a one-off item or it is a large population. Of course, when it is a large population, meaning there are so many cases, this person is suing us, the other one is suing us, the cases are many. So when the cases are many, we don't consider the percentages. And we are saying if a provision involves a large population, then the amount will be determined by weighting. This word is not weighing. We are not weighing, but we are weighting. We are weighting, or we are summing up. We are summing up all the possible outcomes. And remember, you know how to compute the expected values using your tutoring knowledge or qualitative techniques. There is where you do you get the probability, you multiply by the possible expenditure or the possible outcome. You get the percentage, the chances of something to occur multiplied by the expenditure. Then we keep summing up for each. If let's say we have so many people that are suing the company in case of maybe our contracts we've been dealing with them, you get the chance. Of course, they are supposed to give you the chances of something to occur. They give you the percentage, you multiply by the expenditure. If that happens, how much are we going to be paying? Those two are supposed to be given. So you'll be getting the summation of all those possible outcomes of the transaction. And here we have a simulation. We can maybe try to look at this, and we are saying P2 Limited sells goods with a warranty where customers are covered for the costs of repair of any manufacturing defects. The company's past experience and future expectations indicate the following. We have the patterns, the pattern of the likely occurrence of these repairs. We have the percentage of goods sold, we have the defects, and we have the cost of repairing, if at all those defects happen. We have a 75% of something to occur, of the defects to occur, and we have 75% we have none, meaning even the cost is 0. Then 20% they are going to be having minor defects, and if all happens, it means we are going to be paying 40 million. Then 5% of the major, they are going to be having major defects, and if that happens, it means we are going to be paying 160 million. Then they say determine the provision. Of course, to determine the provision, we said we sum up the possible outcomes. How do we get these possible outcomes? We get the percentages of the goods, we multiply by the figure we are going to be incurring if at all that happens. It means it will be 75% times 0 plus 20% times 40 million, then 5% times 160 million, and that will give us, if you sum up all, you'll be getting 16 million. It means that will be our provision. How are we going to account to enter those that have got of 16 million? We are going to credit provision for repairs. Of course, we debit the profit and loss because it is going to be as a liability or as an expense we are likely to incur. So that's basically how we treat that. If it is a large population, population, we don't consider these percentages. You may find that this one we've been saying that the percentage of something to occur must be exceeding 50%, but here we are considering 5%. This one we said if it is a larger population, we don't consider the percentages. We only consider these percentages when it's a one-off item. Maybe they have given you, whereby the company has been dragged to court and they are required to pay maybe 10 million. But they go ahead and give you the percent that maybe there is a 40% chance of the company losing the what? If at all it is like that, then if it exceeds 50%, you say we recognize a provision. If it doesn't exceed 50%, then it means we are not going to recognize it. But the question will be, how will you treat that? If it is 40%, are you going to just leave it and say, here I do nothing and you expect to get marks? Then we are going to be seeing how do we treat that if at all it doesn't qualify to be a provision. If it doesn't qualify to be a provision, it means it is a contingent liability, and we shall see how we account for those items. Maybe to proceed, we can try to look at provisions for decommissioning. This decommissioning is most of the times is in the mining and oil refinery. You may find that let's say a given company, a mining company, has been given a contract, or it has been allocated a mining site where it is to carry out its mining activities. Of course, they go through their exploration and all that to find whether the site they have been them is going to be profitable. Of course, if you don't do that and you just keep mining from anywhere you want, of course, when they are doing mining, they have to first you have to first do the exploration, and you find out whether the contract area you are going to be beneficial, depending on the number of minerals you've seen that are there. So what will happen is that their costs will incur in the future when we have finished carrying mining, and we have maybe constructed certain buildings that are going to be used in our mining activities. So at the end of the project, we have to remove everything, dismantling and recovering the surface to the extent that we found before we started our mining. So all that cost that we are going to incur in the future is going to be accounted for as a provision. But which figures are we going to be recording? Because those figures are going to be future, it means that those figures are going to be discounted and we get their present worth now, so that we can be able to incorporate them in our financials. That's basically how we look at the decommissioning or the dismantling and restoration of sites. That one we are going to look at when we look at the IFRS 6, which does on the exploration and all that are related to the mining and all that. But what we have to know is that costs of dismantling and restoration of sites at the end of the useful life of the project, they are going to be discounted and we get their present worth, so that we can be able to incorporate them in our financial statements. So maybe some students may be asking, why are we recording these decommissioning? Why are we giving the decommissioning as a provision? Because it will happen by all means. If you start the project and you accept, you get that contract area and you start your mining, we are going to incur them. So it's like we are going to incur them so long as we start the operation. The operation like this, it means we are going to be incurring them. So we better provide for them, so that by the time we incur them, we have already accounted for them. So that's how basically we do that. The provision for this commissioning, maybe to get some theoretical aspect, we are saying that this is where an entity acquires a non-current asset and has an obligation to dismantle the asset or the site at the end of the useful life. And we are saying that the cost to be incurred in the future will be discounted to their present worth. That's what I've been talking about. We know how to calculate the present value of a given future amount of money by using our discounting factors. We did that when we are doing IS 16, that is PPE, because of course we looked at some of those costs that we are going to be incurring in the future. We looked at them. Maybe to look at something different and get more light on the standard, let's try to look at the contingent liabilities. We are saying that these contingent liabilities, we said they are possible or potential obligations that may arise in the future. That may arise, but their occurrence, we are not sure whether they are going to occur or not. Meaning that the percentage, if it is a one-off item, the percentage of it to occur is less than 50. If it is less than 50, then how are we going to be treating it? Then maybe we can look at how do we recognize these contingent liabilities in our financials. But we are saying that obligations whose existence will be confirmed by the occurrence or non-occurrence of an uncertain future event not within the control of the organization. Of course, we are expecting that by the time maybe if a certain third takes to court, you find that lawyers can tell and give us an evidence that maybe this one will have a 50% of winning it. If it is a 50%, 50 or 51, then we say that would be treated as a provision, because we already have chances of losing the money. But maybe the lawyers say that we are going to be having a 30% chances of winning that case, then we can record that as a contingent liability. meaning 30% we are likely not to incur anything. But since we have that possibility of something to occur, then we make sure at least we recognize it. But how do we account for that? Maybe before we go that, we can try to complete these small notes, and we are saying that the contingent liabilities are not recognized in the balance sheet. The reason why we don't, because most of the questions are going to rotating on these theoretical aspects, and they are very important, very unique. The reason why we don't recognize these contingent liabilities is that they don't meet the recognition criteria. We spoke about the recognition criteria, something being probable, and we said it must be above 50%. So if it is less than 50%, then it is not recognized as a provision. So the reason why we don't recognize the contingent liabilities in our balance sheets. And we can talk about their cost, we can't even determine them reliably. And that's one of the recognition criteria for the provisions. So what you have to understand is that if something is not a provision, then it will be either a contingent liability or a contingent asset. A contingent liability and a contingent asset, they are all accounted in the same at the same time. Because when you look at as taken to court and the percentage of the company losing the case is 40%, it means it is already less than 50%. It is going to be treated as a contingent liability. But at the end of the day, the company is going to receive the money, because after losing the case, that person is supposed to pay back the company all the costs we incurred if the court says otherwise. And maybe the court may say that let everyone share their individual costs, or they bear, one should pay. But if the court says the other one is supposed to pay the other one for the money that was involved within the process, then you find that you are receiving some income. That's what we call an asset. But it is also an asset, but we are not supposed to record it because we are not sure that we are going to get that money, since the percentage is less. So if you are not going to record them, where do we put them? The accounting treatment for contingent liabilities is that we just disclose them in the notes. Maybe this is something new you didn't see from your financial accounting, but when you are preparing financial statements, we put some after the financials, put some notices, and these notices have items that are needed by the users of those accounting information, those who are interested in our financials. But these items, they are not supposed to be incorporated into our financials. And one of them we looked at in the last standard, we said we had the disclosures of government assistance. We said something, if it cannot be quantified, disclose it we just disclose it. And where do we disclose these items? We disclose them in the notices. We say that we received this and this and this from the government, but it can't be quantified. At least to make these users know that in the future something may happen. Of course, when you say, the best way you can quote this, you can say that we have someone who has taken us to court, but the lawyers are saying that the percentage of us losing the case are less than 30%. Meaning that these users of the accounting information, they have to be understanding that at least in the future, if something happens, they already knew in the notes when they read those financials. So what are some of the things that we are supposed to disclose as far as contingent assets and contingent liabilities are concerned? Of course, they are the same. All of them, we disclose them in the notices. And we are saying we have the nature of the contingent liability. You say if it is a court case, we say the nature is it may be a constructive idea or it is a legal matter. Then you talk about the financial impact of the liability. If it is an asset, how much do you expect to get? If it is a liability, how much do you expect to give out? Then you talk about even the uncertainty itself. It was about what? The person took it what? That's basically what you are supposed to be showing in these notices as far as contingent liabilities and contingent assets are concerned. And that's when that is done, it gives a good impression to these who are reading that maybe if something happens in the future, they are already informed. So by the time, because you know those users of accounting information, they see that information for many things. Others may use the information to find out whether they can be able to invest in the company. So if they don't know some things, they may also take you to court, and you again start bringing other costs. So you disclose everything there. That's why these companies, they are required to publish their books of accounts, especially those which are listed on the stock exchange. So I hope I have explained the contingent liability and the contingent asset. I'm not going to go into that. Maybe to look at something small here, it's all about the degree of certainty and some categories that we can maybe talk about, saying that if it is 10%, the degree of the occurrence of a one-off item to occur. If it is 10%, then we recognize an asset, we recognize a contingent asset or a contingent liability. But if the percentage is more than 50% to 99%, we recognize a provision. About that the provision is probable that percentage is more than 50%. So if it is 50 to 99%, we recognize a provision. Then if it is below 50%, but it is also less than remote, maybe it is below 50 but it is again less than 5%, then we disclose a contingent asset or liability. But of course, if you try to look at there are some scenarios that you may find that something may be to occur, it is about, let's say, 45% or 48%. At least that one is near to 50. That's why here we are putting the 10% and we say we recognize an asset or a liability, because at least that one it is, but that is above 10%. Hope you can be able to use that information well. Maybe the last bit we can talk about under this standard IS 37 is basically the provision for reconstructuring. Here we are trying to look at, when you're talking about restructuring, you find people thinking about losing their jobs and all that. But basically this is a bit broad. It exceeds to that. And here we are talking about the restructuring. You may find there are also certain items that are covered within the standard, and there are others which are out of the standard. Maybe to talk about the ones that are out of the standard, we may talk about if, let's say, the company is developing a new idea. If the company is just developing or is just adapting a new system and they are replacing all the old systems they had, that one we can't call it a restructuring. If maybe these employees, they have been maybe relocated, someone has been in Ginger and has been maybe transferred to a certain division somewhere. You may find that someone has been working, let's say maybe East Africa, it's an international organization, now they are taking maybe to West or whatever. So those are not part of the restructuring, because we recognize that and we assume that the business, it is still a going concern. But when you are talking about restructuring, something, it is ceasing to exist or it stops to exist. One of the things we can talk about is maybe we are closing a division. We had a branch, maybe it was an international organization and it had a branch, let's say in East Africa, and it was not performing. Or maybe it had a branch in Uganda, but the Ugandan branch is not performing. They can organize and they say, you know what, according to the performance of this organization for these years, we are going to close it. So when they are closing it, there are certain costs that we are supposed to incur. Because if you are closing a branch in Uganda, What about the people who have been working there? Are you going to make them redundant and you start incurring redundancy costs? Because they will be there, they are not working, but you are paying them. Or you are going to terminate their contract and make sure you pay the termination benefits. Even closure costs themselves. You may find that to close a company which has already started, you do something, you incur certain costs. So those are the things, some of the things we may talk about. The other one you may look at, let's say a company that does maybe different or produces more products. Maybe I can talk about Coca-Cola. It produces Coke, it produces the one without sugar, but you find that even sugar is more. Then they produce even, let's say, Minute Maid and all that. And you find that maybe they are seeing the product of Coca-Cola and the one for the one without sugar, they are more or less the same, and they try to remove one of the product and they say, let's maintain this. So if you are doing that, then what are the people who have been involved in that product which had no sugar and you are removing it? So that's basically what are the things. How are we going to account for those costs that we are going to incur as a result of closing? If at all maybe the company has been sold, you may not even close, and they may say that no, this Ugandan branch has not been performing, but let's sell it off. Of course, when you sell a company, you may find that some of the employees are going to lose their jobs because the other person who is coming with different ideas. He may even change the products. Of course, when they change the product and you don't know what they are doing, you go out. Those are basically some of the things that we can look at when we are talking about restructuring. Not all about losing jobs, but there are other costs that we incur other than the termination of the employees. Then, having looked at that, remember we said some of these provisions, we incur them, either those costs are going to come as a result of legal actions or they are going to come as a constructive ideas. So these are just going to be the constructive matters, because it is the management that decides on what is supposed to be terminated and what is not going to be terminated. So that's why I was emphasizing that you make sure you understand if it is a legal matter, you understand it, and you find where do you get the evidence to confirm these percentages. Then if it is a provision for restructuring, of course there are conditions that are attached, or there are recognition criteria that we have for us to recognize a provision. We said we can't recognize it if the company is just relocating employees. The one who've been the ones who have been working, let's say in Uganda, they have been transferred maybe to work in Kenya. That one we don't. It's a going concern. If maybe they are developing a new product and they are changing, maybe they are just updating the system, there we don't call it. So hope you can be able. If there are marketing costs, there are marketing costs you incur, and someone may think that they are going to be about restructuring. Of course, you may find that maybe the company wanted to maintain the name and is giving maybe a certain building that was constructed or it was having a branch, and the branch is now put somewhere, but they are giving out the building to, let's say, maybe to the government, because they wanted to regain their status in the market. So those are not supposed to be part. So what are some of the recognition criteria that we look at, that whenever you see them, you just know that this is actually leading to the person, to the accountant to be able to make a provision? One, we are saying that there must be a detailed formal plan for restructuring. It is going to be detailed. The standard says it is a detailed formal plan. So if it is detailed, what are some of the items that are going to be there? First of all, we have to know the parties that are going to be affected. If you are closing up a branch, let's say a Ugandan branch, what are the people who are going to be affected? You let them know. Then secondly, the likely expenditures. How much are we going to be incurring? The total expenditure we are going to incur as a result of closing this branch. In terms of terminating employees, making them redundant. Of course, when you're terminating, you know it is coming with the costs. Then you have also to specify the locations that are going to be affected. That's what we call a detailed plan according to the standard. Don't add in your words. Then the other one, of course, we have to communicate to the parties that are going to be affected. Maybe the employees that are going to be affected. Then the last one, we can look at the evidence of commencement of the restructuring process. If you are selling an operation, then we have to at least to be seeing the sales agreement. If maybe you are saying you are restructuring, you are removing the branch, let's not talk about that you are removing the branch because you want to, because by default, if you say you are closing the branch and employees leave, at the end of the day we see you operating there. It doesn't make sense. If you are closing, then we make sure that there is a commencement of restructuring. It is detailed and there is effective date when it's supposed to, and when that effective date reaches, something ceases to happen. Then maybe we can talk about if at all there is a sale of an operation, someone is selling. You know, when someone is selling, when you are selling a company, some of the employees may remain there. Not all are going to be terminated. The standard talks about some of it, gives some lights about the sale of an operation, and we are saying that a provision is recognized when there is a binding sales agreement signed by the parties. You may say that we are going to sell this company. At the end of the day, you wanted people to leave and they disappear. When they disappear, the company still continues. Doesn't make sense. But the standard says if it is a sale, then we are supposed to be seeing the sales agreement. Then we are giving a note for the provision for restructuring. We are saying that a provision for restructuring is not made for the following costs, since it relates to ongoing activities of the entity. One, we are saying relocation or retraining of the current employees. Then the other one, we are talking about the marketing costs. Maybe the last one, we can talk about investment in the new system. If at all you are just developing a new system, we can't call it a provision for restructuring. So that's basically what the standard says, and it brings to our conclusion of the standard. Maybe to look at a trial number. It is December 2019, question 5B. You can try to look at that and we see what we can be able to get from that. But that's basically the IS 38 provision for provisions, contingent liabilities and contingent assets. That's basically what we can talk about as far as the standard is concerned.
Good evening, viewers. It is your tutor, CPA ACCA, and today we are going to look at the new standard. Of course, in our previous videos, we made sure we finalized the standard that we started on, which was a bit wide, but we tried to finish it up. That was impairment of assets. And today we are going to look at some of the computations that are within IS 36, that is provisions, contingent liabilities, and contingent assets. Basically, it talks about three items. We have the provisions, we have the contingent liabilities, and at the same time we have contingent assets. As we discussed in our first video about IS 36, we first of all need to be careful with this standard because it attracts the attention of the examiner. You find that most of these items, it looks to be a bit theoretical, but some of the things are asked, and this calls for more attention whenever we are dealing with this standard. We'll be able to pick some of the basic information that we may need that can help us to solve whatever challenging question we may be facing in our different examinations. This standard IS 36, it has some kind of it is more of theory, of which that theory seems to be a bit technical. So you have to watch the first video of this standard if at all you are to benefit into the aspect of the things we are going to be looking at in this question we are going to be taking, and it's going to be from June 2016. It is question 5. If you try to look at that question 5, it was carrying 20 marks, which gives a more attention on this standard because we find that it can come as a single number which carries 20 marks. So it's a kind of something you need to understand and be able to look at some of the technicalities that have been used within the standard. When you went through these first, or the one I call the theoretical aspect of the standard, we looked at what is needed for someone to do this number on IS-36, what the standard requires to do, what are the things, how are they defined. Those are basically the things we spoke about in our first video about IS-37, provisions, contingent liabilities, and contingent assets. Basically, today maybe to give you just a highlight of what we discussed in the previous video. On this IS-36, we try to look at what are provisions. If someone says these are provisions, how do we normally tell someone has a provision? And we looked at that in the aspect of the recognition criteria. We saw what conditions that are supposed to be met for us to recognize that we are going to be having a provision. Then the other aspect, we try to look at the measurement of provisions, and we had some criteria or some aspects that we gave out as far as the standard is concerned. We try to look at the 50% chances, something being probable, and we confirmed how a large population, how that can be calculated as far as creating for provisions are concerned. Then the last bit of the provision, last but not the least, because we have provision for decommissioning, and this is mainly with non-current assets. These companies who are getting these contracts, maybe they are engaged in oil or mining, oil and gas, mining and other construction activities. You may find that they have a contract, but they are required maybe to set up some of the buildings that will let alone be removed when the project or when the contract ends. Then maybe the last part of the provision, we try to look at the provision for restructuring, but that one we dealt with it at last because it has some aspects that are a bit different from what we actually need to first understand. So that's how I tried to explain it. We looked at the contingent liabilities, looked at the contingent assets, how are they going to be accounted for, and what are some of the disclosure requirements that are there as far as those contingent liabilities and contingent assets are concerned. So those are basically the items that we looked at, but my emphasis for today, maybe we can try to look at I also gave a table which was giving us the degree of certainty, the likelihood of something to occur. Because whenever you are giving a provision is more or less an estimate. It is something you estimate. It may occur or it may not. So we try to look at the degree of certainty, and we try to look at what are items that we recognize at different percentages or at different rates. We try to look at a situation where we have 100% certain, we are 100% sure something is going to happen. There we recognize an asset or we recognize a liability, because now from there we are very sure. A liability may be in terms of maybe the company is going to be paying out some money. If it is going to be maybe it's going to be coming in as an income. So basically you try to recognize if it is you are 100% sure that something is going to happen, then we expect if it is the company receiving out, then we are going to record that as an asset, because we are going to be expecting to receive certain amount of money. Then we try to look at if maybe the companies they want to pay out and it is 100% sure that you are going to incur those costs, then we try to recognize the liability. Then we try to look at the percentages being 50% to 99% degree of certainty. We said from there that we recognize a provision. If we are 100% sure, we said we recognize an asset or a liability. If we are 15% to 99% certain, then we are supposed to recognize a provision. Provision, especially for one-off items, those items that are not combined together. If it is just one item, then we can be able to look at 50%. If something is exceeding 50%, we say it's now being probable. So we can recognize a provision from there. But there is a scenario whereby the percentages are not reaching 50, they are below 50%, but they are also less than remote. Less than remote means something that is a bit immaterial, something that you can't, that even if you don't consider it, they will not have a much impact, or they will not cause a change in our financial statements. Of course, something being immaterial, it means something, even if whether included or excluded, cannot cause a reasonable change that will make sure that they are going to be disorganizing our financial statements. Of course, making a reasonable change will mean if maybe that figure is included, it is going to be maybe to change our financial statements from being profitable to something that is in a loss, or it is going to change something from a loss to a profit. So that's basically how we try to look at some of these aspects as far as materiality is concerned. Then we have also a remote. That's what we call something that is immaterial, something that is insufficient or insignificant. You can't, that even if you exclude it, it will not cause much, it will not show a much impact on the financial statements that you are preparing. So that one, we don't even disclose, but something below 50%, but less than remote. And the remote, we may take it maybe at 55%, some below 50, but again, not less than 5%. We recognize a contingent asset or a contingent liability. So if you want to understand some of these terminologies, the way we analyze them, you try to check our first video on this standard. You'll be able to understand each and every item that we spoke of. But make sure, as I have given you the highlights of the key terms that at least you are supposed to have, if I told you to do a number is 37. That's probably what I can give you as a precursor of what we actually discussed. So let's go to our question and we see what we can do according to what the question wants us to do. We said we are going to be picking the question from June 2016, and it's going to be question 5. So we can rush to question 5 and we see what is there. There we go. Question is there. Question says IS 37 provisions, contingent liabilities and contingent assets aims to ensure that appropriate recognition criteria and measurement bases are applied to provide to provisions, contingent liabilities, and contingent assets. And the sufficiency information is disclosed in the notes to financial statements to enable users understand their nature, timing, and the amount. So that's basically what we are trying to look at here. We try to analyze this question and be able to pick the items that we can be able to use as far as solving the question is concerned. But what you have to understand in this standard, as I said at the beginning, that this standard is more or less a theoretical standard. But those theoretical aspects that are within the standards, they are very technical in a sense that if you don't understand them, you won't be able to apply to a given scenario, because most of these is going to be about a given scenario, and they may be giving you different percentages to determine whether you are going to be recognizing a provision or you are going to be recognizing a contingent liability. Or so we can try to go through this question. But if you see this question, we have the required. They have given us a highlight of what the standard says. That was the first paragraph. But we have the required, which is something that we need. The required says, for each of the following scenarios, explain how the transactions should be treated, giving reasons and identifying the relevant disclosures that should be made in the financial statements in accordance with IAS 37 provisions, contingent liability and contingent assets. Basically, they have given us the scenarios. We have scenario A, we have scenario B, have the last scenario, scenario C. Each has its own marks. What that means is that when we are answering this question, we shouldn't pile up each scenario into the other. What we have to do, since the marks were allocated for different scenarios, we handle case by case, meaning for part A, we handle it separately when we are giving the solutions. Part B the same, and part C the same way, because they have different items and they have their own marks that have been allocated there. So, as we said, they have given us 3 scenarios. We have A, B, and C. So they want us to explain how we are going to account for the transactions. Secondly, we give reasons. And thirdly, we give the relevant. That word is very important, relevant. Not what you think should be a point. It's something that is relevant to the standard they have given us. So they are telling us we put different relevant disclosures that should be made in the notes to financial statements. What you have to understand is that within this standard, as we discussed in our first video, we looked at some of the items that are supposed to be recorded into our financial statements. And our financial statements, I mean the statement of profit and loss and other comprehensive income, the statement of cash flows, then the last one is the balance sheet, or what we call the statement of financial position. And those are basically the financial statements that are supposed to be dealt with, as well as some of the different aspects that we are going to be doing concerned. So as I said, we have to handle case by case. Start with Roman A, or the part A that has our first scenario. They are saying X, Y, Z Limited gives warranties at the time of sale to customers of its products. They are continuing to say that under the terms of the sale contracts, XYZ Limited undertakes to refund customers for the cost of repairs of any manufacturing defects which becomes apparent within the first 6 months of purchase. They are continuing to say that for the period ended 31st March 2016, XY Limited sold equipment for shillings 100 million. By the end of the period, there was a 40% probability of defects. And that's our first scenario. It is allocated 6 marks, and that's what they want us to. First of all, we explain how this is going to be accounted for. Secondly, we give reasons why is it going to be accounted for into that. Then we identify relevant disclosures if they are there. So when we have gone through this, we can see that XYZ Limited did actually, they sold an equipment for 100 million by the end of the period, and that period was 31st March 2016. If the period, if it must have started in April, 1st April 2016, so it's now, sorry, 1st April 2015, then it is ending 31st March 2016. But what we have to look at here is that the probability of defects is 40%, meaning this company has some warranty arrangement with their customers. And the warranty arrangement is basically they try to give refunds or they provide repairs for some of those items that are having defects, if at all customers have actually bought them within the first 6 months, meaning the warranty was for 6 months. If someone buys an item within that period and that person finds maybe the asset is not functioning well, they may bring it back. The company may decide to repair and the customer takes back, or they exchange the product to the customer. But in this scenario, they were repairing those items for the customers to take them, but it was within 6 months. So the biggest now question we have here is that what are we going to be looking at here? Are we on the side of provisions? Are we on the side of contingent assets or contingent liabilities? And basically, if you try to go through the question, we are seeing that the company is providing repairs, which is going to be a provision. Here now we are trying to look at, is there any possibility of having a provision? So what this scenario calls for is that you have to go through what the theoretical or the standard says as far as the theoretical aspects are concerned, and you try to compare the items. What, according to the scenario we have, is there any criteria or is there any element that may lead for someone to recognize a provision, and that calls for you to try and look at the recognition criteria? We said in one of the recognition criteria, we said there is a present obligation of the entity arising from past event, and we try to look at some of these obligations, and we say the obligations may be legal or may be constructed. And constructed, we try to look at maybe past experience, management issues, and all of that. Then we try to look at even the legal aspect. The other item, we said it is probable that an outflow of resources from the entity will be required to settle the obligation. Something we again explain that something to be probable, it should be exceeding 50%, meaning that the chances of something to occur, they are at least in a balance. They may occur or they may not occur, but at least something is more than 50%. Of course, if it is more than 50%, if maybe the percentage is 60%, 51%, you can confirm that at least something is likely to occur. And from there, you can be able to recognize a provision. Then the other item, we said that even this estimate, a reliable estimate of the expenditure or the amount of the obligation. Remember, we said these provisions are going to be estimates. We estimate what we may incur in the future as far as the situation at hand is concerned. Because here we are trying to look at, if you try to look at the recognition criteria for someone to say that I have a provision, or I should make a provision. In this sense, when you try to go through the question, you are saying that one of the things we can first of all identify from the scenario is that we have a one-off item. The company sold an equipment, which is a single item. Then the other item is that we said in the recognition criteria that something to be probable, it should be exceeding 50%. So when you try to look into this question, it gives us a percentage of 40% probability of defects. It means it's not probable. That one meaning this, it has not passed what? The first criteria. It's not probable that we are going to be incurring or we are going to be having defects. So having seen that it is not meeting those the items or the recognition criteria that we follow, then we should be able to determine, maybe you can also add the other aspect, is that do we actually have the amount of repairs or the cost of repair that they are going to be incurring for those assets that they have actually sold. We are not seeing even any figures, meaning we can't make a reliable estimate of the provision for repairs or repairment of those equipments that are due to manufacturing defects. So it means this item doesn't actually meet the recognition criteria for provisions. So the question is, if it doesn't meet the recognition criteria for provisions, then where are we going to be accounting for this item as far as the other items are concerned, or the other aspects of the standard are concerned? Remember, they have given us a guiding tool that we are supposed to give all our figures in accordance with what IS 37 says. So we are looking at this one, the percentage, since the percentage is below 50%, then we should not recognize a provision. But now that brings us to something, or it gives us a question that if you are not going to be recognizing a provision, then what are we going to be recognizing? And we said if something is not going to be recognized as a provision, we gave that item where we actually discussed and we said, let's try to look at the percentages. It's below 50%, but it is not actually less than remote, or it's not less than 5%. It means here we are going to be recognizing a contingent liability. The reason why we are going to be recognizing a contingent liability is that the percentage of 40%, if at all it had met the criteria for provision, the company would have lost money to pay for repairs. Since it is the company going to be spending out the money, it means it was going to be bringing a liability to the company. So since money was going out, then we are supposed to be recognizing a contingent liability. And we actually said that these contingent liabilities, for them, they don't actually supposed to be taken to our financial statements. They are supposed to be disclosed in the notes to financial statements. Those ones we shall see most of the items that are supposed to be presented in the notes, because this is something that is different from actually what you did in financial accounting level 1, because these notes, they were not there. And the reason why we are giving these notes is that we are giving we are disclosing, or we are trying to bring that information to be known to these users so that they can be able to know that however much the company is making profits, but it has some contingent liabilities that if at all at one time T happens that we are supposed to pay the money, you at least are aware because it has been disclosed in the notices to the financial statements. So For us now to be able to get these 6 marks, we need to show how to account for that for the transaction. We indicate or we try to identify, to justify. We justify and we also give the relevant disclosures. Remember, when you are just going to be disclosing, we said that a contingent liability is not supposed to be taken to the financial statement. But even when you're disclosing it, there are certain aspects that we need to see from that when we are disclosing. One of the items we said the nature of the contingent liability. What is it, a court case? Is it a case that is arising out of the contracts that the company signed? Is it something that is related maybe to different suppliers that the business has? Then the other item we try to look at their financial impact. If at all that happens, how much are we going to be paying in order to offset that liability? The last part of it, of course, we try to look at the uncertainties that are surrounding it. How justifiable is it? Because if let's say they are saying 40% of chances for the defects to occur, maybe we can confirm that maybe the technicians from the factory, they have confirmed that according to what maybe they are the historical figures that what they were manufacturing, they don't expect losses. Of course, that's a justification that at least this contingent, the way we are writing it, it may not materialize in the future because we've gotten some expertise that have given us confidence that what or the percentage they have given us is actually something that we can base on to do other decisions as they may come in. So that's basically what we can get from this scenario A. You see that one scenario can take even 30 minutes just explaining what is supposed to be included within. But what you have to understand is that some of these items, when you try to look at them, they are in the sense that whenever you are writing them, you don't need to be too word and you explain everything the way I have been explaining, because what I'm doing now is to throw more lights so that when you get questions that are, they may not be the same, but they are going to be related to actually what we are discussing. Be able to do them in the shortest period of time. So we can go to our Excel and we first sort that one. But with the good thing, we know which items are we going to be incorporating. And this is actually the same question. So we can try to see what you can do from here. So we have a scenario one. Scenario one, it's about the provision. We say we are no longer going to provide. So the solution, the solution would be, we would say that XYZ Limited should not make a provision, for repairs since it's not probable that the company will be giving out resources. You may call them outflow, because the probability is less than 50%. I add something small. Then the entity or XYZ, the entity will disclose, because we said if you're not going to be recording a provision, then we should disclose these figures in our not financial statements. We'll disclose a contingent liability in the notes. The note says the financial statements. And now, since they have given us the figures, of course, we may put even the figures. Of course, the amount you are going to be disclosing is going to be it's going to be 40 million, and it's going to be gotten from 40 million, the way we get this 40 million is by getting the 40%, which is the percentage they have given us, multiply by the cost. We assume this value is going to be out of the total value that they have sold. So when you multiply that, you'll be getting 40 million. And that's scenario one. We could even end it there, because you are not supposed to write a lot of things, because what they have actually asked us is to make sure to show how something is supposed to be accounted for. Secondly, to look at how they, okay, we give the reason why it is accounted for like the same way we've treated it. And we gave that since the percentage is not more than 50%, because it was relating to a single item. Then we also give a disclosure. A disclosure, these are relevant. If it is not needed, don't give it. Or it's not applicable, don't make any comment about it. But this one, since it was not going to be a provision, then it was supposed to be a contingent liability. And where do we take this contingent liability? We take them to the notice to financial statements. But now we need to know its financial aspect. It is in 40 million. We assumed that cost of repair was supposed to be 40% of the value of the asset. And that's how we got that. The person may add on the uncertainty, but of course you'll be yourself and wasting time, because they have actually given you the question, and the question has the uncertainty within it. Because the uncertainties are going to be arising from the sense when these defects are arising, or they are not going to be arising. That's basically what we can do for that scenario one. And that will be done for that scenario one. So let's try to look at scenario two. We read through, we make analysis, then we come and give a fine solution to the question. So we've done with this, we are done with solution with the scenario one. Then we can also try to go to scenario two and look at what we can get from that. So we have part B says XY Limited will pay environmental cleanup costs of shillings 500 million when it ceases one of its line of operation in 5 years from now. Then they are saying the relevant discount factors after 5 and 4 years at 10% are 0.62092 and 0.68301 respectively. Then they are saying calculate the provision to be made in accounts in the current period and the following year, meaning the following year is 1 year after. Of course, the current period maybe they are talking about is actually the period that we are in, or that we are doing the financials. Then what they want also the provision that we are going to be making after that current period that we are going to be working on. That's why it has been given 6 marks. So when we try to do the analysis of the question, we are seeing that the company will pay 500 million when it closes one of its operations in 5 years time from now. And they have given us different discount rates, and now they are requiring us to compute the provision that is supposed to be made in the accounts in the current year and following year. Then what you have to first of all pick into your mind is what exactly the examiner is looking for. If it is a company paying environmental cleanup costs of 500 million after ceasing or after stopping its operation, we are trying to look at here that the examiner is now testing the provision for decommissioning or dismantling of, because this happens when the person maybe has obtained maybe a contract and now they are going to be using a given resource or an enemy resource. They are going to be extracting, but you just know that whenever they are doing these extractions, the environment is going to be disorganized. So now we are saying that the company, maybe through the person who actually, or through the government, that has actually given these guys the contract to work, they are requesting that after your operations, at least make sure you maintain the environment the way you found it. Because whenever they do the extractions, they leave some, when they are extracting these particles, they have disorganized the topography or the landscape, and you find that they have put different heaps of soil and all that that is supposed to be maintained at their level, which they found it before actually starting their operations. So what we actually also need to understand within these provisions for decommissioning is that even when you don't want to pay these costs, you will be forced to pay them, because at the end, when you have done your operations, you find that the surface has been disorganized. And the only way, the moment you actually embark on that project and you say, I'm going to start the extraction, maybe it was oil and gas, the moment you start embarking on the on that project, you find that there is no way you can escape paying those costs, because at the end of the day, the surface is going to be disorganized. So that's how these items are coming in play. And actually, we try to look at them under IS 16, that was PPE. We try to look at dismantling, whereby we try to make sure that since these costs are going to be incurred in the future, we try to discount them. And when we are discounting them, we use a given discounting factor. We discount them and we get their present worth. The reason why we are getting their present worth is that these obligations are going to be incurred in the current year. So we need to know, if at all you're going to pay 500 million in 5 years' time, we need to know how much is that amount now, so that we can be able to remove it from, we remove that as an expense from our incomes. Because however much we are going to incur them in 5 years' time, they are already costs that we can't actually avoid. So we deduct them, but we only deduct the figures that have been converted to their present worth. The only way we discount we can convert a future cash flow to a present cash flow is by discounting that 500 million back to how much that amount is going to be, if at all that amount has been incurred now. So we are saying that since these costs are going to be incurred in the future, then we need to discount them. We'll write something and we sort this out. Try to discount these figures, we get the present worth. We be able to know which values we are going to deduct now, because they are going to be as liabilities. So what we need to identify is that the amounts that we have, or the present value that we need to get for the current period, is going to be by discounting our 500 million that we are going to be incurring in the future, and we are going to be using the discounting factor that is going to be for the 5th year. Because if the project is starting now, it means that project is going to be lasting for 5 years. It means that cost of 500 million will be paid in the last year of the useful life of the project. So it means the discounting factor we are going to be using to discount our, or convert our 500 million, that is a future cash flow, into our present worth, is going to be the discounting factor that has been given to us, but we take the one for the last year. Then the one which is going to be after, or the one that is within the following year, After 1 year, then we shall also be discounting these 500 million using the cash flow, using the discounting factor of the 4th year. Because if the project is going to be for 5 years and they are telling you to discount these figures after 1 year or in the following year, it means if 1 year has passed, it means we are no longer going to be using the discount. Let's go now to our Excel sheet and we'll be able to discount this scenario 3. We'll be able to get it's going to be our scenario 3. Scenario 2, we may try to do some explanation and we say that XYZ Limited will recognize a provision, for costs that will be incurred in the future since the obligation arises at the point the entity acquires it may be a right or it may be an asset. It requires an asset. It may be an asset that is going to be constructed, or it may be a right to use the asset. It may be an asset, or it may be a right to use an asset, or it may be a contract, or that. Then we have also to explain now which values are we going to be taking to our financials. We are now going to say that the future costs will be discounted to determine their present worth. Then how are we going to be doing it? Because they asked us to look at the first scenario where these are going to be the provision for the current year. Then we'll do some small computations. We said that for us to be able to get the present value or the present worth, it will be equating to getting our future cash flow. We multiply by the discounting factor, and they had given us discounting factors. So we are going to get the 500 million. We multiply by the one for the current year. It means we are going to be paying the money in 5 years' time. So we are going to use the discounting factor for 5 years, which is going to be 0.62092, as it was given in the question. This will give us 310.46 million. It means this 500 million, if someone says I'm going to give you 500 million in 5 years' time, if you know how much that amount is going to be now, you discount it and it will be waiting to 310 million. That's how we are going to be using that. Then we need also to show how this is going to be treated in our financials, because that's what they actually want us to show in terms of disclosing. What we are going to be having is that we are going to be debiting our profit and loss account. This is going to be in terms of this provision. We're saying 310.6 million. Then we are going to be crediting our provision for environmental cleanup costs. They are going to be 310.46 million. And remember, this provision is supposed to be taken in the balance sheet as liability, because we are going to be paying out that money. Since that money is going to be paid in 5 years' time, so we can either put it under non-current liabilities, or we put them under current liabilities. But the best option would be taking all the figure to non-current liabilities. Then we also try to look at now the provision that are going to be. Now we look at the provision for the following year. Provision now for the following year is going to be, we look at now the present value, but we are now going to be changing the discounting factor. Present value will be equal to 500 million. Multiply that figure by now the discounting factor for year 4, because this is now 1 year later. It means the useful life of the asset has been reduced to 4 years instead of 5 years. And the discounting factor was 0.68301. This gave us a figure of 34,1.51 million. Now what we have to do within this is that for this year, the other year we had a provision of 310, but now since we are going to be having the same provision for cleanup costs, but this one is going to be in the 4th year, it means now instead of recording the whole amount of 341.51 million, we are going to be recording only the increment, meaning we are going to be debiting a profit or loss by the increase. The increase, it has increased. The first one there was 310, but now in the other year the liability increased to 341, which means we have an increment, and that increment is going to be coming as a result of getting the 341.51 million. We less now the 310.46 million. And the reason why we are doing this is that when you only take the increment, it means by the end of that year, we are going to be showing that when you add this increase to what we started with, we'll come back to 341. But if you just take the whole of the 341, be wrong. And the increase is around 31.05 million. May take that. So that's going to be our increment. Then we also credit. Now this time around, we are crediting the same thing. We create the provision for environmental cleanup costs. Cleanup costs 31.05 million. And that will be also that. It means that when we go to, now when we try to go to our balance sheet, we are now going to be taking this increment. We are going to be taking the new increment. In the balance sheet, we take this one, even if it is lower, which is 314, even if it is lower. Because this one is higher, it means we have dealt with the 31, but we are taking the whole of these figures. It means when we take the whole of this, it means this figure has been incorporated in. But if you put this figure and you put it in the income statement, you are going to be double deducting the amounts. That's how we do that. And that brings us to conclusion of that scenario 2. We look at the scenario 3 and call it a day. Then we try to look at the scenario 3. Try to go through the scenario 3 quickly and see what we can do. The other one had 8 marks, but this one now has 6 marks. We're saying XY Limited owns land that was donated by one of its shareholders, upon which the company erected some structures. It means they constructed some structures. Recently, one member of the community neighboring the said land filed a case in court against XYZ Limited, claiming that the said land was actually his and the company was trespassing. He paid court for damages amounting to 150 million. Then they are saying that by the end of the reporting period under consideration, the chief finance officer did not make any provision for the above case, contending that he was not sure of the likely outcome of the case. This paid court, it's like they filed a case with the court so that person can be paid. So when you try to look at do the analysis of the question, it has 6 marks. We are seeing that the issue is that the company was taken to court and someone that took the company to court, was actually seeking for damages of up to 150 million. But now the CFO was not actually sure about the outcomes of the court and therefore did not make any provision. So now our concern is to address whether the CFO's decision was right, because if the CFO did actually not make any provision, what was his basis for not making a provision? Those are the things we are going to find out, whether the CFO was right or the CFO was actually wrong to provide for provision. So long as you see they are talking about the provision, what you have to understand is that is the case that has been given meeting the criteria for recognition of a provision, or the recognition criteria, are they met? If they are not met, then it means the was right not to provide for because he never knew the outcomes. But if you find that some of the conditions have been met, then we need to say that the CFO wasn't right, and you give the reason why the CFO wasn't right. So that's basically what this question wanted us to see. But before we try to see this, let's try to be a bit clear about this. If you are given any question, or if you are given any scenario that may be court actions or has court cases, what you have to understand is that most of the evidence that we are going to pay or we are going to be paid is actually from the lawyers. It may be from the company lawyers. It may be from maybe the past practices. You know, in law, you find that some of these cases are decided according to what the previous readings were. You may find that a certain decision has been made based on the past cases, similar cases that particular judge handled. So if we are not basing on the past practices and we are not basing on the evidence that has been provided to us by the lawyers, then we are not actually going to be having any basis for the evidence for us to confirm. Because when you try to look at this question, they have not given us any basis that maybe the company lawyers confirmed that the company is going to lose the case. Because if the lawyers had confirmed that the company is going to lose the case, then it will bring a point for the CFO to provide a provision for that. But since it wasn't given, then it means it gives us an to say that the CFO was right. Because for these court cases, most of the times you base on lawyers say. Lawyers may say that according to the evidence we have, the company is going to win the case, or we are going to lose the case. But if we don't have that evidence, it means we can't justify that the CFO was wrong, because he actually never had any, he was actually doubting, because we were not even given any percentage. It was a one-off item, but we were not given any percentage that maybe it is 50% for the company to win or to lose. So most of the times you base, if maybe there are court cases, make sure you try to look at the evidence that has been given the question. If the question doesn't give you any evidence, and you have actually confirmed that the recognition criteria for provisions have never been met, then they are not supposed to record any. So that's basically what we need to understand from that. And since we have actually seen that in the question we never had any evidence, we are okay to conclude by saying that the CFO was right not to make that provision, because he never knew what will come out of those court cases. So these damages of 150 million, they were not going to be recognized because had no evidence of what will be the likely outcome of the court cases. So we'll go to our Excel and be able to analyze what we have actually discussed, and in 2 to 3 lines, you can be able to summarize this information. In this, you're saying that this case 3, we are saying that XYZ Limited should not recognize a provision for the potential compensation, since, of course, now we are giving the reason why we are saying so, since the likelihood or the likely outcomes of the court case are not clear or are not defined, have no evidence of what will come out of that. So we give what the standard says. Most of the times we said that if the evidence is there, maybe the lawyers have confirmed, we can actually base on that. And we are saying according to IS 37, court cases are recognized as provisions based on information from the lawyers and the likely outcomes of the case, or based on the past practices, because we said on the past similar events, because we said some of these judges, they base on the decisions that were made by other judges in the previous cases, and they can be able to use that information to also make a decision that is in the same way what the previous one was ruled out. So, but now in the question we are not seeing anything. None of this was provided. Hence leading to no provision to be recognized. Then if you are not going to be recognizing any provision, what are we going to be recording? Then this will give us a scenario whereby, since it is the company that was taken to court, and if it loses, it will be able to pay the money. So we are going to be having a contingent liability, because the company is expected to give out money, but we are not sure whether the company will actually give out the money. So we are saying a contingent liability, of which amount it is 150 million. This one will be disclosed in the notices to the financial statements, so that we can be able to give these users of that accounting information, so that even if this item materializes in the future, these people are already aware. So that's basically what this question wanted us to do, and that's all for. Maybe the other aspect that has been left out is a provision for restructuring, where we said maybe the company is now closing off some of its operations. Maybe the company wants to close maybe a branch. They want to change a line of operation. Those are the things that are still remaining. And if you try to go through the theoretical aspects, what restructuring is, the conditions that are supposed to be met before you actually recognize that we are going to be incurring a provision for restructuring, those are the things that can be even asked in the theoretical aspect as they were there, or they can give you some small computation, but most of the times this standard is asked based on the theoretical aspect, because if you can be able to interpret this logic or these technical aspects of the standard, then you can be able to interpret everything and you get everything right. So that's basically for today that we managed to have. Maybe next time we can try to look at some of the other aspects of the standard and wind it up at what is remaining. It's only that provision for restructuring, but all other aspects have been tackled within this similar question, and that's all for today. If possible, we may drop another one that will be able to give you a highlight on that provision for restructuring, but if not, we may try to go and start our cash flows and be able to see what we can achieve. So thank you for watching, and till we meet again, bye for now. Good afternoon to everyone. Today we are going to resume with our series on financial reporting, and the question we are going to look at today is going to be from November 2012, and we are going to look at how we can be able to determine the cash flow statement using the direct method. Most of the times this question is not asked, but we have to look at all the areas and make sure that every area has been covered. And we are going to look at question 2, that is November question 2, 2012. And if you try to scroll down and we see the question, that's the question 2 we are going to be looking at. And if you try to look at this question 2, it says the following financial statements relate to Bcom Uganda Limited for the year ended 30th September 2012. Then you have the statement of comprehensive income, what you call the statement of profit and loss and other comprehensive income. The income statement, as known to most of you guys. We have the turnover, and that was representing our sales. Figure has been given. We have the cost of sales, we have opening stock, purchases, closing stock. Cost of sales was determined after making that adjustment. Then we look at the operating expenses. We have salaries, we have employee statutory expenses, advertising, depreciation, sundry expenses, insurance. Then we have the total operating expense. Go down to the net income. That's how the statement of loss has been stipulated. Can now try to look at the statement of financial position as at 30th September, but now it has been given in a two-year format, whereby we have 2012 and 2011. All the figures are in thousands. As you can see them, we have the non-current assets, land, both for 2012 and 2011. We have the buildings, we have the cost, we have even the accumulated depreciation for both years, we have equipment, cost and accumulated depreciation for both years. Then we have the current assets, have inventory, accounts receivable, prepaid insurance, cash, and all that has been presented there for 2 years. We have now the total assets. Then when you try to look at the equities and liability section, you see that we have the share capital, we have retained earnings. Then the non-current assets, of course, we have a long-term loan, that's a loan mortgage for both years. The current liabilities until we reach the total equity and liabilities for both years. And they have given us other transactions that were recorded by Bcom Uganda Limited. And Roman 1 will have paid a loan installment of 38,880, 38,000,000.88, and it is towards our loan mortgage. You saw it there. Roman 2 we received payment from the issue of shares, that is 37.6 million, having a par value of 20 million. Meaning if they had a par value of 20 million, the balance is supposed to be a share premium. Then we try to look at the required. It says prepare a statement of cash flows for Bcom Uganda Limited for the year ended 30th September 2012 in accordance with IS 7 statement of cash flows, but they have said using the direct method. It takes some time for IS 7 to be said when they are requesting you to calculate using the direct method, but it has ever appeared, so we have to look at how we do it and we be able to do the other method as well, referring to the indirect method as far as statement of cash flows are concerned. Basically, that's what we have, because part B is explained briefly why direct method may be preferred to the indirect method in the preparation of statement of cash flows. These are just advantages of direct methods vis-a-vis the indirect. What are the things that make people to use more of a direct method than the indirect whenever they are preparing their statement of cash flows? So those are the things. You may try to do some reading about them, but my emphasis is Roman A, or the part A, that is requiring us to prepare a statement of cash flow. So the questions seem to be a bit long, but we are going to break it into items that are going to help you understand the cash flow statements and be able to do everything whenever you see any number that is concerning the cash flows as far as examination purposes are concerned. What I want you guys to take note here is that we are trying to look at some of these items, the balance sheet items. We have the statement of financial position, that is the balance sheet as at 2012 and as at 2011. You have to be careful about those dates or the years they have. Most of the times you may find that they have interchanged this one now, this one is 2012, this one is 2011. And most of when you try to look at some of these numbers as we are going to be seeing them, you find that they prefer this 2012, maybe 2011. But in the other final examinations that you may see it, you may find that they have interchanged the figures. So you take a good note about that. Then the other thing as far as cash flows are concerned is that they are supposed to balance by themselves. Whenever we have done everything and we've done everything right, then they are supposed to balance by themselves. What we mean by balancing by themselves is that the cash we have, because this is the cash for the year ended for the year ended 2012, and it is 8946. Whenever you're doing our computations, we are supposed to be reaching that very same figures. But there is some logic I need you guys to understand. Items, let me try to highlight them. Those items as I have responded this cash column, like the same way I've highlighted that cash column. What happens is that whenever we are preparing these cash flow statements, we are trying to look at all the transactions that have occurred within the organization, but they have resulted into cash movement. The cash movement, you may be having an outflow of cash whereby we are paying out, or it may be an inflow of cash whereby we are receiving cash. It may be in form of incomes we are earning from the business or from different sources we have made our investments. Those are basically the things we try to record in our cash flow statement. But the logic is within these financials. When you try to look at the balance sheet for these 2 years, you find that cash in 2011 it was 6606. But when you look at the cash balance as per 2012, you find that it is 89460. That difference you are seeing there the difference you have within cash is actually the reason why we prepare cash, because we are trying to adjust what might have happened within the period we are preparing our financial or our cash flow statement, to the extent that we are having the balance we had at the beginning of the year in terms of cash or the money we have at hand is different from what we have at the end of the year. So those are the things that we are going to look out for within the entire statement within they have given us and within the income statement they have given us, to see the entire operations of the organization, and we see how cash was managed to the extent that what we had at the beginning of the year is not the same as what we have at the end of the year. Because if they were the same, then there was no need for us to be able to prepare these items, because at the end of the day, they are all balancing. So that difference that we have, if we 460, we less the 66060, that difference of 23,400 should be either split into the money that we are going to be having in the bank, or it may be within these other cash and cash equivalents, those items that can be easily quantified, whereby we can actually get money out of them within a shortest period. Those are the ones we call cash and cash equivalent. They are not necessarily cash, but they can be converted into cash there and then. So when you get that difference, it is actually that difference that we are trying to look for that caused these ending balances to be in a mismatch. Otherwise, if they were balancing, then we could actually say that we actually spent the money we had in cash, all of it. So that's basically in a rough way we can talk about the cash flow and how it's supposed to be balancing. So as the question suggests, we are going to be using the direct method, and we try to look at, to prepare the cash flows. It's gonna be a bit wide, but you have to go through each step, because my approach to this question is that we try to look at all the possible areas that the examiner may ask the same question using the same method, and you try to look at other things that we are not asked within the question. So we combine them all. By the time you get out of it, you will be able to do more and more of it. So without wasting more time, let's try to go the Excel and be able to interpret the information that we have. That's our Excel, and we can now try to get things done. We are going to be looking at November. This is November 2012. It is question 2. We are going to be looking at cash flow statement using the direct method. So when we are in our Excel, what we try to start by giving our sheet a heading. They said it is Bcom Uganda Limited, and what we are preparing, of course, we have to start by giving our cash flow a heading. We are indicating the method that we are going to be using, the period that we are going to be preparing our cash flows. Then we try to look at the statement, of course, we are preparing. Those are the things that we talk about whenever we are giving a heading. But don't expect to be given marks for this, but professionally, you're supposed to be doing it. It is Bcom Uganda Limited. Now this is going to be our statement. Being given marks for heading was in level 1, statement of cash flow using direct method. Then for the period or for the year ended 30th November 2012. Of course, we can put all these figures that we are going to be working in thousands, and put that one in bracket. Okay, that's what we are supposed to be doing. Then the question wanted us to prepare the cash flow when we are using the direct method. But what you have to understand is that IS7 doesn't permit the use of direct method. But for examination purpose, it was asked. So that's why we are going to go ahead and be able to show how it is done. Then, but in the real senses, this is not applicable in the real situation. We always use the indirect method because for it is a bit approachable, as we are going to be seeing. But what you have to understand before actually we go any further is that irrespective of the method we are going to be using, we are required to first of all classify all these cash flows, the money we are going to be either receiving or either money is going to be moving out. The cash movement is supposed to be classified under different, actually it's supposed to be 3 different activities. One is the operating activity. Secondly, we look at the investing activities, and we finally look at the financing activities. Maybe to give you more lights about the operating activities, those are the things that we do within the organization, the day-to-day activities of the organization. We sell goods, we buy stock, we buy raw materials, we give out, maybe we incur transport, all the things that we incur within the organization, what we do for the survival of the business. Not actually for the survival, but it's mainly for the short term, the day-to-day things we do in the business. Those are the things, everything that is falling under that category is going to be accounted for under the operating activities. Then the second item, we look at the investing activities. Investing activities, of course, we look at where money is coming from that is going to finance these activities, whether they are going to be long-term or short-term, that we are doing on a daily basis. Because for you to do those daily activities, maybe selling goods in the market, it needs some money. Where are you going to be getting the money for fuel, money to pay all these workers? That's where we are trying to look at. Where do we get our money that we use within the business? Whether to buy these long-term assets that are being used within the production of those goods, or we are embarking on these short-term activities that are helping the organization to run. Then the third one is, of course, the financing. The financing, of course, I spoke about it. Financing is more or less where we're getting the money, but investment is money for the long term. These assets we are acquiring, the other investments we make in other companies, maybe we have different associates. We have got maybe where we are members and we are earning some dividends. So investment and the financing activities, they are more or less related, but one of them is looking at the long term and the other one is looking at the or the short term. That's basically how I can give, but for now, let's try to concentrate on the question and we'll be able to understand some of the things as we go on, because it may take us a while when you have, it's now 30 minutes, but we haven't started on the question yet. Okay, then the other thing you need to also to note is that these methods, of course, we have the two methods, the indirect method and the direct method of preparing cash flow statements, but it's only the operating activities that differs or differentiates between the indirect and the direct method. It's only that operating activities, the way we compute it is the only difference that we have between the two methods, but the rest are the same. So when you have understood this, the only thing you need to understand from the indirect method is only the operating, how the operating activity is done, but the rest are going to be remaining in the same way we've used them under direct method. We can now maybe put this as a note. We try to concentrate more of the direct method, and we are saying that under the direct method, we look at the actual operations of the business, and you try to look at the day-to-day basis, what we actually do within the day. We say selling goods, whether we are receiving cash or we are selling them on credit, or whether we are paying suppliers, we are paying employees, we are paying other operating expenses like rent and all that we actually do within the day-to-day operation of the business. So what we try to do is that we try to get the cash flows that that is arising from those normal operations of the business, what we actually do within the business, and that's how we report it. And that's mainly what direct method is all about. It looks at the things you keep paying, the money we keep receiving, the other expenses that we are paying, and that's all. So it is we are going to be looking at whenever we are doing these computations. So we can try it now can start by looking at the first set of the activities. Here we try to look at the operations as we've been talking about them. We first look at now the cash flows from the operating activities, because we said we are going to be categorizing these cash flows from operating activities. This one we can maybe try to make it a bit bold. Now when we go to these cash flows from operating activities, we've been talking about them, but we may maybe try to analyze this information. Here we try to look at the cash flows, whether they are going to be coming in or in terms of the inflows or the outflows that are going to be arising from the normal operations. For example, we talked about the cash sales. If at all we are selling goods and we are getting cash. Remember, our emphasis is on cash coming in. If cash is not coming in or moving out, we don't record that transaction. So now we try to look at the question and we see what are some of the things that we have within the operations. And where are we going to get this information is through looking into our financials that have been given, especially the income statement, because it is what gives us the incomes and expenses that we have actually incurred in the normal course of business. If you look at this question, we may try to, we said we are going to be concentrating on our income statement. That's our income statement. When we try to look at this income statement, we are saying that in terms of what the business sold out to the customers, we have the turnover of 1.67400. But this turnover, as you are seeing, it doesn't have any note on it, whereby we can be able to get what are some of the sales that were made on credit and what are some of the sales that were actually paid for in cash. So what you have to understand that is when you are preparing this income statement, use whereby we record all the transactions that have been given to us. But when you go to the cash flow statements, it's different, because there we only record things that we actually received cash for. Yes, we sold 1.67400, but did we actually receive cash from all those sales? If we didn't receive cash from those sales, then what we want to find out, how can we get the portion of those sales that we've made during the year and we try to relate to those items that have been paid out, or where we actually receive the cash from the customers. So the other item that may come in as a question to whether we actually received cash, since we've not seen any note showing that we have cash sales. Then what comes into our minds is that maybe what we actually sold was all on credit. But to confirm that is by checking the the balance sheet to confirm whether accounts receivables they are there. When we try to look at our balance, our balance sheet, we are seeing we have accounts receivable. And we have both for the beginning of the year and for the end of the year, which means that we must have actually made some credit sales, because we are seeing that during the year, the accounts receivable balances, they are still there. So it means not at the end of the year, we are seeing we still have 256,608,680, which means that not actually what we sold out, we necessarily received cash out of it. So it means since we still have these accounts receivable, we may now say that we actually sold goods on credit. Then the other aspect that we need to know is that we are saying that accounts receivable figures, they are these at the beginning of the year. It is 144,720, but at the end of the year, we are seeing as if they are growing to a certain number. It means within the year, we must have increased our credit sales. So what we need to know here is that we need to know the cash sales that we are, sorry, the amount we actually received in cash. Because we said we are not going to be getting cash sales, because the only way we can get these cash sales is by looking at our cash book, which was not actually even given, and not expect to be given the cash book at this level. But we may be having a second alternative of where we may get our cash sales, and we may try also to look at the money that we are going to be receiving from these creditors. We may call it the cash or the collection from the accounts receivable. It may be taken in form of the items that we have actually received the cash for. So that's basically, we say the first alternative, if you have not seen any cash sales, you try to look at the cash book. That's the first one. Then the second alternative is to look at whether we had accounts receivables. If you have these accounts receivables, it means that during that period, people are going to be coming in to pay, because we assume that maybe they took goods on credit, but during the year, they are going to be coming in to pay or to offset their balances. And that will come in as collections or cash from the debtors or the accounts receivable. So as far as our cash flow statements are concerned, we need to know how much of this amount or of these sales we made on credit. And we've confirmed that maybe we made some credit sales because of the accounts receivables being increasing in the balance sheet. So we want to find out how much did we collect from these accounts receivable balances towards the end of the year or during the year. What did we collect from these debtors? And when we get that amount, it is the only amount we are going to be recording, not recording the whole sales that were made, but which we actually didn't even receive cash for. So we only record what we received in cash or what we paid in cash. So we are saying that the amount which has been paid by these debtors during the year, we can get it from the accounts receivable figures, because if we have some at the beginning and some at the end, we can try to adjust them, and whatever will remain will be our amount that we have actually got from our trade receivables. So Having made some analysis on that, we may try to go to our Excel sheet, and maybe you can skip line, because here what we are supposed to include all here is cash flow from operating activities. And one of the item is the sales, and most so the cash sales. But since we didn't have the cash sales, then we are supposed to only record the amount that we are going to be collecting from these accounts receivable, because we have confirmed that some of these customers took goods on credit, evidenced by the balances within our balance sheet, because the fact that we have accounts receivable balances in our balance sheet, it shows that we must have sold goods to credit. That's a confirmation. But if those figures were not there, then we could assume that all the sales that were made were in cash. The only item we are going to be recording here is the collection from accounts receivable. Or let me use the debtors or accounts receivable. And this is going to be our working number one. This is our working one. What you have to understand is that when they tell you to prepare a cash flow statement, you first skip a line where you're going, you skip a page where you're going to put your cash flow, then you do the working aside, not mixing everything in the same page. But since my screen is a bit wide, I can start my workings from here and say now this is going to be our workings. And our working number one is going to be the collection from debtors. So how do we now get these collection from these debtors? We are trying to look at how much has been collected from these debtors during the year. We agreed that the first thing we do, we draw an accounts receivable contra account. These contra accounts, you did them on level 1. Those are the ones that we draw. We put in the information that we have, and we use what is remaining as the balancing figure, and that balancing figure is what will be the collection from debtors. Because when we have these collections from debtors, remember from our balance sheet, if we may go back to our question, if you try to look at our question from our balance sheet, we are given 2 years. We have 2012 and 2011. The figures for 2011 are going to be our opening balances, and the ones for 2012, they are going to be our closing balance. Those figures, these ones, the one you are seeing here, accounts receivable figure for 2011, they are going to be our opening balances for the year 2012. And these closing balances we have here, they are going to be our closing balances for that same year 2012. So the good thing with these T accounts, they are, so long as you know whether an account is an asset or a liability or an income or equity section, you can be able to know where the opening balances are going to be. One is that this is going to be an asset account, because debtors are assets, current assets. That's why you are seeing them, they're being indicated in current assets. And if you're very wise, you could be able to know which type of account is it, because they're all labeled within the statement when they are presenting it in the question. So the balances for 2012, they are going to be our opening balance, and they are going to be debited to our debtors account or control account. Since they are asset account, and the figures for 2012 will be credited to the debtors control account, since they are going to be the unpaid debt for the year 2012. Because this figure you are seeing for 2012 is going to be the opening balance for the next year, that is 2013. So that's why we are going to be crediting that figure. Then, when we have done that, Then we can see what will be next as we try to look at our financial statement and we look at some of other things that are supposed to be incorporated within that account. So let's try to draw this T account and we see what we can do. This is accounts receivable. It's a control account that you may, even if you just say accounts receivable account, you'll be right. Sorry about that. We have now completed this. Can now try to go to, this is our debit side, and this is going to be our credit side. So we've drawn our line, and we said we are going to be having the balance. This is now the balance brought down. Balance brought down. When we check our financials, we are seeing that we have 14,4720. Then we have on the credit side, we have the balance. Also the balance carried down. Balance carried down, we have, it is 25,6680. Remember, we are working thousands. We remove the 10. Maybe you can push these figures the other side. Be 14,4720. Then we balance these figures off. Having put in the figures for our balances, having put in our balances, we balance for those balances that were given the question. Then we may now try to look at some of the other items that are going to be within our accounts receivable control account. We try to look at this account receivable. The account will have items like the credit sales, because those are the ones we actually made on, that were made on credit. But in credit sales, they are going to be credited to the sales account. Remember, when you sell goods on credit, the entry we do is we debit our accounts receivable, since they are the ones who actually not paid. Then we credit our sales within the accrual accounting. That's what we do. So since we are not given the values for the cash sales, remember, if we had the cash sales, we could also record them in our cash book. Remember, cash book records all the other cash transactions that have been recorded, whereby we debit bank or cash, then you credit our sales. But since we never had that, we are going to make an assumption. Here we are going to assume that we are going to make an assumption that all the cars, all the sales were on credit, since we never had the car sales. Assume that all sales were on credit. But remember what we explained, don't just make a conclusion that all sales were on credit, yet you have not actually checked thoroughly within the additional information that has been given the question. Therefore, because our sales, we say they gave us, therefore the turnover, because in the question we were given the turnover will be our sales, will be our credit sales. So we said, when you have these credit sales, we are going to, when you have these credit sales, or when you sell goods on credit, we debit the accounts receivables, and credit sales. So that's what we do. Therefore, this figure is going to come in, the figure that was given to us is going to be coming in as credit sales here. These are going to be the credit sales. Remember, we are not looking for we are looking for the collection form from accounts receivables. And our figure was 16, the turnover was 167,4,000. Remember, we are working thousands. And now we'll try to look at other items within the income statements, within the figures that we have, that may reflect within this account. We have to look at some of the items that may affect this account. The other things that would affect this account will have the discount allowed. Remember, discount allowed, it's like they are reducing on the value of the item, of the value of the item you're supposed to be paying. If the value has been reduced, it means it should be adjusted by that figure. So What you need to understand from this is that where do these items fall when it goes to our control accounts. Remember, our control account is going to be reducing values from the credit side. Whatever reduces our customers, what is reducing what we demand from our customer is supposed to be credited. And even the money they have paid is supposed to be credited to that same account. So the discount received, we have the provision for bad debts if at all we are shown that some debtors are not going to be paying. That's why you may find this is net. If it says it is net, it means they have deducted all other things that may happen. And one of the things is the provision for bad debts. We have even the return inwards, or the sales return. There are customers, they have bought goods on credit, but they are returning some of the items. If they are returning some of the items, we had debited their account, so we credit it to make sure that we adjust to the normal figures that they are supposed to be paying. So those are the items that we look at, and we say that if they are there, they are supposed to be taken away, and we'll be able to get all these figures right. So when you try to look at the question, let's go through the question and we see in the income statement whether we have all those items that we've actually mentioned. We talked of we are not seeing any discount, we are not seeing any provision for bad debts, we are not seeing any return inwards. So if you don't have any of those items that we've been given above, because when you go through the question, you're not seeing all those items, then we're supposed to balance off that account. And when we balance off, whatever remains there is actually what should have been paid by these customers to the business. And what we mean by balancing off these accounts is that we add both sides, we choose which one is bigger, then that bigger side will be the total, then we get the difference will be the balancing figure which we are looking for. So we have not seen any of those. Go back to our question and finalize. Since we've not seen any, we can now try to balance off these items by, of course, getting the totals. Here, even if you just say get the totals of this, add this, and add that, we shall be getting that. And this figure, it is higher than this side, so we copy and we paste it the other side. So having pasted it there, we double underline, close off the account. Then we double underline this. That's how we close off the account. But now the difference between this and this is what we are going to be calling our collections from. Start writing it from here. It is collection. Actually, it is now what we actually received. We may call it cash or bank, because what happens is that when these debtors come to pay us, we credit their account and we debit cash or bank because we are receiving money. The debtors account is going to be reducing because they are paying us, and we are going to be increasing our cash because we are receiving money. And we are going to be receiving in the form of collections from accounts receivable. And that figure is going to be the balancing figure, which is 1562040. And that figure is what we are going to be taking, is what we are looking for, and what we are going to be taking to our cash book. Sorry, our cash flow. Because in the cash flow statements, we only record money we've received. So since we've got the money that we received from these people, then we are supposed to say that these figures are going to be taken to this. Can copy this, copy that figure, and we paste it here. It is going to be coming as an inflow. So it is going to come as a positive figure because it is money that we are receiving. it is the company that is receiving money from the customers. But if we are paying out, then we could make it as an outflow. So that's it for that, for that. And that's what they expected us to do from there. This was working number one. This was working number one. Then we try now to go to the operating activity number two. Remember, the first activity was when we are selling out goods. But now let's try to look at when we are paying out suppliers. It's now the company giving out money to the suppliers. It is the same scenario, the same way we analyze the accounts receivable account is the same way we are going to be analyzing the payables account, because now it is now time to look at when it's time for the organization to pay money to the people who are going to sell them goods on credit or raw materials. Because if it is a normal business that does trading in stock, it buys stock and sells. So if you buy, you are going to be required to pay the suppliers. If it is a manufacturing company, it has to buy raw materials to be able to manufacture the finished goods. So we try to look at also that side, and we see what we can get, because those are the things that are going to be happening within the normal course of business. We are saying, having known the sales, then we need to know how much we paid out our suppliers before we actually try to look at these other operating expenses. Because on the payment side, we are going to be paying a lot of things using the money we've received. But before we pay off these other operating expenses, let's try to look at how much are we going to be paying to our suppliers who are going to be giving us goods on credit. That's basically the idea we are going to look at, and we will use the accounts payables control account as per the financial statements given. So we'll try to look at now our question. If you go through the question we've shared, we may look at where do we get our payables. We get them from the balance sheet. So they are current liabilities. So we'll go to the liability side, and they are here. Accounts payables. We said we first ignore these other payables, but we look at the account or the suppliers. Accounts payables, those are the people who are supplying goods on credit to us or to the business. They are the same as the creditors and all that, as we are going to be using those words interchangeably. So we have our accounts payables for both years, and we are saying that when we pay creditors, what we do is that we debit creditors and we credit our cash or bank. The reason why we are doing that is that when we pay them, we are reducing the balance they were demanding from the business. And in that case, we are seeing that cash is going to be lost because we are giving out money to offset the debt that we have with the supplier. So that's the reason why we do a double entry of debiting our suppliers, because they are going to be reducing the debt we have to them, and we credit our cash or bank because cash is going to be lost through paying suppliers. So when you have known that, we now try to look at what did we pay to the suppliers in cash, because what the cash flow statement looks at is how much have you paid in cash, because we are saying we have these 15408 and 105,660. Someone who just looks at the figures, he may say that we have a reduction, which seems that we must have paid out some of the debts to cause a reduction. But for us, what we are interested in, what did we actually pay? And that's the analysis that we are going to go through. But remember, for ease understanding of the double entry, we need to know which accounts are we presenting. That's very important. And in this case, it's a liability account. So since it is a liability account, we are going to be having the opening balances being on the credit side because it is a liability, as they are being provided for in the balance sheet. And we are going now to make these closing balances to be on the debit side of that accounts payables control account. When you have made that, then now we can try to look at some of the other items like the credit purchases and the other items as we are going to see them. So let's first take these balances, we draw a control account, and we make sure we put in these balances in their right ways as the double entry suggests. When you go to our sheet, we can now maybe try to just copy this because drawing something like this, it may take us, it took us some time to finish it, all of it. We rather copy it and we paste it here. Paste it the way it is. And now this one we are trying to look at now, we are looking at the payments. These are now going to be payments to creditors or accounts receivable. And this will be our payments to creditors or accounts payable, payables. This is now going to be our working. This is going to be our working two. This is working two, where we are looking at the payments to, instead of saying these accounts payables, we are going to be calling them accounts. These are now payables control account. And we said these will bring the opening balance, and we said the opening balances are, we said this we are going to be having these figures, we may delete all of them. We said we are going to be having the balances carried down. Balance brought down is going to be on our credit side. And the figure there was 15408. Then the balance carried down, we may put it here, balance carried down. Said balance carried down is going to be on our credit side, on our debit side, since it will be what is outstanding next year. Yeah, it is 105660. So having put these figures, we now go back to our question and we look at the credit. We said we are going to be looking at the credit purchases, what we actually purchased on credit. So we said this account will have items like credit purchases, but remember, when we purchase goods on credit, we debit purchases and we credit our suppliers or the accounts payables. We debit purchases, we credit suppliers. So we go into our items and we look at how we go into our income statement, then we look at the figure for purchases, because when we purchase goods on credit, we debit the purchases and we credit our suppliers. But if we had a cash book, we could also look at the cash items or the cash purchases. And those cash purchases would have come here direct without even writing anything. Even cash sales would have been the first one, then we get the correction. So since we never had the cash book, we are assuming that there was nothing like any payment that was made in cash to these suppliers. That's the assumption we went with because we never seen the cash book there. So when you have not seen the cash book there, the next item you look at is whether we have these balances for accounts payables and accounts receivables. When we see that we have a balance there, then it means that we must have sold or bought goods on credit. Having analyzed that and you find that those figures they are there, then now you can, if you are not given the cash purchases, you can now conclusively say that maybe all the purchases were on credit. So let's try to go into the question and we'll look at the information we have. do we have cash purchases within our income statement? The income statement, we are seeing we have only one figure for purchases, and it is 118,160, which doesn't have any note that stipulates what part belongs to cash and what belongs to credit. So even here, we can make an assumption that we assume that all purchases were on credit because we were not given any identification that some of the items were bought by cash. So we said we also provide an assumption. We assume that all purchases were on credit. And we said that whenever we purchase goods on credit, whenever we have credit sales, credit purchases, we debit our creditors or suppliers. We debit our purchases, and we credit our suppliers, stock creditors, or accounts receivable. And that's the double entry we are going to put in here. We said we debit our purchases, and we assumed all the purchases were on credit, so we are going to record all the credit purchases within the figure for this, which is going to be our credit purchase. We may say purchases, but since we assumed, we may just say purchases because there is no need for you to split them yet. You assumed that all were on credit. Purchases of 11111 is 1118160. Then, having put in that figure there, we try to look at what other items that are supposed to be included within that account. And we are saying the other items that will include in that account will be the discount received. Remember, discount, if someone gives you a discount received, if someone gives a discount, it's a deduction to the price that you are supposed to pay. To the business, it will be looked at as an income, but the person who is giving you that it looks like an expense to that person. So to the creditor's account, it's supposed to be debited because it is reducing the figure of creditors. So since it is reducing the figure, everything is supposed to be debited. We have return outwards. Those are the purchase returns. You bought some goods, but you find maybe some of them, they are not the standard you want, you return them. The other one, discount received, we spoke about it. And all these items are reducing the amount to be paid to the suppliers. So they are supposed to be recorded in the debit side. Remember, this account is reducing on the debit side. So since we are not given those, because now we are trying to look at the items in the income statement, we see whether those items we spoke about, they were given to us in the question. But they were not given because I'm seeing we have salaries, we have employees, statutory expenses, and others, which doesn't specify all those items that we spoke about, which confirms that maybe those are the figures we have and we need to balance off this account. But what you have to keep in mind is that what we actually remain with, or what we shall remain with as the balance, is what will be the actual payment that was made to the suppliers. And that's what we are looking for to be incorporated in our cash flows from operating activities using that direct method. So we try to sum up. When you sum up this side, getting this plus this same figure will be the same figure that we shall take to the other side. Copy this one and paste it here. So now this balancing figure is what we are going to be. Remember, when we are paying these suppliers, payment to supplier is a reduction in the money we have. We are using the money we have at hand to pay these suppliers. So it will be a credit to cash or bank and a debit to creditors. So it will be cash or bank. We are putting both means because we may either pay by cash or we pay by bank. And this will be the payment will be representing the payment to the creditors, and that will be our balancing figure, and the figure is 1158. Because if you try to understand some of the things, even if you don't cram them, you are saying that at the beginning of the year we started with 1. These are the purchases that we had that we had not paid at the beginning of the year. Then we purchased these during the year. And at the end of the day, at the end of the year, we are seeing that we have only this balance that is still not yet paid. It means the remaining, the balancing figure should have been paid to complete the missing figures. Because if this is what we started with at the beginning of the period, and this is what we purchased during the year, then it means that if this is what we had at the beginning, this is what we purchased, but we found ourselves that at the end of the year, we only remained this. It means the balance is paid, which is the same figure which we are supposed to be taking to this side as our payment to creditors. So that's how we actually do these items, and we'll be able to get some of these items. So we try now to look at, remember we said we look at the money we get, we look at what we paid to creditors, then we also try to look at the payments that we've made during the year to other operating expenses. Remember, where do we get these operating expenses? We get them in the income statement. So this income statement is for the full year or for the whole year, but the balance sheet is not for the whole year. It is at a specified period of time. That's why we are always tallying with the balance sheet figures, because that's what we had at that period. Then after computing the collection from debtors, we've known them. We've also known the payment to the suppliers. Now we need to look at the payments to other operating expenses. But now these must have contributed to cash movement. And hence, all these other non-cash items, they are supposed to be taken out or are left out. In other words, what didn't contribute to cash movement is not supposed to be included in the cash flow statement. That's how, as per the direct method suggests, and that's what differentiates, because in the part B of this question, the same question they asked, the advantages. For this one, it looks only those items, doesn't take into account the non-cash items. Because if you try to look at it in a logical way, you may try to see that a business may be having a net profit, or a business may register a net profit in its financials. But when you prepare the cash flows of those of that company, it doesn't have the cash flows. So it means they are using these other accounting things that are included within. You may also find in another situation whereby the company is registering a net loss. But in other words, that net loss, when you compute the cash flow statement, the company is stable, or its cash flows have a positive cash flows. In a sense that when they have a positive cash flows, it means that maybe some of these other deductions that were included within the computation of the net profit, they were not actually given out as cash. So those are the things we need to highlight and be able to adjust. So here we made a mistake. This one is supposed to be in a negative. We take it as a negative because it's an outflow of cash. Or you may try to put it in a bracket. Move the negative and I put it in a bracket. So we try to look at other things, as we said. We look at the income statement. We try to look at all those operating expenses. We are completing everything. But we must make sure that we look at those, or we recognize only those that involve the cash movement. So we go to our income statement and we try to look at all other operating expenses. We have salary expense, we have, but now the other logic is when we are looking at these operating expenses. These operating expenses, you look at them vis-a-vis with the balance sheet figures. In a sense that since this income statement is showing figures for the whole year, the balance sheet shows what is still outstanding at that very period or at that particular period. That's why we look at an expense, we verify it with the balance sheet. If you find that in the balance sheet we have a similar expense, then we assume that that expense wasn't entirely being paid. So we try to look at maybe the prepayments. We look at in terms of the assets, the current assets and the current liabilities of the business. We see whether any of these expenses are reflecting there. If they are reflecting there, then they are supposed to be adjusted, and we only take out a portion that has been paid. We look at this salary expense as our first item. We compare that salary, we look at whether we have anything that relates to salary. We have salaries payable. Since we have salaries payable, then we need to draw a T account. And this T account is what will help us to get all these right. But what you have to understand whenever you are doing this T account is first identify what the account is. Is it a liability? Is it an asset? Because if you don't do so, you won't be able to understand where to actually do these figures. And we said, remember in the start, we said that these accounts verify themselves. So let's go ahead and try to draw a T account for that. Our working number, this is now going to be our working number 3, and it is salaries. I want to look at what was paid, salaries paid. We are looking for only the paid account, but we are going to use copy this. This is now we are looking at the accounts, the salaries payables, because it is the one that gives us the balancing figures. The one is for last year and the previous years. Accounts payables. So the control account. Someone may just leave it like salaries payable account. But remember we said this is a liability account. So we look at the amounts in the balance sheet, so in the income statement, and we compare it with the balance sheet figures. And if you see that the salaries payable have not all of it has been paid in the income as it is in the income statement, then we adjust. But we said it's a liability account, so the opening balance will be on the credit side, and the closing balance should be at the debit side. This is the balance brought down. Balance brought down for this was given as 8820. Then the balance, was the balance carried down. Balance carried down was 7560. 7560. So we try to look at what other items are going to be within. This one, of course, is everything that relates to salary. One of the items that is going to be there is the salary for the year, what they actually paid in the income statement. What they paid in the income statement will be there. So when you try to look at this now, the double entry, how are we going to be bringing the figure that was paid in the income statement and we put it in our account? What was the double entry before actually we start these accounts is that the figure that was included in the profit and loss or the income statement was deducted. Deducting something, it means it has been debited there. This is how I want you to understand it, and if you get it right, you'll be able to do each and every number without any confusion from these figures. What was taken to the balance sheet, sorry, to the income statement, was deducted as an expense. And deducting from the income statement is the same thing like debiting the income statement. So since in the income statement they debited what is there, for us to complete the double entry, we have to credit that figure. And that is going to be credited to the figures, and it's going to be in terms of profit and loss. Actually, we'll bring it in terms of profit and loss. Profit and loss, I mean the profit and loss account. What we took to the income statement was 264,600 is what we took to the income statement. It was deducted as an expense, meaning in these T accounts, we are going to credit it because the other side it was debited. Because removing anything from the income statement is like someone saying debit that income statement, because crediting the income statement means we are adding that figure to the gross profit. Hope you can be able to get that right. So we now get these figures, the total, which will be this. We add, if there is nothing that can affect that account, add that. So we copy this figure and we paste it here. Paste the figures. Then the balancing item is what we actually paid. The analysis is just simple, that account. We are seeing that at the beginning of the year, we had a liability. They were demanding us in terms of salary, 8,820, which is this one. But during the year, we also incurred an extra, or we incurred an extra of 264,600. Even this one is not paid. This is what we incurred in the year. It's the same obligation in the year. But we are seeing at the end of the year, we're only registering 756,660 as a liability, meaning the balance of these two sums, if you add this plus this, the balance should have been paid. And it should have been paid from the cash or bank. If it is paid from cash or bank, it means here cash was reducing. Here we are supposed to debit it. And we come here, we say cash or bank. Cash or bank, and that's our balancing figure, which is 26,5,860. This is our balancing figure, and that's what we are supposed to be taking the other side. And that will be coming as payment, or the salary is paid. This is now our working 3. This is our working 3, which is negative. Can just pick it from here, this figure, because it is money that moved out to pay off workers. That's it. If you try to maybe to get more lights in a very lively example, especially for these salaries, what this means is that employees were still demanding at the beginning of year 2011. They were demanding 8,820. But when you are still demanding, it doesn't mean that you are supposed to go home because you are still demanding. You will continue working. When you continue working and the year ends, they have not paid even for that year, you will still have increasing the liability by this, by 264,600. But you find that when the year ends, you find that you are demanding the company only 7,560. It means the company has paid salaries, those areas for the salaries. They have paid all of it, but now you are only demanding 7,560. But you were demanding this at the start of the year. They had not paid salaries for the entire year. You were demanding for that full year. When you add them, but you find yourself demanding only 760. That is a lively example of how you can understand this. Hope it helps. We've finished the salaries, and now we are going to look at the other operating expenses. I'm seeing the videos coming a bit wide, but we need this because we are understanding everything at once. But we are soon finishing. We are done with the salaries. We have now the employee benefits. We said the rule of thumb is we compare the activities and the amounts at the balance sheet or at the year end. Whether we have any balance that is not paid, we can now go to the employee benefit. We try to look at the balance sheet here, employee statutory benefit, statutory expense. If you have, since it is a payment, we are supposed to look on the credit side. So then the current liabilities, because it is a payment, if it wasn't paid, it is not there. So that one, it is an implication that for it was entirely paid. So we write nothing about it. We only record the figure as it is because everything was paid. We look at any other item. We have the next item is depreciation. We say the depreciation is a non-cash item. It is just a mere spreading of the cost of the asset over the estimated useful life of the asset. That one doesn't result in any cash movement, so it's not supposed to be. It's not supposed to be indicated anywhere in the direct method, but it will only be considered when we are using indirect method. So that one we can ignore. That one is supposed to be ignored. Then we look at the insurance, but let's first write this figure before we forget it. For employee statutory benefits, this one we just include it the way it is. There is no need for adjustment. Employee statutory expense. There is no need for working. It's a negative because cash is moving out of 29,340. You said depreciation, we ignore that one, even if you just keep it like that. Then insurance, we had insurance. No, we had sundry supplies. Do we have anything relating sundry? We have nothing here relating sundry. We also record that one because it has no adjustment in it. This is sundry expense. It's also negative, which is 8280. Now we have insurance. We have remained with insurance and advertisement. Check, we see whether we have adjustments for them. We check the current liabilities. We have prepaid insurance. What of the advertisement? The advertisements had nothing. So advertisements will also include it there. Include advertisement. So this which has a working for. Even advertisement was a negative 12,780. So we have to adjust for this because it has a payable, a prepayment. This is 4. So we need to copy this. Copy this. This 4 is now looking for insurance paid. Insurance paid, but we are getting it from the insurance payable account. It was prepaid insurance. Prepaid insurance, because it is the one that gives us the balances. As we said, we first know which account is it, then we know. So prepaid insurance, it is an asset account. You've seen it, it was presented under current assets. It is an asset account, which means that the opening balance should be on the debit side. The balance brought down should be on the debit side. Balance brought down should be on the debit side of this account, and the opening, the closing balance then should be on the credit side. The opening balance was 1980. Then the balance carried down is 1620. So if it is 1620, what it's supposed to be included here is what is in the income statement. So when you try to look at the income statement, what is in the income statement has been deducted, meaning it has been debited to the income statement. So we are supposed to credit it by saying profit and loss. Hope you can be able to understand. Profit and loss account, what we took there was 3780. When you've got that, we are able to get what should have been at the by adding this plus this. We get the balance. This figure is the one that is supposed to be taken. We copy it and we paste it here. Then we get the balance. Of course, the balance is going to be what we actually paid cash or bank. And the balancing figure, 3420. So this figure is what we are supposed to take to the other side, but it is going to come as a negative because we are paying off. It's supposed to be taken here, but it's a negative. Said it's a negative. It's a negative. Explanation for this is that we had a payable, which means we had some money. We had this in our, we had already paid this, but the expense that accrued for the year was 37. Since it was 37, and in that process we found that we are still having a balance of what we actually paid, because this is something that we paid, which we shall enjoy next year. Of 1.6, we remove it. This one is what we are going to be enjoying next year. So we must have paid this by cash from what we had, in a sense that we remained, in actual sense, we paid all of this, but the only expense we utilized was for only 3.3780. That's why we remained with all of this that we shall enjoy next year. That's the sense of that. That one is done. Then the next item online in that line of operation is now all the expenses are done. We've remained with tax and interest. Tax and interest, those ones, they are not part of the operations because they are supposed to be reducing our operations. We tax what we've got, or we tax the profit we've earned. So we need to first get the preliminary totals for that, and we see what we have. We deduct the tax and we pay off the interest, and we see what we shall be remaining with. Get now the cash flows, and the cash flows from operating activities can get a sum of all those figures, and we are seeing that we have a positive. When you add all those, you find that you have a positive 75780. So now we try to remove, to less interest, first of all, we less the tax. First, less interest before we pay the tax. But we now remove the only interest that is paid. Then the second item, of course, it will be the income tax, or the tax that we paid. These ones also need to go into workings. This will be working 6. This one is working 5, because we saw they have other things that are not paid. So go to our working 5 and copy this one. This is the interest paid. We are going to get it from the interest payable, which is there in the income statement, balance sheet interest. When you try to look at this question, you're seeing that the interest payable, we have the opening balance of this and this. So interest payable, it is also a liability account whose balance brought down will be on the credit side. Balance brought down is on the credit side, which is 4680, and the balance carried down will now come. Balance carried down will come on the debit side, which is 3960. 3960. Then we adjust it to the balance with the figure that is in the income statement. It was also deducted, meaning that this side it is going to be credited. Profit or loss account. The figure was 36,000 that we paid. If you get the totals, of this plus this, we'll be getting 4680. Copy this figure. So now what will be here is the cash, what we actually paid, cash or bank, and the variance is going to be 36720. This is what we actually paid. So when you copy this figure and you take it up there, all these figures are the ones we take are the balancing figures. This is negative 36720. Then we also do the income tax to also add balances. So we can pick up this here. This is number 6, which is now the income tax paid. We need to use the income tax payable. Also, its balance is going to be on the credit side since it is a liability account. This is the balance brought down. The balance brought down for that, the 520. Balance carried down to be 3420. So also the figure that is in the income statement was deducted from the income statement, meaning it was debited. We have to credit to the income tax payable account in reference to the profit and loss account, and the figure now is that was deducted there was 33,120. So when you sum these ones up, add this plus get this, you copy it and you paste it here. So the balance is what must have been paid, which is cash or bank, and the figure we have here is 32,220. And that 32,220 is supposed to be taken to the other figures and we adjust it at once. It's also negative 32,220. So we get now the net cash flows from operating activities, and we get the difference. So when you get that difference, you'll see that it's giving you 6840 as a negative, and that's the net cash flows from the whole operations or from the operating activities. So now, having done the biggest part of this computation, then we can look at now the second category of cash flows from investing activities. Here we said we mainly concentrate on long-term assets. The things we are supposed to include here are the assets we have acquired, the disposals we've made of those assets, the incomes maybe we received as dividends for investing in other businesses. Then we look at also the interest income that we've earned from other businesses that we are operating. Actually, the focus here is all about the non-current assets. If at all we have made anything, any investment somewhere, is what we are supposed to be following. So we try to look at the balance sheet under non-current assets and we see what we have there. So if you try to go to our sheet here and you look at the balance sheet, we look at the non-current assets only. We have land, buildings, and equipment. Those are the ones we have. So we start with the land. When you try to look at the land had 116 and 116 in the same years. It means it had the same amounts for all the 2 years. Hence, we had no any difference. And the implication is that we neither bought land or we neither sold land. Because if we had sold land, we are going to be recognizing income. But since we never sold land and we never acquired land by giving out cash to gain more land, it means here we record nothing. So we try now to look at the buildings. We are seeing the buildings. We had 79200 and 79200 as the cost. But if you try to look at the carrying amounts, they were different. Sorry, the accumulated depreciation, they were different. This one 38800, then which creates some mismatch. So we tried now to look at the buildings also add nothing, because maybe depreciated at different rates. Since the carrying amounts are the same, we may take it like nothing happened to them. But we try to look at the equipment. The equipment had a difference of 152, then the other one was 133. That difference, we need to know what caused the difference. When you compare the values in different years, we can see that there is an increase Of course, from 2012 to 2013, we are seeing there is an increase in the value for the equipment. But we need to make more analysis. Is the increase as a result of purchasing more equipment, or is the increase more of the revaluation? Remember, when they do these revaluations, you may find that these assets are going to be having a higher carrying amount. So when they are having these higher carrying amounts, remember these revaluations, those are non-cash items, which are not going to be accounted for within the cash flow statement. So we need to check whether we had the valuation gains or valuation losses anywhere in our financials. Because when we try to look at the income statement, we didn't see any revaluation loss, or even after the income, the net income, we have not seen the revaluation gain. Because if it was a gain, it was supposed to come after the net profit here, where we were supposed to be having other incomes and we have the revaluation gain. But since we don't have it here, and also because the revaluation gain, remember, it is taken to the OCI or other comprehensive statement of other comprehensive income, and also in the equity component under as a revaluation surplus. We are not seeing any revaluation surplus under equity component. So it means there was no revaluation. So the implication is here is that increase in the value of the asset was a result of additions. More assets were acquired, because that's going to be the only reason why we have an increase in the value of the assets. If it's not a revaluation gain, then it should be an addition of more assets. But an addition of more assets, it means we are giving out more cash to buy assets. So it's an outflow to the business. So we said we are going to record that as an addition or an acquisition of more item. We have acquisition of additional equipment, and this is going to be an outflow. We can do this with small computations here, where we can say that because we are going to be having the difference of 152,080 with less the 133,200. But to confirm that, you have to first make sure that there is no valuation gain or loss that has been incurred. Otherwise, if it was there, it may arise, which will give us 18,880 as a negative, meaning it's an outflow. So we said the other items would be a disposal of any asset. But now what you have to understand is that what we record here as in terms of the disposal, we recorded the disposal proceeds, what we actually got from selling the assets. We recorded the actual amount that we have received. We have also to check in the current assets to see whether there is any interest that has been received. Receive any interest income. There may be even dividends that we received, some dividends. But when you try to see in the income statement, nothing was showing us whether the company earned some interest, because it would have been added to the gross profit as other incomes, but nothing was there. So we can only conclude that that was the only item that was there, and we can take that same item to be our net cash flows. Net cash flows from investing activities as the same figure, negative 18880. We go to the last category, which is cash flows from financing activities. Cash flows from financing activities. Here we said we look at whether the company paid any dividends, whether the company issued more shares, whether the company received any loan, whether the company paid any loan. We look at the financing aspect, where the organization got the money to finance the operations of the business and other investing activities of the business. So we may start with the equity section, and we see, because with this equity section is what comprises of our share capital, the money we got from the shareholders. We try to look at the money we actually got from our own sources. in terms of maybe the retained earnings, the money we generated internally. We look at the money we got from loans when you go to the liability section. We go to the balance sheet section and we finalize this, because this is the last part of the question. It has been so long, but we are soon finishing. The equity section, we are seeing that there is an increase. Of course, from the balance sheet here, we are seeing that there is an increase. There is an increase in the share capital, which means that the company must have issued more shares to the public. And when they issue more shares to the public, it means that money, the company is going to be raising more money, which is supposed to be recorded as an inflow in the business, since the company is going to be acquiring more cash. But now, what we have seen here, yes, there is an increase. If you get that difference, there is an increase. But now, in other questions, you may find that maybe to record the proceeds of what actually they got from the shares. Let's try to look at the additional information that they have given us. They told us the company received payments from issue of shares. They received the total payment, meaning this total payment of 3.37.6 million was the payment they received in total, meaning, but it had a par value of 20 million. It doesn't mean that they received in total of 57 million, no. What this means is that they received 20 million, but they made also a premium of 17.6 million sold of the shares. So what this means is that whenever they give you, they may give you maybe the company issued shares with a par value of, let's say, 1,000, and they go ahead and say that the company made a premium or made a profit of, let's say, 200. That 200 is supposed to be added to the 10,000. Then you multiply by the number of shares that were issued to get the total proceeds. What we are supposed to include as our inflow is the total proceeds, or the total amount of money that was received or that was got by the company after selling the shares. If the shares were discounted, you make sure you record the exact amount the company received. That's what I wanted to highlight as far as these shares are concerned, because you may find that in other questions they may not give you the total money they received, and they give you in bits that we received this as per value. Per value is the nominal value. The nominal value is like shares have prices. A price of 1,000, a share of 1,000, its nominal rate is always 1,000. But if the has been sold at 1,500, we say that it has been sold at a premium. And that premium is supposed to be included when we are computing the amount that has been received. Even when it has been issued at a discount, we make sure we record the exact amount that the organization has received. That's basically what we wanted to go through, but this one was more direct. We just either take this, we either take that 37.6 million, or we just get the difference. Whichever you take will give you exact figures. We have issue, these are now proceeds from issue of shares. We said you may take the difference, or you may just take the other figure direct. 34 to 37.6 million. But remember, we are removing 3 zeros. We are working thousands, which is the same as someone saying 621,900 minus 584300. We didn't see any payment of dividend, but if we had, it would have came here. If you had any dividend paid, it would have came here. But you have the last item we saw, it was a repayment of a loan. That note one had a repayment of a loan mortgage But what you have to remember is that a loan installment includes the repayment of part of the principal and also the interest component. That's very important as far as computing the loan mortgage is concerned. They got a loan, and this loan was to finance, of course, the operations of the business. But now they are paying back. If you try to look at the question again, it says pay the loan installment of 3880 on this loan mortgage. We have to understand that a loan installment has two components. We have the interest and we have the loan principal, because when you are paying, they give you a lump sum amount you are supposed to be paying every month for the loan to get done in a given period of time. So that lump sum amount you are submitting every month, the bank converts it into two items. The main one, it is an interest component and the principal component. You are paying back of the money you actually borrowed, and you are paying the interest on top of that. But remember, we had already computed the interest. The interest we are paying in the operations, we computed it. So that interest we are paying, we charged it to the other side because it's an expense for using the money that they have given. Remember, this money is being used within the operations. That's why it has been deducted there. So what we are going to be reducing here is a loan principal. What we only need is a portion of the money we are paying back. Remember, we borrowed this loan. If let's say we borrowed 100 million, but every month we are paying 38 million, you find that part of the 38 million is reducing on the other 100 million we borrowed. So it means when we are paying back the loan we borrowed, we are paying back the principal. That principal is supposed to be recorded as an outflow of resources because it's no longer financing, but it's clearing the loan. That's what we actually do with so now we have to compute the amount that is supposed to be submitted as loan principal. So we can make that one as our loan repayment of the loan mortgage. Here we are not talking about interest, but or the loan principal. And now this one is going to be our working 7. This is the loan principal 8. We say the loan installment. The loan installment has two components. It has the principal amount as interest. The loan principal was 38. The loan principal was 38,880, which is equivalent to the loan principal, which we don't know. Let me call it P. But the interest we have already paid it out, and it was 36,720 from our computation where we computed. This is now I put here from working. This was working 5 where we computed the interest. So when you cross this the other side, we'll be having a loan principal. Loan principal will be 388 minus 36,720. This will give us 2160. That is the loan principal, 2160. This 2160, since we are paying, we are supposed to be reducing. It is an outflow. So it's supposed to be negative 2160. So that's all we had within the information that they have given us. So the next item is now to get the totals, the final totals for all those subtotals. Because if you get this, the net cash flows, because now these are going to be net cash flows from financing. Having got all these subtotals, then we can be able to get our cash and cash equivalents, net cash and cash equivalents by adding some of these net cash flows from all those three This is now going to be the net. The net either increase or decrease. So we get the totals here. It will be this. We add, can go upwards like this. We add that one. Then we also add this one. And this answer we've gotten here is what we call the net. Since it is a positive, it is a net increase. The net increase in cash and cash equivalent. Say the cash equivalent, those are the items that can be easily liquidified. We can easily convert them into cash. And then we add from what we've got from the entire operations and all the activities of the organization, we add now the cash equivalents, the opening balances. We add the opening balance of cash and cash equivalent. This was given in the balance sheet. If you try to check our balance sheet, it has that figure. And this figure is within the cash balance that we have at the beginning of the year, which is 66060. This figure. When we add what we've got up plus this one, we must be getting this. If we don't, then we just know we've made a mistake somewhere. So when we add this, it is 66060. To get our closing, this is the answer we've been looking for, closing balance of cash and cash equivalent. If we had an overdraft, was suppose we first add this one plus this one, we less that overdraft that we have, then the balance will be balancing automatically. So this one will be summation of this, and it will give us 89,460. And that 89,460 is the same figure that we have as the balance here. So which means we've done the right thing. Otherwise, that's it for today. It has been something that is a bit that's a bit long, but we make sure we get something and we'll be able to get some ideas of what we can be able to achieve. Maybe to give you some more lights is that IS7 is something that is frequently considered as number one, frequently, not must, in most of these papers that you see. If you don't find cash flows, group accounts, IS1, you find other numbers, but it's not a guarantee that those are the numbers that they bring. But according to the time we took, it's 3 hours, we've been doing one number. Those numbers that have the capacity of coming as number one, we make sure we analyze, we add in more time, adjust everything so that we can be able to learn each and every idea or aspect that may arise within the examination, and we get stuck. So that's all for today. Until we meet again, maybe we try to look at the different version of the indirect method, but we said it is only the operating activities that are changing, but the rest are the same. So the same way we hustled for these other operating activities, for these other activities, it is the same way we shall do with the indirect method. But one thing I want to add that will be coming in the next video is that we want to look at a situation where we are going to be looking at a question using an indirect method, but when we are not given the income statement, because here we were given everything. So we want to look at a very different aspect where we have only the bank statement, the balance sheet, and we don't have the income statement. We see what can we do if at all we have few statements. That's basically what we can do, because if they don't bring all of it, then they are supposed to give you one. And if you cover all those two aspects, then I hope that everyone will be good to go as far as IS7 is concerned. It's a bye for now. It has been long. Until we meet again.
Good evening, viewers. This is CPA ACCA, and today we are going to continue with our series on, and our topic for today is going to be IFRS 15, that is revenues from contracts with the customers. As we discussed earlier, that when we are looking at these IFRS, we try to get much about into the new standards that has been introduced, and this is one of the second standard that was introduced recently, and it was introduced starting first, it was effective 1st January 2018, and it replaced some of the standards as we are going to be seeing. So basically, before we dive in, allow me to take off my video so that you can be able to concentrate on the screen and be able to get the information as we are going to be seeing. We can now resume with our IFRS 15, that is revenue from contracts with the customers. As the standard suggests, we are going to be looking at some of the revenues that we are getting when we are engaging with the customers in terms of signing an agreement with different customers, whether they are going to be long-term or they are going to be short-term, as we are going to be seeing. But as far as the standard is concerned, we are going to have certain items or what we call the learning outcomes. If anyone is going to be watching this video on IFRS 15, these are the things that you are expected to get until you complete the whole video. One of the things we are going to talk about some of the terminologies that have been introduced. Remember, when these standards are replacing the old standards, it means that there are certain items that are going to be introduced within the coverage or within the scope. And we are, as our learning outcome one, we are going to be looking at the terminologies that are used within the IFRS 15. Secondly, we are going to look at the recognition, that is, how do we recognize that we are going to be having revenue? And that is basically some of the item that has been changed from the old standards, because the old standard used to recognize the revenue as when the risks and the rewards have been transferred to the person who is supposed to receive the revenue. But using this, or as per the new standard, we are going to look at the 5-step model that is going to help us understand how are we going to be recognizing that we have actually earned revenue from the contracts that we are going to be engaging with our customers. The third outcome is going to be the performance. We are now going to look at the performance obligations. These performance obligations, they are now the new terminologies that have been introduced as far as the upgrade of the standard are concerned. And we are going to look at how are we going to satisfy the performance obligation at a point in time or over time. If at all you are supposed to do certain kind of work, or you are required to do a number of tasks in the future, how are we going to be satisfying that? So the next one, we can look at some different or some types of contracts that are resulting into losses. There are those loss-making contracts. how do we account for them? Or how is the standard approach those contracts that are mainly resulting in losses, or when someone engages in those contracts? Then the other one, we are going to look at the contract modification. If the contract has been changed, there are certain items, if maybe the person was required to supply maybe 10 tons of, let's say, beans, and you find that the person is now required to supply maybe 15 tons. If the contract is going to be changing, then we need to know that is it resulting into a new contract, or it is going to not result into a new contract. Those are the things we are going to be looking at. Then finally, we shall look at how are we going to account for these contract costs. What are some of the costs that we are going to be capitalizing, and what are those that we are going to be expensing as far as the standard is concerned? So basically, that's what I expect, or that's what you should expect. By the end of this video, you will be able to learn and answer some of the queries that may arise as far as IFRS 15 revenues from contracts with the customers is concerned. So without wasting more time, let's kick off and try to look at the terminologies. What are some of the items that we need to know their specific definitions according to the new standard? We are saying that IFRS 15 revenues from contracts with customers replaced both IS 18 revenue and IS 11 construction contracts. And these were basically the 11, it was 11 from maybe the short-term contracts, but this IS 11 was all about those contracts that are going to be taking a long period of time, and their performance is going to be satisfied over time. So basically, this IFRS 15 combined those two standards, and it was effective commencing 1st January 2018. Remember, this is our second newest standard. The first one was IFRS 16 leases, which 1st January 2019, but this one was for 1st January 2018. What it means is that if you are to look at some of the numbers that we are going to be doing in this standard, it means that we are supposed to look at those questions that are going to be prior to 1st January 2018 up, then going forward. Because those questions that are going to be coming before 2018, they are going to be examined, or they were examined basing on the other standards that were replaced. So whenever you are doing some revision, make sure you are looking at numbers that are 2018 going forward. And we are saying that IFRS 15 sets out the rules for recognition of revenue based on the transfer of control to the customer from the entity supplying the goods. Here, what we are trying to mean is that there are certain recognition criteria or conditions that we are supposed to fulfill before we say that we have actually received the revenue. We are going to see those conditions as we progress through. For now, let's try to get some of the terminologies that are going to be used within the standard. Most of the key definitions that we need to know, one of them is control. And we are saying that control, this is defined as the ability to direct the use of and obtain substantially all the remaining benefits. If someone has a control over the asset, it means that person is able to derive all the benefits that are incorporated within the use of that asset. The person can direct where they are supposed to be employed, or where the items are going to be used and determine how much they are supposed to be getting from that without getting any interference from different stakeholders. Because you may find that someone says, I own a certain item, but in actual sense, the person cannot use maybe the asset as when there are certain restrictions. So if someone is controlling the asset, we are saying that you are able to direct the use or the purpose for that asset, and you are also able to get the benefits that are associated with the asset. That's basically what control is all about as far as the standard is concerned. The other one now we are going to look at is a contract asset. The word suggests it is an asset, but how is this arises to be an asset within this? Here we are saying that this is like an entitlement of the entity to receive a given amount of money upon certain conditions or after fulfilling certain conditions, and that's basically the performance of the activities. We are saying that this refers to an entity's right to consideration in exchange for goods and services that the entity has transferred to a customer when the right is conditioned on something other than passage of time. For example, an entity's future performance. What we are trying to look at here is that if actually the person has delivered certain items to a given customer, the company expects to receive a given amount of time, of money. The money it doesn't necessarily mean that if you transfer the goods and you satisfy the needs of the customer is supposed to pay you there and then. Since we are using accrual basis when you are preparing these financials, you may find that you may deliver or you may do the work now, or you may do the service, provide the service now, but the payments are going to be made in the future. Basically, we can look at an example. If let's say you have, maybe you are required to supply a given tons of coffee, maybe to a given company, and the company within the contract you've signed with that company, it stipulates that for you to start demanding payments, maybe you are supposed to deliver a certain kind of items. Maybe for you to start receiving the payment, you must have maybe submitted, let's say, 10 tons of coffee to that company for you to start receiving that money. But what will happen is that if at all you have not supplied those 10 tons to the company, you will not be entitled to any payment. So that's basically what we are trying to look at, that if the company does not supply as the condition states in the contract, then we are saying that the company is not going to receive the payment until it reaches the agreement that was signed in the contract. So if been supplying, maybe it has been some tons of coffee to the organization, and you find that they have actually supplying the goods, but they have not yet reached the minimum requirement for them to start receiving the payment. What it means is that they have already earned that money. It's like unaccrued income. It is money that has been earned, but you have not yet received it because you have not met certain criteria, which comes in as an asset. That's basically what we are trying to talk about when we look at the contract asset. Maybe the other example you may look at is if, let's say, the company has got a contract and it's supposed to supply maybe 200, maybe it is supposed to supply 500 computers as the full contract. The company has got to supply 500 computers. But you find that within the contract maybe you may find that the contract says for you to start receiving the money or the first installment of the amount, you must have supplied maybe 250 or 50% of the total supply. You are supposed to supply 500 in total, but for you to start receiving the money, there is a minimum supply you must have made for you to start receiving the deposits. And if it reaches a time and you want to get the money, but you have not yet supplied half of the quantity that is needed, you may find that you will not be able to get, but the money is there, you have worked for it, it is just that you have not actually earned it since you have not yet met the condition. That's basically what the contract is, the contract asset is all about. The other one we can look at is a contract liability. A contract liability is just the opposite of contract asset. And how do these contract liabilities arise? This happens if, let's say, the one has received the money before supplying the goods or the services that is supposed to be supplied. Maybe you have your contract, and maybe the contract is to supply 500 computers, and you find that before even you supply any item, they have actually given you some money before you start supplying the computers to the organization. What will happen is that you have actually received that money, but you have not yet worked for that money. It means it is going to be a liability. It becomes a liability to you is that because it creates an obligation that you are supposed to deliver for the money you actually received. That's why when you find that if you receive money and you have not yet actually worked for it, you find that in the financials, we remove that money because that money doesn't belong to the financial we are supposed to be incorporating. So that's basically what I can talk about in brief as far as the standard is concerned. Then the other item we may look at is a standalone selling price. A standalone selling price, as the word suggests, it's a standalone selling price, meaning something, the price that belongs to a certain item. But what happens in contract arrangement is that sometimes these goods and services, they are supplied in a group. You may find that the company is delivering certain items at a given price when they are in a group. But for the standard selling price we are look at, what will be the price of each item that has been included in the group? If at all that item can be sold on its own, or that item can function on its own, then we assign a value on those goods. But mostly what happens in these contract arrangements is that sometimes these goods are sold in bundles. You can talk about maybe this multi-choice, the DSTV. You find that these DSTV guys, they sell their decoders and the dishes plus a 1 month subscription that is free, but it is incorporated within the cost of the dish and the decoder. So by the time the person acquires or buys that decoder and that dish, that person is also entitled to a 1 month subscription that is free upon paying the whole amount. You may find that maybe they are selling the dish maybe they are selling it at 180, but you find that when you buy it and they install that dish, you may find that you are going to find a 1 month subscription that has been paid. But what we are trying to look at here within the standalone selling price is that what is the price of the subscription that you have that is incorporated within the cost or the total contract cost. And what will be the cost of the dishes plus the decoders if at all someone wants to buy those items? We're saying that the standalone selling price, sometimes we find goods that are sold in group or in bundles. We've talked about these DSTV where they sell to you the item, and after selling to you the item, they give you a 1 month free of the 1 month subscription on top of the amount you have, on top of buying the dishes. Then the other one, we may look at these telecommunication companies. If you are to, maybe if you want to buy their data bundles and minutes, you find that you may go and try to discuss what are some of the things they can offer to you if at all you want to subscribe maybe for a 1 month or a 1 year subscription for maybe the data or minutes. You may find that in the proposal they may say that if at all you are going to be paying this and this amount, we are going to give you the monthly data or the quarterly data plus maybe giving you these headsets or the handsets that you can be using for making calls. And that thing they may give it to you for free upon purchasing the monthly data or the quarterly data, whichever arrangement that they are suggesting. But what this standard suggests is that if you are to look at what will be the cost of those handsets they are going to give to you, and what will be the cost of the monthly data when someone is not going to be given a free handset. So basically that's what we are trying to look at as far as the standalone selling price is concerned. We are saying that even if something has been given to you for free, we have to determine what is the cost, so long as that item can function on its own and someone can buy, or it can result in a performance obligation. Someone can buy that item and use that item separately. Then we need to determine the cost of that item separately. That's basically how we can describe the selling price, the standalone selling price. We can resume to determining. We try to look at the recognition of revenue. We said when this is mostly the item that has been introduced, that is a bit different from what you use to account for the revenue. And we are saying that when you are recognizing revenue, there are 5 steps, or there is a 5-step model that we are supposed to go through before we recognize that we have actually received the revenue. So when all these conditions, these 5 steps are fulfilled, we can now say that we have actually earned revenue. One is that we are going to be looking at the 1-step model. The first one is identify the contract with the customer. Identifying the contract with the customer. Here we are trying to look at what are some of the indicators that you have a contract, or what shows that you have a contract with the customer. If someone says, I have an engagement or I have a contract with that customer, what can we use to say that we actually have a contract with the customer? These are some of the items that we look at, and we tell that the person has actually a contract with the customer. One, we are saying that the parties have approved the contract and they are committed to carrying it out. If you have gone into an agreement and all the parties have agreed, they have actually agreed to do whichever kind of task that has been agreed upon by the 2 parties, then we have it gives us a brief information that at least these people are going to be having a contract, which means that either side of the either side of the parties, the two parties to the contract, they are committed to carrying out the contract they have actually signed. But if you find that one of the parties is not willing to do the needful or to do what they are supposed to do as far as their contract is concerned, then we can't say that we have a contract with a customer. Then the second one we are talking about that is each party's right regarding the goods and services to be transferred can be identified. And when you're talking about these parties, the parties to the contract, if maybe they are dealing in buying and selling, because that's mainly the things that we always do, is that we are supposed to be having these parties may include the buyer and the seller. If those parties, their rights, what they are supposed to do towards the contract is known. One of the things, the buyers has a right to receive the goods. If I have actually ordered for some goods, then I expect you to be delivering the goods to me as the buyer. And upon delivering those goods, we expect that even the buyer has a responsibility to pay the seller, meaning the seller has a right to receive payments for the goods they have actually supplied to the buyer. So that's what we mean by saying that each party's right regarding the goods and services to be transferred can be identified. The buyer has a right to pay, and the seller has a right to receive the payment. Then the third item is that the payment terms for the goods and services can be identified. If you can't identify, remember these items we are going to be looking at, you should be able to attach a value on certain items that you are going to be seeing. We are seeing that if at all the person, the buyer and the seller, they have agreed maybe to supply certain items to a given person, we must be able to know that which payment modes are those guys going to be using. Are they going to take these goods on credit? Are they going to be paying by cash? Are they going to be making partial payments? Or they are going to be using benefits in kind? You give me this, I give you the other one, in terms of a barter system like that. So we should be able to know, actually know the payment terms for the goods that we are going to be supplying to each other. Then the other one is that the contract has a commercial substance. Something to have a commercial substance, it means that the contract must be giving rise to the monetary benefits. At least we expect that there must be an outflow of cash. If maybe you are just transferring the item, it is maybe a parent to a subsidiary, then when there is no monetary transactions that are going to be taking place, then we don't expect that to be called revenue or to be recognized as revenue. So it means we are not having a contract with any person, because there is nothing like any monetary benefit that's going to arise from both of the parties. Then the other condition is that it is probable that the entity will collect the consideration to which it will be entitled to. What we are looking at here is that the company can be able to collect the money for the goods they have actually supplied to a certain customer. If I'm the seller and I'm giving out the goods to maybe a given retailer in a given location, we are expecting that it should be probable. And we said if something is probable, it means something it is beyond 50%. The chances of the person receiving the money or recovering the money for the goods they have supplied is more than 50%. Then the other one is the last one, as far as identifying the contract with the customer is concerned, as our first step model, we are saying that the contract can be written, verbal, or implied. What we are trying to look at here is that there are some instances whereby some contracts are not going to be written down. or you are not going to be having any agreement. If let's say you are going to maybe to a shop and you wanted to buy maybe a phone, you go there, you negotiate the price. After accepting the price, you pay the money. It means the contract was there, but it was verbally. The verbal communication you made when you are agreeing on the price or when you are bargaining for the price is actually a contract. So it is not necessarily that these contracts are supposed to be written or they are supposed to be formally or formal, they are supposed to be written in any kind of documentation. But what happens within companies is that most of the time we may be having written agreements, and sometimes they may be even implied. And we are saying if something is implied, we may take a scenario. If let's say you're a company and you are dealing in transport services, we expect that these customers or the people you are transporting, by the time they enter into maybe the transport network, if let's say you are using a road, by the time they sit in your taxi or by the time they enter the bus, you find that there is no need for you to ask them that are you going to pay at the end of or are you going to pay for the transport fare? Because by the time the person enters and sits, we expect that that one is going to be a passenger. There is no document that you need to write with that person to confirm that you are going to receive the money. At the time the person sits, we expect that the person is going to pay the money without even asking. That's also a contract, but it is an implied contract. Then the other one is the one which is very common, the written one. You get the document, you sign the document. Mostly in these loan arrangements, you find these banks, you find they have a written document. Either you agree with it or you don't agree. But most of the time, they give you their contract. Most of the time, it may not be an agreement, because an agreement is something you bring an issue. I say that one I want it, the other one I don't want it. But let's say it is in the bank, they give you their loan application, you just fill in. It is a contract. It's more. It is not. It's a kind of one-sided agreement that it is the company that present to you what they offer. Then it's you to choose whether you are taking or you are not taking. By default, when you sign, you have actually agreed to whatever kind of information that are embedded within the agreement. So that's one of the fastest step. The first step of the 5-step model that we go through so that we can be able to recognize revenue. Then let's try to look at the second step, and these conditions were examined in May 2019, question 3, Roman 1, question 3A, Roman 1. So you may cross-check and try to get to understand those points. Then the second one, we are going to be looking at, the second one is to identify the separate performance obligations. We've been talking about performance obligations. You have an obligation to do this. You have an obligation to do this. Or you have something to fulfill. Something is pending and you need to sort it out. So now what are we trying to look at here? We are trying to look at what does the seller, now we are now concentrating on the side of the seller, because it is the seller who is going to be fulfilling the obligation. If maybe I have bought a phone and that phone is supposed to be upon when I've paid as a customer, when I pay, you are expected to give me maybe the rest of the things that are supposed to be incorporated within the asset. Maybe you may give me the item, or I may buy it. And since we had an agreement, you find that I have taken it, but I found it was not working, then it will be the person to do the maintenance or to provide me with the new one, depending on the warranty agreement that may be incorporated or embedded within the agreement. So we are trying to look at what does the seller has to offer to the buyer in terms of fulfilling the performance obligation. What are you going to be delivering to the customer? If I'm the seller and we are saying that the performance obligation is a promise in a contract with the customer to transfer to the customer, either now these are the things that we transfer to the, or the things that we deliver to our customers upon fulfilling the terms that are within the contracts. One, we are saying that it may be a good or a service, or they may be a band of goods or services. But the condition is that those goods are going to be distinct. And they are going to be distinct words. That's one of the words that we are going to be emphasizing on. And we are saying something to be distinct is that that item is going to be, it can be sold separately, or it can work on its own. If we say I'm buying a phone, but when I buy that phone, I find that that phone has a charger inside. It may happen that some customers, they may come and they say, maybe me, I want a charger only. I have a phone, but I just want to buy a charger. Can function on its own, and it has a value. Someone can go and buy it as a unit. And we are saying it may be a good, it may be a service, or they may be just in a bundle, as we said, that maybe these items are coming at once. If maybe someone is paying tuition, when you are paying tuition, you pay a single sum, a lump sum amount of money for tuition. But you find that with that tuition, you are provided with the reading materials. You are provided with maybe revisions, and you are provided with even the lectures. But those items are coming at once. They are coming in a bundle or in a batch. So that's one of the items that the seller may deliver in order to perform or to fulfill a performance obligation. Secondly, we are saying a series of distinct goods. Remember, we are saying these goods are supposed to be distinct. These items can be distinguished, not these items that where one cannot function on its own and you start calling them distinct. There may be a series of distinct goods or services that are substantially the same and that have the same pattern or transfer to the customer. You may find that maybe the company has been delivering, maybe the company is engaging, let's say, is providing security. It is a security company and it is providing security services. But it has been providing those security services for a given period of time. That's basically what we are looking at when we say a series of distinct goods and services that are substantially the same and that have the same pattern of transfer to the customer. You may find that the person has been providing security services, the company has been providing security services on a continuous basis. It has been giving that company for years and years. Maybe the company has been giving cleaning services, and those cleaning services, they are given out at the same amount over a given period of time. So they may be a series or it may be a single item. We are saying that a good or a service is distinct if it is sold separately or if it could be sold separately because it has a distinct function and a distinct profit margin. What this means is that for something to be called distinct, it must, first of all, it should be having a value. That if I'm to sell this item, I will sell it at this amount, and when I sell this item, I'm getting a profit component of this. That's basically what we are meaning by talking about the distinct. So we look at the third step. We said there are 5. It is a 5-step model. We've seen 2. And the third one is to determine the transaction price. And now when we are looking at the transaction price, we are saying it's all about determining how much the customer is going to pay the seller. Remember, in the second one, we've been looking at what are the items that the seller is going to be delivering to the customer. But in the third step, we are looking at how much is the buyer going to pay the seller for the amount of goods and services that the person has actually received. And we are saying that the transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange for transferring goods or services. We are saying that for us to determine the transaction price, it doesn't mean that the person is supposed to pay us there and then. We may be having, the money may come at a later date, and we shall see how are we going to be treating all that amounts that are going to be coming in at a later date. So that's basically the third step. We are looking at the amount the customer is going to pay to the seller. And now the customer is only going to pay. Remember, the customer cannot pay when you have not actually fulfilled. But we first know the amount, then we know how much the person is going to pay after fulfilling the. Then the fourth one is looking at the allocation, or we try to allocate the transaction price to the performance obligation. Here, when we are trying to look at how we are going to be allocating the transaction price to the performance obligation. Remember, the transaction price is going to be the amount the buyer is going to pay to the seller. But the seller has an obligation to transfer the goods, of which those goods, they are the ones that are going to result in the price. And we are saying that when a contract contains more than one distinct performance obligation, a company allocates a transaction price to a separate performance obligation in proportion to the standalone selling price of the goods and services. So this is basically, if maybe we've been saying that these goods are supposed, most of the times the goods are delivered in batches. So if these goods are delivered in batches, then how are we going to be apportioning the consideration we've actually received towards those items? Because we said that even if you receive these items, some of the items for free, we are supposed, so long as those items can result in performance obligation, we are supposed to allocate a price to them. I've been giving you the example that if, let's say, DSTV is giving these dishes at maybe 180 as the price, but when someone buys the DSTV, that person will receive a 1-month subscription that is free, but it is inclusive. But remember, each monthly subscription has its own price that is separate from the cost of the dishes. So even if someone pays 180 as a single unit for both the dish and the subscription, the monthly subscription, we have to determine what is the proportion of those two items that we've actually received on top of the money that the customers paid. If you have paid 180, but maybe the dish was maybe, if someone is to take the dish alone, is supposed to pay this and this amount. Maybe you can try to look at some of the very lively example, because you may find that in the dish arrangement, those DSTVs, for them, when they are selling, they sell them at once. Everything is intact. They can't separate, but each has its own value. That's what we are trying to mean. But if you are trying to look at a very clear example, we may look at is if we are paying for these professional courses, maybe CPA. If you're studying CPA, you are paying each amount of money to study this CPA. Maybe you are paying, let's say, $50 or whichever amount. Maybe you are paying $50 for each paper. Maybe to study financial reporting at a given college, wherever you'll be attending from. But that $50 you are paying is inclusive of the reading materials, and at the same time includes even the revision classes, and at the same time it includes even the normal classes that you are going to receive as lectures. But there may be scenarios whereby you may find that there is a customer who there may be a student who may come and say that me, I'm not going to be attending classes. I want only revisions. How much am I going to be paying? In proportion to the total $50 that someone pays when the person is going to acquire all the service. That's basically what we are looking at when you are saying that we allocate or we apportion the transaction price, the amount we have received from the buyer, to the performance obligation. So that's basically what we are saying in that. Let's try to look at the third, the last step when we are recognizing our revenue. And this last one is by far the most important step. We are saying that we recognize the revenue when or as a performance obligation is satisfied. This is very important because we've said that you are going to look at scenarios in exam past papers that maybe a person is required, they had a contract, and on that contract, before even they supplied anything, they gave them a deposit or a down payment. But that down payment, you have actually received that money, but you have not yet worked for it. It means that money, we can't recognize it as revenue in that very financial period because we have not worked for that money. So we are saying revenue should only be recognized when or as the performance obligation is satisfied. If, let's say, the contract was to supply 10 computers, at the point you have actually supplied the computers to the customer, so long as the customer has accepted the goods, of course, we are going to be seeing how do you tell that the customer is satisfied? Because you may take the goods and the person says, these are not the right quality I wanted. So we're not expected to get the money. So we are going to also look at some indicators as we shall see. But what we are trying to look at here is that when you have supplied the items and the customer has accepted the items, whether the person pays there and then or whether the person doesn't pay, it means you recognize the revenue there and then, because we are using accrual basis, that we recognize cash, not necessarily when, we recognize the revenue, not necessarily when cash has been received or has been paid. So that's basically what we can look at. But what you should know, we are saying that the entity satisfies the performance obligation by transferring control of promised goods. Remember, we started by looking for the term, for the meaning of the word control. If someone has control over something, it means the person can direct whatever they want to use or whatever they want to do with the asset, and they are able to get all the benefits that are associated with the asset. And we are saying the person or the seller is going to transfer the control of the promised goods or service to the customer. A performance obligation can be satisfied at a point in time, or such as when the goods are delivered to the customer, or over time. Basically, what we are looking at here, we are going to look at some of these performance obligation. What do we mean by performance obligation satisfied at a point in time and over time? At a point in time, let's say I was supposed to transfer 10 million to someone's bank account, maybe in US, and I have actually transferred the money. If I can do that there and then, it means I have done that at a point in time. But if the performance obligation, I'm going to satisfy that over time, it means that this performance obligation is going to be existing for a long period of time. Some of these These are the contracts, those long-term contracts. Maybe it is a construction company and they have got a tender to construct maybe roads. You may find that those roads are going to take a very long period of time to be completed. So its performance is going to be there in stages. We'll be looking at the stages of completion, at different stages of completion, and we'll be receiving different amounts according to what we have actually completed. So we are going to look at these items in details, but that's basically what step 5 is very important. We don't recognize money when you have not satisfied the obligation or when you have not fulfilled the contract. We have an example here, but that one we shall look at it at a later date, because this is basically the computations of what we've been talking about. But I wanted to first do away with these items. Then let's try to look at these performance obligations and we try to look at them in details. We are saying that performance obligations satisfied at a point in time. We are saying that a performance obligation satisfied at a point in time, at the point at which the customer obtains control of the promised asset and the entity satisfies the performance obligation. At the point when you have transferred the item, if maybe the person bought a car from abroad, and that person is supposed to be, the car is supposed to be imported from wherever it's supposed to be imported and supposed to be delivered or transported to the buyer's place. By the time it reaches the buyer's place, then we can now say that we've actually satisfied the obligation. So let's try to look at what are some of the indicators or what shows that we've actually transferred the control. It's now we've been owning a certain item, but now we've actually transferred the item to a different owner. One, we are saying that the entity has a present right to pay for the asset. Of course, what we are looking at here is that if the person has actually received the goods, then the person is required to pay us because we've done what the person wanted. So that's one of the items, and we are saying that when goods are delivered to the customer, then the entity will be entitled to receive the payment. By the time you receive the payment, it means you have actually transferred the ownership, or you've transferred the right or the control. Secondly, we can talk about the customer has legal title to the asset. If maybe we've been selling in old items, maybe motor vehicles, but we still have those land titles in the name of our company. Maybe if you have been selling land and we have different plots of land, at the point when we transfer those titles to the name of to the names of the customer, then it means we have actually transferred the control, meaning the person can do anything on that land because the land now belongs to that person. We are saying that the customer is now owning the item upon delivery. If at all you have given the land title to the person, it means the person can now do anything they want. They can even sell it for anything they want. Then the third one we can look at is that the entity has transferred the physical possession of the asset. Self-explanatory, we are saying that there is someone says that we've actually transferred the land title in the names of the buyer, but when the buyer has not actually received the land title. So when we actually transfer the land title into the names of the buyer, and we actually give the land title to the buyer, it means that the person is now fully in control of the asset. The fourth one, we can look at that the significant risks of ownership, risks and rewards of ownership have been transferred to the customer. There are certain items which I need to classify as far as this point is concerned. When we are talking about the significant risks, we say that if maybe I've been holding the item, maybe you've been paying the item on hire purchase. I've not given you the item. I'm still having the item. And by the time I transfer the asset to you, the risks, some of the risks may arise. One of the risks we may find that at the end of the day, that land title, someone may steal that land title when you are the one with it. By the time they steal it from you, it means me, I've already lost the control. You can't demand me because I gave you the control. If you lose the title, it means the risk is on you. Then in terms of the rewards, as far as land is concerned, you may find that I have bought land, let's say 20 million. But by the time you make the transfer and you give me all my documents, the land has increased in value. And it is now the land which I bought at 20 million, it's now costing 25 million. That difference or that increment in the price because of maybe inflation and market forces of demand and supply, whichever causes the price to rise, has made me to benefit. At the end of the day, I paid less money, but right now, if I'm to revalue the asset, I'm getting a lot of money. So those are the benefits and the risks that are associated with the transferring ownership. Then the last one, we have that the customer has accepted the asset. This is very key because you may say that the customer has paid the money, and we have delivered the goods, but the customer reaches there and says, man, these are the quantities I wanted, or these are not the qualities I wanted. Take them back and bring for me others. I did not order for this. But if the customer, with what you provided, or what you have actually provided, satisfy the customer's demands, then we say that the person is now entitled to giving you the money. And from there, we are saying that the performance obligation has been fulfilled. There is one simulation that we may look at, August 2019 question 2B, but this, I'm not going to go through the questions. It's better we first handle these theoretical aspects. When we deal with them, we can be able to recap and get more clarity as we are going to be doing the computations. Then let's look at with the performance obligation that has been satisfied at a point in time, at a given point in time. But now we are satisfying the performance obligation over time. Over time, that these are long-term satisfactions that have been given a long-term contract. Maybe I'm to construct a road, and that road is going to take maybe 5 years to its completion. What will happen? I will not need to wait until 5 years for me to start receiving payments, because you may find by the time I started the operation, I also needed to be having some money to be used in operating there, to be used as working capital to cater for the day-to-day operations that are going to be existing within the process. So by the time we look at this, you should realize that at a certain point, we are going to be receiving different amounts at different stages. You may find that someone has been given a contract, maybe to construct a flat, but maybe the person has now constructed. You may find that in the contract, the person is supposed to receive payment maybe when they have completed the first floor. And you find that by the time they complete the first floor, they can request for the money. That is at a certain stage of completion. By the time they reach to the third floor, they have received part of the money. So how do we deal with such transactions where we are going to be receiving money at a different stages of completion? We are saying that a performance obligation is satisfied over time if it entered into more than one accounting period. Something that goes above one accounting period or 1 year, it means it's something that is going to take long. We are saying in this type of contract, an entity offers an enforceable right to payment for performance completed to date. You are not going to wait until you complete the building for you to receive the payments. When you do something, you can ask for a portion. These are the things that are happening maybe for those construction companies, those that are to work. You find that they are receiving money at a different stage, depending on how their contract is arranged. And actually, this other standard was looking at, because this, remember, this is combined standards. It means that this was the ISE concerning about the construction contracts, those long-term items. But now the new IFRS 15 mixed it, and we are looking at it as something that is a one-off item. So we said that we are going to be receiving money at a different stage of completion. But how are we going to be determining the stage of, because not at every stage that you are going to be asking the money. If, let's say, maybe you are supposed to construct a house and you finish the foundation level, then you start asking for money. You may find that in the contract they have specified that if you are to ask the money, you must have reached somewhere. And for you to make sure that you have reached somewhere, it means they are going to be having some certified work. You find that for this point in time, we've actually certified that we have completed this. Certified work means something that has been completed. Maybe the engineers have confirmed that at least we have done this. We are saying we have approaches that we use to determine the stage of completion. One, we have the revenue approach, and how we determine the stage of completion using the revenue approach, we are looking at the work certified to date, or the actual work we have actually completed to date over the total contract revenue, we multiply by 100. That will give us a percentage of what we have completed. You may find that if it is 50%, it means you have done 50% of the work. Because what you have done, the worker certified or the worker done is half of the total contract revenue. So it means that will determine how much someone can give you. If, let's say, the total contract was for 10 million and you have actually done 50%, someone may say that I'm going to give you 40%. When you complete another level, I give you another one. Then the other one is the physical units approach. Here we are looking at if these items, they are now not measured. They are not measured according to the work done. They are measured in units. If maybe you are required to produce 10,000 units and you have so far produced maybe 5,000, then what is the percentage of that, of what you completed vis-a-vis what you are supposed to complete? Then we are saying the stage of completion using the physical units approach is the units completed to date over the total contract units multiplied by 100 to get for us the percentage. Then the other approach, which is the last one, is the cost approach. When you are looking at this cost approach, we are looking at how much have you incurred in terms of the costs? How much have you incurred in terms of the cost vis-a-vis the estimated cost that you are supposed to incur at the end of the operation? The stage of completion now will be the cost incurred to date minus the closing stock. This closing stock may be in terms of the materials that you have not actually used. If, let's say, you budgeted that, no, when you are constructing this building, it will consume this much of the material. But you find that when you have completed maybe the first floor, you find that some of the materials are still available. So you list those materials and you divide by the total estimated cost, the whole estimated cost for the contract. Then you multiply by 100. Those are basically the ways we determine the stage of completion of how we can be able to use and get to know how much we can ask from the person who has given us the contract. That's basically how we can determine that. Allow me go take you through to some of the contract asset. We'll try to look at how do we determine the contract asset or the contract liability. Because some of these things are going to result, either we are going to be having a contract asset or we are going to be having a contract liability. So how do we determine those ones? We are saying that a contract that span for more than one accounting period. Now we are looking at how are we going to be determining the contract asset or the contract liabilities for those long-term contracts that are delivered in more than one accounting period? We are saying as the contracts that span for more than or that go for more than one accounting period, we are saying about these contract assets and liabilities. We are going to be seeing the amount that you are going to be recognizing, and we see how we are going to be computing. We are saying we have the actual cost that we have incurred to date. We add the recognized profits, if there is any recognized profit. Of course, if you have not recognized the profit, it means we are going to be recognizing losses. Losses, we are supposed to be deducting them, but the profit, we are supposed to add it back. Of course, what will happen with this is that if you have actually incurred 10 million, but the amount that you are receiving is maybe 12 million, you find that you have maybe a profit, and that profit is what we are talking about. This one is more or less of how we are going to be getting our sales minus the expenses, what we have incurred. If there is a loss, you less it. Then we have the receivables, the amount invoiced. We said that at certain point, you are going to be asking for money at different stage of completion. So if you are going to be asking for money at different stage of completion, it means that even these amounts you have actually received, we are supposed to less them off so that we'll be able to get what is not yet received. Then when you less that, you are supposed to be either getting a contract asset or a contract liability. And a contract asset, these figures are going to be taken to the statement of financial position. Either they are going to be an obligation or they are going to be an asset. But remember, since we are dealing with these long-term things, then they may be going in terms of the long-term assets or the long-term liabilities. There is an example there, but we shall look at those ones later. Let's try to look at these contracts. These are basically the contracts that are resulting in losses. When you are actually making losses, you are engaging the contracts, but you are actually making losses. And how do we ascertain these losses? We are saying that once a loss is ascertained, it must be recognized in the statement of financial position as an expense. But the contract revenue must be limited to the stage of completion. You may find that at a given stage of completion, what you have actually incurred is more than what you have got. There we are supposed to be recognizing those losses as an expense. Those are very brief ideas, but we are going to be looking at them when you are doing the computations. That's when you'll be able to understand most of them. Let's try to look at the second last point, and we'll call it a day. It's all about the contract modification. We try to look at a contract modification, and we are in this, when you are looking at the contract modification, one of the things we are going to emphasize here is that we are going to be looking at a scenario that results in a change in a contract. There are certain transactions that may happen and may lead to the cancellation of the first contract, and you start adopting a new contract. There are other items that are going to be treated as they are not separate contracts. If maybe the person has been delivering 10,000 tons of coffee at the same place, but now they have changed the contract. Instead of delivering 10,000, it's going to be delivering 15 at the same place. I don't think there we shall be need to modify the terms of the contract. What we shall only do is to increase the value, because the amount has remained the same. They're supposed to be delivering at the same place. So we want to look at some of these contracts that are going to be resulting as changing the contract or treating the contract as the same. We are saying that a contract modification is a change in the scope or price or both. In the scope, we are talking about the terms and conditions that are within the contract, or it may be change of the price. If the price changes, of course, you need to draft another contract, or they may be both. The contracts are changing and the prices are changing of a contract that is approved by the parties to the contract. if you have actually agreed to the changes, then you can redefine and or remodify, and you get a new contract that can be able to incorporate all the changes in the terms. We are saying that a contract modification exists when the parties to a contract approve a modification that either creates new or changes the existing enforceable right and obligations of the parties to the contract. These contracts, we said, there must be resulting either in a new contract or they are creating changes in an existing contract. We said if the terms are not changing, if the places are not changing, but what actually changes is maybe the location. You are supposed to deliver the 10,000 tons, but instead of taking them maybe to Kenya, you are supposed to take them to Tanzania. But the rest are the same. And you agree that I can do that maybe at the same cost. Then there is no need of drafting a new contract. But there is a scenario whereby the people, you were supposed to transfer maybe 10,000 tons to Kenya, and now they are telling you take them to South Sudan, and even the costs are going to be changing, and the terms are going to be changing, everything is changing. So it will lead us to creating a new contract. We are saying, how are we going to be accounting for this contract modification when you have a separate contract? We are saying that contract modification represents a separate contract. That's what we are going to look at. We are saying that certain contract modifications are treated as separate new contracts. For those modifications, the accounting for the original contract is not affected by the modifications, and the revenue recognized to date on the original contract is not adjusted. Furthermore, any performance obligation remaining under the contract continue to be accounted for under the original contract. Then let's try to look at what are some of the criteria that we are going to be following. We are saying that an entity shall account for a contract modification as a separate contract if both the following conditions are present. Remember, all the two, they are supposed to be present, not one. If one is present and the other one is not, it means we can't recognize it as a separate contract. One, we are saying that the scope of the contract increases because of the addition of the promised goods and services that are distinct. We are saying that if the terms of the agreement are going to be changing because we are adding in some additional items, we may be adding, we've been delivering coffee and now we are going to be delivering coffee and beans. We are adding another item. Then the other one is the price of the contract increases by an amount of a consideration that reflects the entity's standalone selling price of additional promised goods and services. And remember, those additional items, they are coming in with their different prices. Then we try to look at the contract modification where it is not a separate contract. What it means is that the same contract is going to be prevailing for all. One, we are saying that if a contract modification is not accounted for as a separate contract, an entity shall account for the promised goods or services not yet transferred at the date of the contract modification in whichever of the following ways. In whichever of the following ways is applicable. One, we are saying that an entity shall account for contract modification as if it were termination of an existing contract and the creation of new contract. If the remaining goods or services are distinct from the goods transferred on or before the date of contract modification. You have been transferring beans, but now they are telling you to transfer coffee. Those are different items. Secondly, we are saying that an entity shall account for contract modification as if it were part of the existing contract if the remaining goods or services are not distinct and therefore form part of a single performance obligation that is partially satisfied at the date of the contract modification. The entity would just update the transaction price and measure progress for the single performance obligation. This one we shall have a number, which is May 2019. Question 3. We said we are considering questions that are above in 2008, because that's when the standard was introduced. So this is our last part, and we are going to be looking at how are we going to be accounting for the contract costs, and we are looking at what the standard guide has on the costs that we should capitalize and the costs that we should expense. What are some of the costs that we are going to be expensing, and what are some of the costs that we are going to be capitalizing? Capitalizing means we are adding to the value of the contract. One, we are saying that the incremental costs of obtaining a contract. What happens here is that in a contract arrangement, we incur certain costs. Maybe we've got some brokers that have helped us maybe to acquire this deal. Remember, when you are selling this, maybe it was through a bid arrangement, and we've incurred some costs to those brokers that helped us to get the contract. It means that these costs are going to be directly attributable to the contract. It means that these incremental costs, the reason why they are saying incremental is because they are just increasing the cost of the contract, or they have incurred in addition to acquire. If they had not incurred them, they wouldn't acquire the contract. So if all those costs are going to be added to the cost of the contract, and they are supposed to be treated as an asset, meaning treating them as an asset is like we are capitalizing them, such as we have the sales commission recognized as an asset if the entity expects to recover these costs. Because at the end of the day, when you get this contract, those costs, you are going to put them, and when you're putting these costs, it means when someone, part of the money that is going to be for the contract plus the costs you've actually incurred. So long as you can recover those costs, then you are supposed to capitalize them. And we are saying that these costs that would not have been incurred had that individual contract not been obtained. Because these are some of the costs that if we don't incur them, we are not going to obtain the contract. And we are saying under IFRS 15, these costs are capitalized or recognized as an asset and amortized over the useful life of the contract if they are expected to be recovered from customer. I have incurred the cost when I'm inquiring about the possible customers that are going to come in to get the contract. But if at all I can recover that money from the customer, then I need to capitalize them. Then the other one, we can talk about the cost that would have been incurred regardless of whether the contract was obtained, or then we have these other costs that even if you have not acquired the contract, these costs you are going to incur them. It means they are not relevant to the contract, but for them they are supposed to be paid there and then. If maybe you have staffs, these staffs you are paying them commission or you are paying them salary, whether they have made a sale or they have not made a sale, you are paying them. So if you are paying them, it means that even if they don't sell, you will actually pay them. So those ones, they are supposed to be expensed because like they are normal costs that are incurred in the business operation. Then we have costs that are incurred in fulfilling the contract, unless within the scope of another standard. Because what we are looking at in these standards, we are saying that these standards shouldn't override each other. If some costs are accounted for under different standards, then we are not supposed to account for them if those costs are treated in a different standard, such as IS2 inventory, IS16 PPE, IS38 intangible assets, because we may be having these some of these items, and we have them. But there are some of the criterias, because we are saying that there may be costs that are directly related to unidentifiable contract, such as labor, material, management costs, and others. The costs are expected to be recovered. That's a very big point, that if you have to recover those costs, and those costs they are directly attributed to the asset, then they are supposed to be capitalized. And when you are capitalizing them, it means of course after capitalizing, we go ahead and amortize. We get the amortization which we are going to be taking into our financials. After amortizing, they are capitalized and we amortize them over the contract period. Then we have costs that's more or less the same. They are consistent with the transfer, the custom of goods and services, with the asset index. But we have this, however, general and administrative costs that are not explicitly chargeable to the customer, and the costs of wasted material, labor, that were not reflected in the price of the contract are expensed. These are some of the things, but what you should understand is that most of these items that are not going to be capitalized, they are going to be expensed as and when they are incurred. So what you should have to understand is that the costs that are directly attributed to the cost, and those costs are going to be recovered, then they are supposed to be capitalized. The rest are supposed to be expensed, so long as they are related to the contract and they are not among the category that is going to be capitalized. That's basically what we can see. One of the things that we are left in this standard, as far as the standard is concerned, is doing the computations, and we try to get the whole idea after doing the computation. Those are coming in the preceding videos that are going to be coming in. Make sure you subscribe, share, comment, and send also to others to have a benefit, and also be able to improve our learning. Because by the time you subscribe to this channel, it means you are going to be notified. You subscribe, you ring the notification bell, so that you'll be able to receive whatever updates or whatever videos we are going to be uploading as far as accounting is concerned. Because this is not mainly CPA, but there are other professions like ACCA. People are going to use these materials, and they are going to be help them do well in their exams. So thank you for watching, and never to subscribe.
Morning viewers, this is your tutor CPA ACCA, and today we are going to be proceeding with our series with financial reporting, and we are going to be looking at IFRS 16 leases. And allow me take off my video so that you can be able to concentrate. We are saying that when you are looking at these standards, we've completed so many standards so far, but today we wanted to look at some of our new standards within financial reporting, and this is IFRS 16. It is a new standard which was effective in January 2019. And when you look at a new standard, when it is coming in, just note it has replaced some of the standards, and we are seeing that IFRS 16, that is the leases, replaced A17, where we used to account for these leases. But when this new standard came in, there are certain items that are being changed, as we are going to be looking at them, and you are going to be seeing what are the upgrades that were made as far as accounting for leases is concerned. Basically, what we are going to be looking at in this video is how do we understand when someone says we are going to be talking about leases. What are leases? In terms of the definition, we are going to look at how we account leases and what are some of the parties that are involved within the lease agreement or transaction. We are going to be seeing how each of these parties are going to be accounting for the leases in their perspective, and we look at the recognition. We said when you're looking at the recognition, those are the conditions that are supposed to be met before we say that you have a lease. Then when you look at that, we can also look at the measurement. Having recognized that you are going to be having leases, how are we going to measure, or which costs are we going to assign to these items as we are incorporating them into our financials? Having looked at the measures or the measurement basis, we shall also look at the recognition exemptions. What are some of the leases that are out of the scope of the IO, or that are not supposed to be accounted for, as we are going to be seeing? What are some of the recognition exemptions that are given to some kind of leases or some kind of lease arrangements? And we are going to be looking at the last part will be around the lease sale and lease back. If at all you have been owning an asset and you have sold it out, but after selling it out, you realize that you need that asset back and then you lease it again. How are we going to be handling certain items, or how are we going to be accounting for those transactions? Then maybe the last bit of it will be the lease modifications, if at all some of the items within the lease agreement are going to be changing. Maybe if the payments, they were supposed to be paid at a certain date, and now instead of paying at a certain date, they have been either increased or the period has been reduced. All of that we shall be seeing them when we are doing the lease modifications. Without wasting more time, let's kick off and we see how we are going to be accounting for these leases for the start. And we are saying that IFRS 16 leases replaced IAS 17, and it was effective 1st January 2019. And we are looking at this as a new standard that was introduced in, because it is one of the, by far it is one of the newest standard. The second one was IFRS 15, that was living from contracts with customers. That was the second newest, but this one is the recent one that replaced the IAS 17. Previously, in IAS 17, we used to account for leases and we categorize them into the operating and the finance leases, as we are going to be seeing. But when these amendments were done, when you are accounting for certain items, you may find that we are going to be eliminating all that. So basically, if you are to have any trial number, make sure it is above the 1st January 2019, because the previous computations or questions were based on the IAS 17, which was replaced. So if it was replaced, it means the questions that are set below 2019, they are going to be basing on the old standard. So you take note of that when we are reading or when you are getting some questions from different question banks. So we are saying under this new standard, leases, the parties. One, we have the lessor, that is the person who owns the asset, and we have a lessee, depending on whichever pronunciation you are going to be going with. But one of the party is the person who is owning actually the asset, and we have the lessee, who is the person that is just who is just obtaining the right to use the asset, or is the one who leases the asset. And when we are talking about these leases, mainly we are talking about these long-term assets that can a useful life that exceeds 2 years. Because if you are talking about these leases, however much they are divided into different types, as we are going to be looking at them. But when you are trying to look at these leases, we are trying to look at some of the non-current assets that can at least stay for more than a long period of time. So let's try to look at the definition wise. What are leases? And we are saying a lease is a contract or part of a contract that conveys or transfers the right to use an asset for a period of time in exchange for what we are looking at here is that when you're talking about these leases, they are just an agreement between the person who has the asset and the person who is going to be using the asset. So we expect that the leasee is going to be acquiring the right to use that asset over a given period of time. The given period of time may not necessarily be the whole useful life of the asset, but it may be for a given period of time. And that person is going to be paying a certain amount of money, either on a monthly basis, either annual basis, or quarterly basis, depending on the agreement that has been made between the lessee and the lessor. So that's basically what you should know about the leases. It is a contract or part of a contract that conveys or transfers the right to use an asset for a period of time in exchange for consideration, meaning that the other person may not actually take the ownership of the asset. He may be using the asset for a short period of time, for a long period of time, but at the end of the day, that person is making a certain amount of money, or what we call a contribution. That's the amount you are paying for you to acquire that right of using someone's asset. When we proceed, we can try to look at, we are saying IFRS 16 states that a customer has a right to direct the use of an identified asset if either, so these are basically some of the criteria that we use for someone to make a decision that a person has a right to an asset, or when a lease is existing. We expect that if the person has leased out some assets, we expect that for us to be sure that they have actually leased out the asset, we look at some of the two criteria. One, we are saying that they obtain substantially all the economic benefits from the use of the asset, meaning if you have actually leased out the asset, you are able to get whatever, or to generate whatever income you wanted to get out of the leasing of the item. If, let's say, you have leased out the asset, you have acquired the asset, maybe to manufacture certain items, we expect that you are going to be delivering those benefits after you have actually leased out, after you have leased the assets. The second criteria is that the customer has a right to direct how and for what purpose the asset is used throughout the period of use. Here, what we mean is that if actually you have acquired a right to use the asset, it means you are responsible for what you are going to be doing with that asset. If at all the asset is leased and you have acquired the right to use that asset, you should put it to any purpose you want. No one should make a decision that you are supposed to do A, B, C, D with the asset we've actually given to you. But that should be within the time, or should be within the lease period. The lease period is actually the duration of the lease. If you have actually acquired the asset and the asset is going to be with that person for maybe for 5 years, for 10 years. That's basically what we are meaning. That when you have acquired the right to use the asset, you are supposed to determine whatever purpose you are going to be doing with the asset. Those are basically the criteria that we could base on to say that the person has actually acquired the right to use a given asset. So when we proceed, we are trying to look at how do we account for leases in the books of the lessees. The person who have actually acquired the right to use someone's asset for a given period of time. How is that person going to be treating that asset they have acquired within their financial, when they are preparing their financial statements? Of course, you know, when you have actually leased out when you have leased the asset, it means you have not actually bought the asset, but you have just acquired the right to use that asset for a given period of time. So how are we going to be accounting for these for these assets that we have acquired under a lease arrangement? And basically this is what we are going to be looking at, or this is our main focus as far as the standard is concerned. Because basically when you look at the side of the person who the owner of the actual owner or the lessor, you find that for him is going to be receiving maybe different amounts at a different date. We are going to look at how the lessee is going to account for the assets they have leased, and we are going to also to look at how are we going to be accounting for the lease in the books of the lessor or the person who actually giving out the right to another person. But our main focus, as far as the standard is concerned, we are based on the books of the lessee. That's the person who is actually acquiring the right to use the asset. Basically, what we are going to look at, how is the standard? What are the criteria that are set by the standard on how we are going to be accounting for these leases in the books of the lessee? We are saying IFRS 16 abolished the distinction between an operating lease and a finance lease in the financial statements of the lessee. That previously these leases, they were using the IS 17, they were categorized between the operating leases and the finance leases. But when this new modification was done, IFRS 16 abolished the distinction, how different we used to differentiate these leases into the operating leases and the finance leases. And when this new standard came in, we are now combining all the leases in the books of the lessee. We account for them as they are all the same. So basically, when you are talking about the accounting for the leases by the lessee, we are looking at how the person who has acquired the right at the initial stage of, or at the initial recognition, when you have just acquired the right to use the asset, how are you going to be recording those assets that you have acquired? And we are saying that initial recognition, actually when you have just acquired the asset, we are saying at the commencement of a lease, the lessee accounts for two items. We have two items that the lessee accounts for as far as the standard is concerned, and one, the lessee is supposed to account for the right of use asset. The right of use asset is actually the asset or the value of the asset in use. The actual asset the person has acquired the right to use. So basically, when you're talking about the right of use asset, we have certain items that we are going to be accounting for as far as the acquisition of those leases are concerned. From when you're acquiring any asset, we are looking at what are some of the costs that are going to be associated within that process of acquiring that asset. Are they going to be capitalized, or some of them are going to be ignored? So basically, it is the same way we used to value these non-current assets under different standards, that will incorporate all the direct costs that are attributed to bringing in the asset to its operation. And here we are looking, when you are looking at the rights of use asset, we are trying to look at what are some of the costs that are associated with the acquisition of that right to use a given asset. And basically, we are not talking about the cost we have actually paid. It's not only the cost that we have actually paid to acquire the right that we are going to be accounting for. There are other costs that we've incurred, as we are going to be saying. So we have certain items that are supposed to be accounted for as far as the asset in use is concerned. One, we have any initial direct costs that are incurred by the lessee. And here we are looking at some of those costs that are directly attributed to the contract. If maybe you have paid certain brokers, you have paid commission to brokers that have helped you to acquire that right, then it's supposed to be added back to the cost of, or to the amount you have actually paid in the contract. So it is one of the direct costs that are attributed to the lease, and they are supposed to be combined so that we can be able to get the cost we have actually incurred to acquire the right of using a given asset. The second item is any payment that has been made to the lessor at or before the commencement date of the lease. There are certain costs. If basically you want to acquire, let's say you wanted to acquire a given asset on a lease arrangement, you may find that there are so many factors that you are going to be encountering on the way to acquire the right to use a given asset. Because first of all, you are not going to be the only person that is looking at acquiring the right of a given asset. There are so many people who are going to come in. You may find that you are required to pay a certain amount earlier before you actually sign the contract, the actual contract. You may find that you have actually paid certain amount, and by the time you go to sign the contract, you have actually incurred some costs. It happens, like you may find if let's say you've been using the asset, and that asset, maybe the lease term is now expiring. By the time you say that I want to renew this contract, most of the time was people pay even before the contract expires, so that by the time the contract expires, they have already acquired, or they have already secured their possession within the bid to acquire another lease term. So if you have paid any amount before signing the contract, then it's supposed to be added to the actual cost you are going to pay after signing the contract. Then the other item we are going to be looking at is any lease incentive that has been received by the lessee. If let's say you have received certain amount of money from let's say the lessor, you may find that by the time you are acquiring maybe a given asset, if let's say you are going to be acquiring, or maybe if you are going to be hiring or leasing a given warehouse, you may find that you need to design the house or the warehouse to the extent that to a standard that you see it is going to be better for the operations you are going to be incorporating in. And it may happen that you may tell maybe the person who is giving you the warehouse, and you find that the person cannot modify or do the necessary repairs to make sure that the asset looks exactly as how you want it to be. You may find that the person who is giving you the right to use that warehouse may ask you to pay a certain amount of money, maybe to renovate the warehouse to reach the standard that you want. And by the time you come to sign the agreement, you'll find that the house has already been renovated, but they have actually used your own money. It means that money is going to be deducted from the costs that you are going to be incurring when you are actually signing the contract. So if you have made certain amount of money before, and that money is going to be refunded back to you at the time of signing the contract, then it's supposed to be less. The other incentive we may talk about, let's say you've got a discount, you may find that the person is supposed to give you maybe the lease amount is supposed to be maybe 10 million, and you find that the person is saying, instead of giving me the 10 million, that you just give me this, maybe 8, and you find that that 2 million that you've been exempted, we are supposed to less it from the costs you have actually incurred, so that we can be able to incorporate in the actual figures that you have actually incurred. Then the other one is a lease liability. This lease liability, we are going to look at it, but basically lease liability is actually an obligation that you are going to pay a certain amount of money in the future. Because when you're looking at these leases by the lessee, the lessee accounts for 2 items. That person will account for right to use or right of use asset, that is the actual asset in use, and the lease liability. If at all you are going to be making some partial payment, and the money, the other that are going to be, you are going to be submitting them at a later date. Those are their items at the initial recognition. But this lease liability is inclusive or is included within the that is within the cost of the right of use asset, because it is part of the money, it is part of the consideration to acquire the right to use the asset. It is within the components that are making up the right of use asset. And the last one is going to be the estimated cost of dismantling and restoring the sites. This one we shall look at it in details, but what you have to understand as far as this is concerned is basically that these costs that we incur, if let's say you are going to be using maybe land, you are going to be leasing out land, you'll find that at the end of the useful life of your lease term, you'll be to restore the site or to make sure that you maintain the site as the way you found it before you acquired the lease, or before you acquired the right to start operating on a certain ground. This is mainly in the mining and oil drilling. You find that these people, when they're removing the minerals, they are disorganizing the land. And by the time they remove their minerals, or by the time their contract expires, you find that the surface is disorganized. So what will happen is that you will incur certain costs at the end of the useful life of the contract, or at the end of the lease term, to make sure that you maintain the level of the land to the extent that it looks exactly how you found it before you started the operations. So if there are those costs that we estimate that maybe in the future we are going to be incurring these costs to make sure that we are organizing the land how we found it, then we shall also incorporate them
within the cost of the right we have acquired. And when you sum up all those, excluding the incentives, then you will be able to get the right of use asset. That's basically at the initial recognition. That's what the lessee accounts for. The second item that the lessee accounts for is the lease liability. This one we spoke about it, but maybe to add more on that is that a lease liability, this comprises of all payments outstanding or not yet paid at the commencement date, but they are discounted to their present value using the interest rate in the lease or any incremental borrowing rate. Here, what we are trying to look at is that since these costs are going to be paid in the future, if you want to incorporate them within the cost, we have to discount them to get their present worth now. And the only way we can do that is by using any given discount rate that will be stated in the question. That is basically what it is supposed to account for at the initial recognition when you have just acquired the right to use the asset. Then we try to look at subsequently now at the reporting date. The other one was initial measurement, what we actually include when you have just acquired the right to use the asset. But what are some of the things, or how are we going to be accounting for these two items, the right of use asset or the actual asset in use and the lease liability at the end of the year? Which figures are we going to be incorporating into our balance sheet and all that, balance sheet and financial statements? Because the figures we've been talking about, they are at a point when you have just acquired the right at the commencement. But now, when the year ends, we have to report items at the end of the year. So what are the figures that we are going to be incorporating in our financials as far as the right of use asset and the liability still in the books of the lessee? And we are saying that for the right of use asset, that is the actual asset in use, we are saying that subsequently the lessee shall measure the right of use asset using the cost model under IS 16 PPE or property, plant and equipment. What do we mean by saying we are going to be using the cost model as the same way we in IS 16 PPE? What we are meaning here is that we are going to be depreciating, of course, because if you are looking for the figures that you are going to be including in our financials, we are looking at what are some of the expenses that are going to be incurred on the right of use asset that are going to be included in the profit and loss. Then the balance is what we are going to be taking to our balance sheet. And now we are saying that when you are depreciating these assets, we depreciate it in two ways. One, we use the straight line, but basically when we're in this right of use asset, we depreciate it in a sense that the useful life you are going to be using of that asset should be based on two factors. One, if at all the asset is going to be sold at the end of the useful life of the at the end of the lease term. If at all the lessee is going to acquire the ownership of that asset at the end of the lease term, if the person is not going to acquire the ownership or is not going to buy that very asset, then we depreciate that asset over the shorter of either the lease term or the useful life. If the person is not going to acquire the asset at the end of the lease term, we compare the lease term
and the useful life of the asset. And we take whichever is lower or whichever is shorter of the two. If maybe you find that the useful life of the asset is 10 years, but the person has leased the asset for 5 years, if at the end of the 5 years, the person is not going to buy that asset, then we take, when you are calculating the depreciation of that asset, we take the shorter, which is 5 years as the lease term. But if the person is going to buy the asset at the end of the lease term, what we consider is that we are going to asset using its useful life. Because the implication is that if at all the person is going to acquire that asset, even though the person has a lease of, let's say, 5 years, and the useful life of the asset is 10 years, it means that the person is going to be the actual owner, or the person is going to use that asset for the whole 10 years. So it doesn't make any sense to depreciate the asset using the lease term, yet the person is going to stay with the item until it reaches its useful life. Because even if there are these buildings, you find that the building has maybe a useful life maybe of 15 years. And you find that the person is going to use that warehouse maybe the person has leased that warehouse maybe for 5 years. You find that those 5 years will elapse, and yet the asset is still having more 10 years to reach its useful life. So if the person is not going to acquire the asset at the end of the lease term, then we expect that the asset is going to be depreciated using the shorter of either the lease term and the useful life. But if the person is going to acquire the asset at the end of the lease term, then we don't care about the shorter of the two. We just take the useful life of the asset. That's basically one of the ways we can subsequently measure or account for the right of use asset. Then the other way is by the leasee can also apply the IS 40 investment property. If at all the asset is an investment property, and we use the fair value model. Because as from the IS 40 investment property, we say that subsequently the investment accounted for, or they're measured at fair value. So we use the fair value model, or we may use the revaluation model. We may use the revaluation model under IS 16, but basically, as far as the standard is concerned, most of the times we use the cost model to value these right of use asset. So that's basically what we use to value these right of use asset using the cost model. And we said that when we are using the cost model, we take the cost, we less the depreciation, so that we can be able to get the carrying amount that is going to be taken to the balance sheet, and the depreciation will be taken to the income statement. But how do we compute the depreciation? Is by either comparing whether the person is going to buy the asset at the end of the lease term, or the person is not going to buy the asset at the end of the lease term. If the person is not going to buy the asset at the end of the lease term, we take the shorter of the useful life and the lease term. Secondly, if the person is going to buy the asset at the end of the lease term, we take the useful life to determine the depreciation. So that's how basically we account for the right of use asset, or the actual asset in use. And the third note is going to be on how do we now subsequently account for the lease liability. Remember, we said the lease liability is going to be, initially is going to be discounted, and we'll get its present worth. After getting the present value of that asset, of that future sum you are going to be paying in the future, that was at the initial measurement. or at recognition. But what figures are we going to be taking as a lease liability in the balance sheet or at the end of the year? What we are saying is that a lease liability will be amortized over the lease term, and we split the financial costs or the interest. And when we split the interest, then the remaining debt is going to be the lease liability, and that lease liability is what we shall be taking to the balance sheet, but we compare the financial cost or the interest and we take it to the income statement. Basically, what we are looking at is we are just spreading the all that present value we've got to the useful life of the lease. If the lease term was maybe 5 years, we spread that lease liability over the 5 years. We get the component of interest and the component that is going to be actually on the point of the lease amount. Because what will happen in lease when the money is going to come in the future, it means if the money is coming in the future, the person will charge you more amount than actually what you are going to be paying right now. Because you may find that by the time you pay that money in the future, maybe inflation will be there and the money will lose its value. So that's basically why we convert it to determine its present worth, and we also try to separate what are some of the components that we are relating to the finance or the financing cost. But basically in the financing cost, we are interested about the interest component. So that's basically what we are going to be looking at. And we are saying if there is a change in the lease term, lease rate, or anything else, then the lease liability must be remeasured to reflect all the changes. This is what we shall look at under the lease modifications, if at all there are changes that are going to be made within, maybe the lease is going to be adjusted, the amount you are going to be paying is going to be adjusted depending on, because if you adjust the period, it means you have to adjust the amount someone was going to pay, maybe on a monthly basis, annual basis, depending on how the contracting suggests. So if that happens, then it means we have to redefine or remeasure the lease liability. That's basically what we shall look at when we go to the lease modification. Let's try to look at what are some of the recognition exemptions. We said under these recognition exemptions that there are some leases, some types of leases that are not required to go through all these steps when we are accounting. If maybe the lessee acquires these leases, we account for them differently. The person is not supposed to account for the right, the use asset, the lease liability, and they are basically in two types. They are all this is only two exemptions, and we have one is leases with the lease term of 12 months, that's 1 year or less than, with no purchase option. If at all the lessee leases these assets for less than a year or for 1 year, and the person has no option of buying at the end of the lease term, then we can only through the other routine way we do when we are accounting for these other leases. Then the second one is the underlying assets have low value when they are new. Basically what happens is that the standard doesn't disclose what do they actually mean when they're talking about assets of low value. But basically when you're trying to check these assets, they are talking about the asset which is below, or something which is below $5,000. At least you may say that is low asset, and maybe some of the examples we may talk about the computers, these personal computers, maybe some furniture, these small items. Those items are not supposed to go through the previous ways we've seen how we account for these leases. But the question is, if at all those assets are not going to be going through that procedure of accounting for a rights of use asset and the lease liability, then how are we going to be accounting for them? And we are saying that for the above leases, lease payment will be recognized on a straight line basis over the lease term. Meaning what we do for these, we the costs over the lease term. If the lease term is 1 year, we divide the cost we are incurring, we divide by 12 to get what we are going to be paying every month. That's how basically we account for that under the books of the lessee. But now, having seen how we account for those leases under the books of the lessee, or the person that is acquiring a right to use the asset, let's also try to look at how are we going to be accounting for these leases in the books of the lessor, or the person who actually owns the assets. If you try to look at the books of the lessor, we are trying to recognize that since this person is also going to, first of all, is going to lose the assets, since the assets are going to be given out. Secondly, we are seeing that the person is also going to be receiving some money upon giving out these assets. So how is that person going to be reporting, or how is the person going to do to prepare those financials? And we are saying that here the lessor continues to classify leases between finance and operating leases. This is basically what the old standard was talking about. What the old standard was giving is actually being brought to the books of the lessor. And we are saying that for the lessor, in the books of this person is going to classify these leases between finance and operating leases. Finance leases, those are actually, these are the leases that are going to take almost the useful life of the asset. If the person is leasing these items for more years, more or less taking all the useful life of the asset, and the person is going to be, at the end of the day, you may find that the person may actually take, or may actually buy the asset at the end of the lease term. Let's say the asset had a useful life of 10 years, but the person is leasing this asset maybe for 8 years. And at the end of the 8 years, the person is willing to buy the asset. Those are basically the assets that are going to be within the financing lease. Then the other operating lease, those are the leases that are taking lesser period. If maybe the useful life of the asset is let's say 10 years, but the person is leasing for that asset maybe for 2 years or 1 year. And at the end of the day, the person is not going to buy these assets at the end of the lease term. So what we are basically saying here is that the lessor will continue to separate or classify these leases into finance and operating leases. And we said is a lease that substantially transfers all the risks and rewards incidental to the ownership of the underlying assets to the lessee. If they are talking about these risks and rewards, mainly if a person is acquiring a given asset, there are some risks that are associated. If at all I sell to you a given item or an asset, there are certain risks, maybe theft, they may steal the property. If maybe you lease maybe a truck, and you find at the end of the day they may steal the car. That's a risk, because you are actually the owner of the asset, meaning we've transferred everything, all the risks and the rewards. And maybe in these rewards we may find that at the point of transfer, or when I have actually transferred my asset to you, you may find that this asset, it may increase in value, and you end up, you paid less money, but the asset gained more value in the market. And if you are to sell that asset at that time, you find that you are going to be making profit. Those are maybe the rewards, the way you can talk about the rewards, meaning we've actually transferred all the risks and the rewards incidental to the ownership of the underlying asset to the lessee, meaning it's like the lessee has given up all the asset. So if it is to account for leases in the books of the lessee, it means the lessee is going to separate these assets into the finance and the operating. So if it is a finance lease, how is the lessee going to account for it? Because one, we've actually seen that the person is going to give up the ownership of the asset. So if the person is giving up the ownership of the asset, it means the person is also going to derecognize the asset, because the asset is no longer belonging to that person and it will be belonging to the other one. So if it is an operating lease, it means the person is going to be continuing to record the asset in his or her books, because the person still has the ownership other than the finance lease. So maybe to try to clarify more on the finance leases, we try to look at what are some of the examples of situations that indicate that a lease is a finance lease. One, we are saying that the lease transfers ownership of the asset by the end of the lease term. That's what we've been communicating, that at the end of the lease term, the person is going to be the owner of that asset. Secondly, we are saying that the lessee has the option to buy or to purchase the asset at the price that is lower than its fair value at the date the option becomes exercisable. What this means is that you may find that the person you have actually leased the item may be for, let's say the lease asset is for 10 years and the person has gotten for, the lease term is for 8 years. But within the contract, someone suggests that at the end of the day, you may buy this asset if at all the lease term ends and you feel that you want to be using the asset. So it means that even the other 2 years that are going to be remaining to the useful life of the asset, you may find that this person will be charged less compared to what the person would have paid if they are to buy off the asset. Thirdly, we are saying that the lease term is for major part of the economic life of the asset, even if the title is not transferred. What this means is that if someone leases, if maybe the asset has a useful life of 10 years and the person leases that asset for 9 years, it's like the person has actually bought the asset. Because at the end of the day, even if you don't sell that asset to that person, it means by the time the person leaves the asset or the person ceases to have a right of using the asset, it will also be very old. At the end of the day, if it is a car, you may find that maybe it has gone now to it has actually lost value, and you can't even modify it, and you can't even use it. It's like the person has almost bought the asset.
because if the useful life is 10 years and the person has released the asset for 9 years, it means the person is actually bought the asset. Then the fourth point we can look at is that at the inception or at the commencement of the lease, the present value of the lease payment amounts to subsequently all of the fair value of the leased asset. If maybe the asset you are leasing out, if you are to put it in the market now, you find that the value they are going to give you under the lease arrangement is almost the same value that they are going to be giving you at the point if we are to sell it now. That's basically this point is meaning that here at the point of commencement of the lease, if the present value of the lease payment, remember the present value of the lease payment, we said that is the lease liability. Because that lease liability, how it gets to be the present value, it means we have actually discounted it and we got its present worth. If that amount is equal to the amount that the asset can fetch in the market, if at all it's going to be sold, is the same, you find that the asset is actually being sold out, or which gives rise to, or which is one of the indication that we have a finance lease. You find that the person has given you more or less the same amount that you can acquire from the market if you are to sell it out. The last one, maybe we can look at the leased asset of such a specialized nature that only the lessee can use them without major modifications. What this point means is that if at all you have an asset and that asset is specifically for certain items or specifically for producing certain items, and if at all the person leases it out, even if they have not bought it, by the time their lease term ends and they leave you with that asset, you can't use it for anything. And since you can't even use it for anything, and secondly, you can't even modify it, at least to be doing another kind of work. So it means it's like the asset has been sold out, meaning it will be one of the indicators that we have a financial lease. That's basically what we can talk about as far as the financial lease is concerned. But let's look at what are some of the criteria that we are going to be following when we are accounting for these financial leases. Remember, we said in the books of the lessor, these leases are separated within the finance and the operating. So we are now looking at how are we going to be accounting for finance leases in the books of the lessor. That is, basically we start with the initial measurement at the commencement of the lease term. Which values are we going to be recording in our financials? We are saying at the commencement of the lease term, the lessor derecognizes the underlying asset and recognizes a lease receivable in the statement of financial position. What will happen is that if this asset has been leased out or more or less sold out, because at the end of the day, the person will have an option to buy the asset. You will find that this person ceases to be the owner of the asset. Remember, here we are in the books of the owner. If the person has given it out in terms of financial lease arrangement, it means the person ceases to be the owner. So if you cease to be the owner, then you have to derecognize the asset or to write it off from the assets you have. But upon the recognition of those assets, we are recognizing the lease amount or the money, the lump sum amount that you are going to be receiving
after selling or after giving out this asset. What happens is that when you are receiving these, they come as a lease receivables. We don't actually receive cash, because by the time you go into a lease arrangement, it doesn't mean that they are going to give you cash there and then. So what we do, when we are crediting the PPE, if maybe the asset was a PPE, when we are writing it off, of course, when you are writing it off, it was debited. So when we are writing it off, we credit it, and then we debit lease receivables. Here we are not debiting cash or bank, because we are not receiving cash at once. We are now recognizing lease receivables. They may take the asset and then they pay us later. So we are saying that the lease receivable equates to the amount not received at the commencement date, but that amount is supposed to be discounted to its present worth. Remember when we said that when you are receiving this money, it's not only the money that you have actually sold the asset is the amount you are going to be receiving. There are other indirect costs that may come along. Maybe if at all, because if even the person who is selling these assets may also incur certain costs. They have paid some commission to brokers to look for these people who are going to buy the asset. So when they have incurred those costs, they will also combine with what the buyer is going to give to them. So the lease receivable is going to be a combination of the initial indirect costs, sorry, the initial direct costs that are associated with the selling of the asset. But basically, what the amount the person is going to be paying in the future will be discounted, and we get the present worth, so that we can be able to incorporate in the figures. Then, if at all we are going to be initially recording that as a derecognition of the asset and a recognition of a lease receivable, then what will happen at the end of the year, that is now at the subsequent measurement, what are we going to be recognizing at the end of the year? What we are going to be recognizing, the ledger should recognize finance income in the profit and loss account. This profit and loss account is going to be the lease receivable. Remember, we are reporting, or we are preparing these accounts on an accrual basis. Whether we've received that amount or we have not received it, at the end of the date will come. So we take the lease receivable to the profit and loss. That is one. Then the second thing, we are supposed also to reduce that lease receivable by the money that we are going to be receiving, or that we have actually received by the end of the year. Because if you sign the contract, they may give you some part of the money, and when they give you the money, of course, you debit the bank account or the cash. You debit the bank account by the cash you have received, and you credit the lease receivable, because now the part of the money has been received. So you have to reduce the lease receivables. And that lease receivable, the remaining, is what will be taken to the profit, to the balance sheet. Of course, we recognize the income. Then let's look at how are we going to be accounting for the operating leases. The operating leases by the lessor. Mainly, you can talk about these leases, even if you don't call them assets. It may even happen in these football matches and football players. You find that the person has been given out to a certain club on a loan. And on a loan, they may be having an option to buy the player at the end of the loan period. And the other way, you may find that the person is actually buying the player. And you find that at the end of the day, the club is paying certain amount, even at the point when they have actually bought the player. When you look at the likes of Eden Hazard, they bought the player from Chelsea, but at the end of the day, they are remitting some money at the end of each year. Or at the end, there are certain terms that were fixed within the contract, and you find that the club is still paying some money on top of the money they actually paid. You find that the person has the club has paid money, but there are some top-ups they keep making depending on different achievements that the player is going to bring to the new club. So those are basically some of the things you can talk about. If it is an operating lease, you find that maybe the person has gone for a lease, and after the lease, the person will go back. So it means the other club will be accounting for the player. These people, they are only counting for the right. They are just using for that short period of time. We are saying that the lessor keeps recognizing the leased asset in his statement of financial position. The reason why the lessor is now recording this asset is because the asset has not been sold. But what will happen is that when you account that you still have the asset, on top of having the asset, it means you are also going to be accounting for the income you are going to be receiving as a lease income from leasing out that operating lease. And we are saying that the lease income from the operating lease is recognized as an income on a straight line basis over the lease term. This is also an amortization of the lease amount over the lease term. That's basically there. There is an example here, but we are not going to go through the example right now. Let's maybe talk about a sale and lease back transaction. What will happen is that you may find that the company needs maybe to have certain amount of money, but the company cannot actually, or it has looked maybe for other ways of getting this money, but it has not yet got ways. But you find that the company had the assets. If maybe the company has the assets and these non-current assets are there, but they actually need cash, what they can do, actually this sale and lease back is one of the most commonly used financing tool. You find that the person sells out the asset and again lease that asset back. It is a sale and lease back. And how does it happen? It happens in a sense that has these, if maybe the company has many non-current assets and it wants to get some cash, maybe to push the operation of the business, and they have maybe tried to get money from different sources. But so what they can do, they can sell off some of these assets. When they sell these assets, the other party, then what they do, the other party will give them cash. But after receiving this cash, they use some of the money they have actually received to lease out, meaning that the person who was now a lessor will be now the lessee, because at the end of the day, you sold the assets to a given person, and that person is going to give you these assets as terms of the lease arrangements. Also, there are other advantages and disadvantages that are associated with this, but it is one of the ways you can be able to acquire cash. One of the easiest way you can look at is that maybe you can look at, for a simple example, maybe a landlord selling out maybe the house, and that very same person becomes a tenant of the same very house he or she sold out. So when you have sold and you become a tenant, it means now you're going to be, it's like now you're going to start paying a lump sum amount of money for a certain period of time. So that's how basically we look at how some of these transactions happen.
And what we are going to be looking at here is that how are we going to be accounting for these lease sale and lease backs. The other person who has been now the lessee is now the lessee, and the person who was the lessee is now becoming the lessor. But there are certain conditions, as we are going to look at. If someone is becoming a lessor, what we are going to be looking at is that has the person actually sold these assets, or they have not yet sold them? Because it may happen that I may give you these assets and you give me cash, but when I have not actually sold the assets to you, you may find that I have given you these assets as a security for you to give me cash. Then after getting your money, I pay you back, you give me the assets. So if at all the person has actually sold the asset, how are we going to be treating it? If the person has not actually sold it, because if you are selling, it means it is going to come as revenue, meaning it will be accounted for under IFRS 15, that is revenue from contracts with customers, as we are going, because it is going to be our next standard that we are going to be looking at. So if it is not a sale, how are we going? Because if it is not a sale, then it is supposed to be dealt with under the IFRS 9. Those are financial instruments and all that. So we are saying that a sale and leaseback transaction involves a sale of an asset and leasing the same asset back. In this case, the seller becomes the lessee and the buyer becomes the lessor, as we discussed. What I'm more interested in is how are you going to be accounting for them? The accounting treatment of a sale and leaseback depends on whether the transaction of an asset is a sale under IFRS 15, that is revenue from contracts with the customer, or whether it is not a sale. So these are the two scenarios. The first scenario, if it is actually a sale, you have given up the ownership of the asset to another person. Now we are saying that the seller is going to be now the lessee, accounts for a right of issue, a right of use asset. That's basically how we've been doing it, but this time around, the person is going to apportion. How are we going to be apportioning? Because remember, you are going to be receiving, you've sold these assets, but at the point you have actually sold these assets, we've been depreciating these assets. So we have to compare. If you're selling these assets, are you selling them above the carrying amount? Carrying amount will mean the net book value of the asset. Because by the time you've been using these assets and you've been depreciating them. If you have been depreciating them, it means that the assets have been reducing in value. So we shall need to know, have you made a gain when you have sold these assets? And we are saying that the seller accounts for a right of use asset at the proportion of the previous carrying amount related to the right of use retained. Then we shall also compute a gain or loss will be recognized only to the extent that the right, to the extent related to the rights transferred. Now the buyer is now going to be the lessor, because after buying, it's going to give you and you start paying back some money on under lease arrangement. So what the buyer will account for a purchase of an asset, because you have actually sold the asset. The other one is going, first of all, you are going to recognize the asset. Then the other one is going to recognize an acquisition of an asset. Then this acquisition of this asset is going to be accounted for under different standards, or that asset is going to be accounted for under different assets. Maybe if the asset was falling under PPE at IS 16, if the asset was falling under IS 40, investment property, and all that.
So the asset will be accounted for under different standard, and the next thing we shall be accounting for, it will be the lease. Now the lease will be accounted for under IFRS 16, as we've been saying in the books of the lessor, meaning this person now will take the other previous steps we've seen of how the lessor accounts for that lease. This is how we are going to be computing the right of use asset, and we are saying the carrying amount of asset over the fair value of the asset we multiply by amount of the lease liability. We said we are going to be apportioning most of these items because by the time you've sold those assets, you are depreciating them for certain amounts. So it means when you're taking the figures, we take their carrying amounts. Then we also determine the gain. Of course, when we are getting the gain, we shall get the fair value of the asset, what you have actually got from the market. We less the amount of the lease liability. Then we divide by the fair value, we multiply by the total gain. That total gain is supposed to be apportioned. Then lastly, we can look at how are we going to be accounting for a transfer that is not a sale, when you actually given out maybe the land title of the land, maybe to a financial institution or maybe to a bank, and you want now to get money. Remember, you give out the title as a security and the bank gives you money. It doesn't mean that when the bank gives you money, it has actually gained control over the asset. No, it means that for them, they're just using the asset as a security for the money they are giving you. So by the time you take back the money you've got plus the interest, then they will give you back the land title. If maybe it is a logbook, you had a car and you are now giving out the logbook to the bank for the bank to finance whichever percentage they are going to give you. But when you pay back the money, then they will be able to release all the documents that you have actually given out. And we are saying that the seller keeps recognizing transferred assets and accounts for the cash received as a financial liability. This is going to be under S9, that is financial instruments. And then the buyer will recognize financial assets under IFRS 9 that will amount to the cash paid. That's basically what we are going to be looking at. We are going to do computations, and that's how we are going to be getting all the other aspects that are remaining. The next standard is going to be IFRS 15, that is 11 from contracts with customers. And when you have actually exhausted these computations and we've learned how to deal with the leases, then we can be able to take off from there and we'll proceed to the IFRS 15, that is 11 from contract with customers. Hope you can be able to subscribe and share, comment, also let others have a benefit. Thank you. Hello viewers, this is your tutor CPA ACCA, and today we are going to resume with our series on financial reporting, and the topic we are going to be discussing today is basically the group accounting. We want to see what are the things that are being covered within the group accounting, what is the scope as far as financial reporting level 2 is concerned, and what are the things that are supposed to be covered in the advanced financial reporting. But basically, since we are going to be concentrating on our financial reporting, that is level 2, we are going to look at those areas that are going to be examined as far as financial reporting, as far as group accounting for level 2 financial reporting is concerned. Basically, what we are going to look at now is maybe an overview of what is covered under group accounting that is relevant for us students who are doing level 2 financial reporting. We are going to look at the overview of group accounting. Then we look at the standards that are covered under the group accounting. We try to look at these IFRS 3 business combination. We look at the IFRS 10 consolidated financial statement. We look at the steps, the steps that are taken in group accounting, or what we consider when we are preparing all these statements as we are going to be seeing them. Basically, to give you an overview of this group accounting, actually group accounting, this was basically on level 3 syllabus and was introduced in the level 2 syllabus in 2016. That is the 2016 syllabus, because on level 3 it's that group accounting that is basically the compulsory number, and it carries 50 marks. So it was introduced just to equip the students with the basics that are so far needed for group accounting. That are so far needed in group accounting. So basically, as students of financial reporting level 2, what we have to cover in group accounting is basically we are just going to pick out the basics or some of the starting aspects of group accounting, so that by the time we reach level 3, we are going to be going to an advanced stage of group accounting. But as far as financial reporting is concerned, we are going to be looking at the basics. We understand them, and we see how we can be able to interpret those basic information that are within the group accounting, so that we can be able to prepare the group financial statements. Mainly, as level 2 financial reporting, we try to look at the consolidated income statement, the consolidated balance sheet, maybe statement of changes in equity. But the other consolidated cash flows and all that is prepared under group accounting for advanced financial reporting, that is level 3. So basically what we are going to be looking at is how are we going to use the basic information that we are going to be acquiring under this group accounting that will help us to be able to prepare the consolidated or group statement, financial statements, as we discussed about. So the other aspect is the applicable standards. We said we are going to be looking at the IFRS 3, that is business combination. We look at the IFRS 10, consolidated financial statements. We look at IS 28, that is investment in associates, but mainly at this level, we are going to just give maybe a brief explanation or a brief notes about it, but it will be detailed at level 3. That's where we will be looking at those investment in associates. But as far as level 2 is concerned, we are going to be looking at some of the basics. How are the associates accounted for? We are not going to go deeper into the computations of what is supposed to be done under the investment in associates, but we are just going to give a brief highlight of what is needed. What we only need from this is basically the group. Group means it's a combination of the parent and the subsidiary, as we are going to be looking at some of the terminologies that are being used within the group accounting. So having seen the overview of what we are going to be covering, we said we are going to look at the steps. What steps are we following whenever we are doing any number on group accounting? And basically, whenever we are talking about the group accounting, we are mainly concerned about the group. So if something doesn't contribute to the group, then it's not going to be covered under group accounting. So the few areas we are going to discuss more in the preceding videos, we are going to look at the IFRS 3, that is business combination. We look at the IFRS 10, that is consolidated financial statements, and we look at the steps we go through so that we can be able to prepare those financial statements as we discussed earlier. So if you haven't subscribed yet, please make sure you subscribe, because what we are going to be doing is that we are going to follow a simple step, and we are going to be looking at how certain things are being handled as far as group accounting is concerned. So if you want to get more on what is covered under group accounting, make sure you subscribe, and don't forget to hit the notification button so that you can be able to get the notification as we upload more videos, because this is going to be a step by step, because we want to understand this group accounting so that by the time we go to level 3, we have the basics that we need to be able to look at other advanced aspects, as we are going to be seeing them under advanced financial reporting. So for now, we are going to stop here, but the video that is coming, we are going to look at this IFRS 3 business combination. We try to look at what is it all about, what business combination means. Then we look at the different aspects that are within the business combination, because you may find that maybe when these companies come together and they form maybe a group, there are certain things which are within that group that are done, which we need to have an information so that we can be able to see how the accounting can be done. So basically, that's all we have for today. Until we meet again, it's bye for now. Hello viewers, welcome to our part 2 of group accounting. This is financial reporting level 2, CPA level 2. And basically what we are going to look at today is what we are going to focus as far as our group accounting is concerned. We are going to look at the different standards that are being covered under the group accounting that are relevant for us to be able to derive the financial statements, the financial statements that as we are going to be examined, because those are the things that we are going to be looking at within the examination. And basically the applicable standards, we said, as a precursor to what part 1 was all about, is that we are going to be looking at the IFRS 3 business combination, IFRS 10 consolidated financial statements, and IAS 28 investment in associates. And basically what we are going to be focusing on right now in this part 2 of group accounting, we are going to look at the IFRS 3 business combination. Then in the part 3, we'll look at the IFRS 10 consolidated financial statements, as we are going to combine that one with the IAS 28, because that's basically something that we shouldn't consume or spend more time on, because it's being dealt with in advanced financial reporting. But here we just going to take a few basics that we need. So without wasting more time, let's try to dive in and we'll see what IFRS 3 business combination is all about. But before we go into what we are going to be covering today, let's try to look at an overview of what we are going to be covering as far as business combination is concerned. That is IFRS 3 in this case. What we are going to focus on is the definition of business combination. What do we mean by business combination, or what we call maybe the merging? Others may just call it merging. Others may just say maybe two are becoming one. Then all of that aspect. So we need to know, as people who are doing financial reporting, we need to know, and we actually analyze what business combination is all about and what it means. So the second aspect we are going to look at, it will be the takeaway from the definition. What are some of the key items that are supposed to be within the definition of business combination? What are the things that we are going to look at and we keep emphasizing? One of them we can take from the definition is the control. Control is very important, and it will be a basis for every question that we are going to be looking at in any group accounting number, because if control is not there, then we are not going to be having the groups themselves, they are not going to be there, because we need to have a control, one company taking over the other, and we are going to be seeing the criterias or the indicators or the conditions that are supposed to be met, so that we can be able to say that from this point we now have a control, or this company has a control over the other. The other aspect is significant influence. It is something that we are going to take out from the definition, and it is very important for us to be able to understand what it means, its applicability, and what we do if at all we have significant influence, or if at all one company has a significant influence over the other. So we are going to see in which range is the company influencing maybe the decisions of the other entities. So that's going to be the key takeaway that we are going to pick from the definition of business combination. We said when we take out those key points within the definition of business combination, we are going to look at the indicators or the conditions, as we've said. Then we are also going to look at the key terminologies or the key terms that we are going to be using under business combination. Those different items or the key points that we are supposed to be able to understand from the beginning, so that when you hear them, we are going to be referring maybe to how things are going to be done whenever we go to the computations. So it's really an important area where we are supposed to be attentive and we'll be able to understand the aspects that are within the business combination. Then the last one, we can look at now the outcomes. What happens if at all there is combination, or there is merging, or there is an entity, many entities becoming as one entity? What happens? What are the things that are going to be coming out of the merging, or out of the combination of these companies? Because as you see the production, how the production is that you first put in the raw materials, then you see what comes out of the raw materials as the final products. So we are going to look at the final products of a business combination. What comes out of the business combination? Those are the different aspects that we are going to be looking at in terms of the subsidiaries, in terms of the associates, in terms of investment. Those are the key outcomes that we are going to be looking at as far as business combination is concerned. Then maybe the last bit of business combination, that is IFRS 3, is how are we going to be accounting for those outcomes? If at all we've got a subsidiary, what entries are we going to be making in our financials? Or what is the impact of a combination resulting to a subsidiary? How are we going to be accounting for a subsidiary? Secondly, how are we going to account for an associate? If it is an investment, how are we going to be accounting for those items? So that's the overview of what we are going to be discussing right now. And when we are done with that, then the part 3 of this video, of this group accounting, will be emphasizing on the IFRS 10, that is consolidated financial statements, as we are going to be seeing. Because if at all we go with the IFRS 3, that is business combination, and we finish it, you may find that it is going to be driving us to making the financial statements that we are looking at as the end product of students who are studying group accounting. So without wasting more time, let's dive in and see what we are going to be discussing. So an overview of business combination. Here we just need to know the definition of the business combination, and the definition, it's by far the most important item, because when you understand what the definition says, it will be very easy for us to understand what are the items that we are going to be focusing on, or what is the scope of what we are supposed to be looking at under business combination. And we are saying business combination, this is an arrangement whereby one company obtains control or significant influence over one or more businesses. What will happen is that you may find that a certain company is acquiring or is buying another company. When that happens, we are expecting to have one company controlling the other, and the other one maybe we may get is a significant influence, depending on how much of the shares or how much of the assets of that company have been acquired by the other company. So this happens in those instances where a company is buying or investing shares in another company. When, of course, when we are doing so, or when you are buying shares, or when you are investing more money into another business, what that means is that we are going to be gaining control. The company that is either buying or investing money in that company, you will have an impact on that organization, in a sense that you are going to either be controlling that organization, or you are going to be having an influence. So we are going to look at what do we mean by a company having a control in a certain organization, and what do you mean by a company having a significant influence over the other within the business combination aspect. So what we need to know about control, maybe we can first understand what control is. And the definition for control, it says this is the power that one entity has over the other to direct relevant activities of that entity and be affected by the variable returns from those activities. So as per the definition, it is very clear of what it's the power one entity has over the other to direct the relevant activities. And among these relevant activities, we may look at the management, the decisions that are supposed to be done by the management, maybe the items that all the procedures they go through, maybe to recruit those management guys that are going to be able to run the company on their behalf. So those are the key activities or the relevant activities of that entity. So if this company has power to control those activities, and in the return, what they say about the organization will determine, or they will be liable for what happens. Because if at all you recruit people who are going to mismanage the company, you may end up suffering or getting losses. When you incur losses, you end up not getting profits or will not get your dividends as the shareholders. So if you have the power to control an entity or to direct its relevant activities, you will also be in position to the outcomes that are going to be coming out of your interference within the relevant activities that are being done by that organization. So when we try to look at the standard provides for us some of the indicators or the conditions that an entity has obtained control over the other, and we are seeing them as listed. These are the conditions that we say, if we see them happening, we can know that the organization, maybe an organization A, has control over the organization B. One of them will have the right to appoint, remove, or reassign key personnel. As I explained, you may find that these people, what they say about the type of people they want to recruit so that they can be able to manage the company on their behalf is they have a direct impact on their recruitment, or maybe in the recruitment process. They give guidance on what person is supposed to be employed in a different category, maybe especially these heads of department, maybe the directors. So if they have that, if there is that condition whereby this organization can be able to appoint or remove or reassign key personnel, then we may end up concluding and say that we have control over that organization. But most of the times these conditions, they work concurrently. So meaning you can't just base on one aspect and say maybe there is a control or a significant influence. You have to look at maybe all the aspects, the three aspects as are highlighted by the standard. The second one is the power to cast the majority votes. Here we try to look at maybe in the annual general meetings, we find that these people they are many to the extent that they can be able to influence these other people to join them, or what they say can be heard easily than the other guys who are also the shareholders. You find that these people, they are owning much of the company, so what they say makes an impact, a positive impact to the decisions that are going to be made by the entity. So the third one, we are looking at the right to direct the investee to enter into transactions for the benefits of the investor. Basically, we are trying to look at these people. They may also try to look at, they may also try to influence other people who are going to be coming in as potential investors, because for them they are owning more than 50% of the organization, and you find that these people, what they say, they can also influence others to join their side because they are the majority within they hold majority votes within the organization. So that's basically what the standard gives as the indicators of control within the organization. If there is control or there is power of one entity to direct the relevant activities, then we can also base on that and we say this organization is now controlling the other or has an influence, if at all it is not controlling the organization, because it can't be a two-way within one organization. It is either you have a control or you have a significant influence. and we are going to be looking at what differentiates the two. But as for now, let's try to understand what they mean, and as we go on, we can be able to understand how we can differentiate some of those items. So that's basically the items, and we are saying that if the company doesn't have control, now we are looking at the other aspect. If at all the company doesn't have control over another organization, then it is supposed to be having a significant influence. And what does a significant influence mean? Here we are looking at the power that one organization has over the other that gives them a right to influence some of the decisions. And most especially, these are matters relating to financial and operating decisions, but not control. Meaning, these people, they submit in their opinions, but not all the time that they are going to be accepting their opinion, because at the end of the day, they are not the majority shareholders. These are few people. They have not bought maybe 50%, more than 50% of the organization, and maybe they own, let's say, 45% or 40% or 35% of the organization. And owning 45% of the organization, we are trying to look at 45% of the assets of the organization, as we are going to be looking at all those aspects. But as for now, let's try to focus or to emphasize that we understand without cramming that when you have a significant influence, what you have to do is that you can submit in your opinions, but not all the time your opinions are going to be considered. You are submitting in what you think is right, and the majority shareholders may say that what you are saying is either right or it's not right, but you have an influence. Like you can, because whenever you bring an opinion, it means you are bringing something on the table which can be discussed by convincing other majority shareholders either to pick it or leave it. But if you have control, is that when what you say, if maybe you are at the annual general meeting, you find that the opinions we are giving out, you have so many people who are going to back it out. And you find that, of course, most of the decisions are taken by the majority side. And you find that these majority sides, that's the organization that is having more than 50% of the shares of that company. So we have also the conditions or the indicators of an entity that has a significant influence over the other. Of course, if you have a significant influence, most of these decisions you are going to be basing on, as we say, they are financial and operating decisions. You may look at maybe capital budgeting, wanted maybe to acquire some assets, and you find that maybe you are having a disagreement on what assets that the organization is supposed to be buying. You can submit in your opinion, because that opinion will be taken, and if at all it goes through, then you can be able to convince the other majority shareholders to accept your proposal. So let's try to also understand the conditions that shows that an organization has an influence over the other. One, we have representative on the board of investees. Here we are trying to look at maybe at the board of directors, maybe at you find that maybe one of the members from the other company is part or is represented at the board of those investors, because you find that these shareholders, they come together and they contribute their money. So even these guys who are very few, they have a representative that is going to be hearing what the other guys are discussing, so that that person can be able to pass the information that they have got from the meeting or these board meetings that may be held by the organization, and you find that they have a representative there. So if they have a representative there, it means these ones are also influencing, because if you have a representative there, it means that that person is going to be submitting your opinions as people that person is representing. It's like these members of parliament, you find that in a constituency, you have only one member of parliament that raises the concerns of the people in that very community. So this is the same way what that person says or what that person gives is considered as far as the management of the organization is concerned. Then the other one is participation in the policy making process. If you find that these few shareholders that are owning less than 50% of the shares of the organization, they are being included when they are making these decisions. They are making, maybe they want to implement maybe a different, they wanted maybe to expand the business, and they are laying some policies, or they are putting other items that are going to be used by the same organization. You find that these people, they have maybe a representative who is there participating in this policy making, so that that person can be able to pass the information to the other colleagues about what is happening to the organization. Then the third one, we look at the material transactions between the investor and the investee. Here we are trying to look at it's mainly in terms of the technical assistance. If you find that these people who are few, they are giving guidance to the other majority shareholders, their opinions also matters, especially in terms of the technical aspects, maybe in terms of the policies, drafting policies of what, because you submit your proposal, and if it goes well, then we see that you influenced the other guys to make sure that they back you up and be able to consider your opinion. Then the other one is the interchange of management personnel. We say these are going to be two companies. One is maybe they are going to be two or more companies, or one or more companies coming together to form a group. So if they are forming a group, we are expecting that if the other company bought more than 50% of the shares in this organization, what will happen is that these people who are now owning less than 50%, they are going to be the significant influencers. Then the other one, they are going to be the controllers of that organization, because they have bought more than 50%. So if there is an interchange, you may find that the people who are owning the organization, you may find that some of the staffs maybe that were it is mostly in these top managerial positions, you find that they transfer them and they take them to work in their head office. They pick some people from the branch and they take them to their head office. So you find that it's a group which has a head office, but it has different subsidiaries that are operating under their control. But you may find that they have some staffs who are, maybe they are more experienced. They take them to the other side to make sure that they can help them to run the business. If that happens, then we say there is significant influence. And even the other way around, you may find that these guys who are buying the organization, they may change, and they say maybe the CEO, who was the head of the company that is buying, or the head of the group, to be the CEO of the subsidiary, so that they can help the organization to improve where it was. Then the last one is the provision of external technical information. That this one, we spoke about it, and mainly these are the things that you see in terms of the market. These are mainly, especially in terms of the market survey. When you're doing market surveys, when you're doing policy, when you're making policies, when you're drafting maybe these other salary scales that are going to be paid by the organization. Because whenever a company is buying another company, or they are investing in another company, they have seen the opportunities that are there after those companies becoming one. If at all they become one, there are so many reasons that they consider for a company to buy another company, and even the other company to accept to be bought. So you look at all the technical assistance that can be provided. You may find that this organization has been maybe in, let's say, auditing, and this company has been doing only tax audits. Maybe the other one, they have been in financial audits. You find that they are coming together, and when they are coming together, the other one is bringing knowledge of financial auditing or auditing books of accounts, and this one, they are bringing the tax audits. They are bringing the knowledge they have together so that they can be able to expand on what is supposed to be done. You may find that some of the people who are within the other organization which provides maybe auditing for books of accounts, they may advise these guys who are doing the tax audits, and they give them some of the areas how they have been doing it so that to reach to where they were. So that's basically the indicators. If you see some of these items reflecting in any given question, you find that you will be able to differentiate that this is belonging to a control, or this shows that a company has a significant influence. So, as we said, we are going to be looking at some of the technical words or the terminologies that we have. We've been talking about the group. We've been talking about a parent. We've talked about acquiring the other company, buying the other company. So we are going to discuss or to learn how each of these is defined. So as a wind up of what we've actually discussed, what you have to make sure to understand is that you have to know the conditions for each of those items before we proceed to these definitions of different key terms. You have to know when do we have a control and when do we have a significant influence. Something which is significant, it means it can result to something. There is a possibility of something to happen because of the influence that has been put, or that has been brought maybe to the board or anything. So when you be able to get those aspects, we are going to make sure that this question is actually going to be very easy for you, because those are the things that we are going to be looking at, especially when we go to our stages in group accounting, because we need to know, is there any relationship? What is the relationship between those two companies? And we shall discuss those when we reach there. So among the terms we are going to look at, let's try to know what a group is. And according to the standard, we are saying that the group is a parent and its subsidiary. Take this as maybe the head office and the branch. We may lower that to that level, that a head office is now the parent, but these branches, they are going to be our subsidiaries, or the different outlets that were created by the organization. But all this becomes as a result of combination. When the other organization buys or invests cash in another entity, we end up having a group to a parent to subsidiary relationship, whereby it depends on the percentage. If you acquire more than 50%, then we are going to be having maybe a subsidiary, as we are going to see them under the outcomes of business combination. But the key emphasis here is that a group is a parent and its subsidiary. That's a group. These subsidiaries, it doesn't mean that they're supposed to be maybe more than two. If it has been one company and it has bought one company, then it becomes a group. The other one becomes a subsidiary, and the company which has bought becomes the parent. So we have the parent. The parent is the entity that has one or more subsidiary. A parent is, let's say, the head office that has different branches within different regions of maybe the country, or they are supposed to be, it's a global company and it has different branches in different countries. The other one is the acquirer, and we are looking at this as the entity that obtains control over the other. And we said, if you have control, you can influence, or you can lead, you can interfere within the decisions that are going to be made by the organization, and you are also liable for those same decisions that you've made. Then we have the acquiree, that that have been, this is the business that the acquirer obtains control of in a business combination. In other words, this is the company that has been controlled by another company. Then maybe the last aspect we may talk of as far as the key terms is maybe the acquisition date. The acquisition date is basically that specific period of time when this entity makes payment, or when it buys, it invests in another company. That specific period when you, not necessarily when you have transferred the money to the other entity, but when you have obtained control. Of course, how do we know that you have actually obtained control? We may look at, maybe there is a sales agreement that has been signed. Maybe you've made part payments. Maybe we are going to be looking at how we acquire the organization. But the acquisition date is just the date on which the acquirer obtains control of the acquiree. So that's basically what we will look at as far as the different items that we are going to be looking at. So having understood those definitions, then we need also to know what happens when one organization acquires control. If the organization acquires control, or it acquires a significant influence of another company, then we need to know the outcomes. This is basically what comes out of the business combination. After these companies becoming one and they form a group, what comes out of it? And we are going to be looking at the different outcomes in regards to their percentage of control. Of course, we are going to be putting this aspect in terms of the percentages so that we can be able to determine what control means and what significant influence means, as far as we add on the aspects we discussed earlier about those definitions for those two items. So the first one, as the outcome of the business combination in regards to the percentages. Now we are going to be talking more of the percentages, because the underlying aspect here is that within the outcomes of the business combination, we are trying to look at the percentages. If the company acquires more than 50%, then we are saying that that company has control. If it is less than 50%, then we are going to be having significant influence. But among these significant influences and these controls that we are obtaining, what are the things that we are going to be, if let's say the company has actually bought 50 maybe 60% of another company, and that qualifies a point, the organization which has acquired 60% of the company's shares there is going to be having a control. So what are we going to be calling that organization? Is it going to be the parent, or which relationship are we going to be having within those two companies that are becoming one? So one, we are saying that we are going to be having a subsidiary, and the subsidiary, this is an entity that is controlled by another, whereby the controlling interest is more than 50%, and is having more than 50% of the voting rights, or it has the right to cast the majority votes through an agreement with the other shareholders. We've said that maybe in the annual general meeting, you find that when they pass, maybe they are, let's say in a parliament, when they pass a bill, you find that the party that has many people, it can end up buying, especially the ideas, it may end up winning all its items that it has brought on the parliamentary floor. You find that they end up winning the other percentage. So if it goes more than 50%, it shouldn't be 50%. It's supposed to be more than 50%. Because if it is more than 50%, even if it is 50 49.8.2, and the other one, of course, is going to be 49 point something. So if it is more than 50%, we are saying that that organization is going to lead to a parent and a subsidiary relationship. We are going to be having two companies, the one which is a parent that acquired more than 50%, and the subsidiary that is having less than 50% of the shares of the organization. Then the second outcome is going to be the associate, and the third one is going to be the investment. But when we are looking at group accounting, most of our emphasis, we are going to be focusing on that first outcome as a parent and a subsidiary relationship, which forms a group. Hope that one is very clear. As far as level 2 is concerned, under financial reporting, when we are looking at the group accounting, we are going to be focusing at that first outcome, which is the subsidiary parent and the subsidiary relationship, because that's what forms a group. The rest of these, they are not going to be forming the group because everything is going to be less than 50%. Because when you try to look at the associates, this is an entity in which the parent has significant influence but not control. And it is usually represented by holding between 20% and 49% of the shares in that or in another organization. Then what that means is that the last aspect, which is the investment, is that the entity in which the parent holds less than 20% of the shares in another entity. And this one, we can also conclude it, and we say that this will be accounted for under IFRS 9 or IS 39, that is financial instrument, which are not part of financial reporting. We will not cover those ones. They will be covered under advanced financial reporting, that is level 3 CPA. So basically, those are the outcomes. But as I said, our emphasis is going to be on the first outcome, which is the subsidiary. Meaning, if it becomes the subsidiary, it is giving us the indicator that we are going to be having a parent and a subsidiary, which are forming the group. Because we say the group is a parent and its subsidiaries. So it is where we are going to be having control. The rest, we will be having influence, significant influence. So having understood the different outcomes that are going to be coming out of the business combination or the results of business combination, then we can eventually look at an extension of the business by the parent company as if the company has just opened up a new branch. Because when the company obtains control, or it has bought more than 50% of the shares, in other words, control means you have acquired more than 50% of the organization. So if that happens, then we are going to say that we are having that organization controlling the entire organization where it has acquired that more than 50%. So if it is going to be in that case, then we are going to be having a parent and subsidiary relationship where one company is the acquirer and the other one is the acquiree. So hope you can be able to understand this, because this is going to be our major area of focus as far as the group accounting is concerned. Because if we don't have a group, then we can't prepare these consolidated financial statements, because we will not be having two companies. As the reason why we are looking at these consolidated financial statements, we are trying to look at the books of the group, the whole group, meaning the parent and the subsidiary. The parent is the company which has acquired the subsidiary, and the subsidiary is like the new branch. It's like the company opening up a new branch in a different country or a different location. So that's basically what we had to understand among the outcomes. Then what we need also to understand, we have understood that an investment is being accounted for under IFRS 9 or IS 39 financial instrument. Then we also need to know how these other outcomes are going to be accounted for. How do we account for these outcomes of the business combination? So that's going to be our subtopic of what we are going to be looking at, accounting for business combination. And mainly what we are considering here are the outcomes. How are the outcomes going to be induced or recognized in the books of the group? So without wasting more time, let's try to look at the different aspects. Of course, we are saying that IFRS 3 business combination provides methods for accounting for different forms of business combinations. The different forms are the subsidiary, the investment, and the associates. Those are the outcomes we've seen, or the results of business combination. And we have part one, which looks at the subsidiary, because we said this is going to be our major area of focus. And we are saying IFRS 3 recommends the use of acquisition method of accounting, where we are required to, now these are the things that we are required as per the standard. This is what the standard says about accounting for subsidiary. One, we identify the acquirer or the person or the entity that obtains control over the other. If let's say A buys 55 or 60% of the shares of the other organization, then we say that A has a control over the other. Within the exam, they will not give you a percentage that is close to 50, so that you can't be able to know whether there is control or not. It will be, they will give you either a percentage which is maybe 70%, 90%, so that you don't doubt whether there is a parent to subsidiary relationship or not, or whether there is control or there is significant influence. So it will be you to use the percentages that they have given to know whether the company has actually obtained control or whether the company is just having a significant influence. But as far as the group accounting for level 2 financial reporting is concerned, they will always give you a percentage that will show there is a control. Because if they give the other option, then it means you are going to be passing, because everything will be easy there. Let's take a very big note about these outcomes, how we account for them, because they are very important in the next preceding videos that we are going to be looking at. We said we identify the acquirer. The second one, we determine the acquisition date. We said the acquisition date is the date on which the acquirer obtains control over the acquiree. Then the third one, will recognize and measure all identifiable net assets. The word is identifiable net assets acquired and liabilities assumed, and any non-controlling interest, which we abbreviate as NCI, at fair value. We use the fair value. Take note of that. We use the fair value. If you don't know what a fair value is, please go back to our first video where we started financial reporting. We spoke about all these measurement bases. So having seen all those items, then we can look at the last one. We compare the consideration paid or payable to the fair value of the net assets to determine any goodwill or bargain purchase. Then the last one, we look at now the goodwill. These are the things that we are going to be talking about whenever we go to these financial statements, because we shall be seeing how we compute the goodwill, how we determine whether we have a bargain purchase or we have actually goodwill. And if we have a goodwill, then we make sure we test that goodwill for impairment. If the goodwill has been impaired, then we can try to look at how we are going to be calculating the impairment loss and all that. But in a narrow way, you can try to look at goodwill as just a matter of comparing the amount they have paid. If, let's say, the assets of the organization, they were maybe 10 million, were worth 10 million, and the company maybe has paid, the other company which is acquiring maybe 80% of the shares has paid maybe 12 million. And that 12 million, if you deduct 12 minus 10 million, which is the value of the asset, you may find that that 2 million will be represented as the goodwill. But at some point, you may find that this goodwill is impaired at a certain point, or during the year it has been impaired. Then you deduct that impairment loss so that you can be able to get that exact goodwill. So that's basically, if there is no goodwill, of course, it is a bargain purchase. A bargain purchase is just the company has been sold at a loss. Maybe the company had assets of 10 million, worth 10 million, but you find that the organization which is acquiring is paying only 9 million. It means you have made a loss. But that loss is called a bargain purchase, meaning the person has paid less money as far as the assets of the organizations are concerned. The consideration paid is less than the fair value of the assets acquired. We measure at fair value. The reason is because we want to determine these assets at their present or the current market price, what they can actually face or fetch in the market. So that's how basically we go by the accounting for subsidiary. We are going to come back to that. We see how we are going to be calculating some of those things under the steps that we are going to be looking at, the steps in group accounting, because it is those steps that we follow in group accounting that are going to help us in making these consolidated financial statements. So that's basically the outcome or the accounting for that outcome of a subsidiary. Then let's try to look at the accounting for an associate. Of course, we spoke about how we account for an investment, but we can also repeat how it is done. But for the outcome number 2 is the associate, and we are saying that here, what you have to understand is that here we don't go into deep of this accounting for these associates, because our main emphasis is on group. If the group doesn't exist, then we have no business with it, because this accounting for associate is handled under IS 28, investment in associates, and that is not part of level 2. It's supposed to be in advanced financial reporting. So we are saying that the standard requires that an associate should be accounted for using the equity method of accounting. And that equity method of accounting we are trying to look at. Of course, if you try to look at the accounting equation, we have the assets, we have the liabilities. Of course, you find that the assets are equaling to the owner's equity plus liabilities. So we use the equity section, because if you take the assets minus the liabilities, you will also be able to get the equity. So we use the equity component because we either use the money from the shareholders or we use the money that we have actually borrowed from other sources to finance the business. So if at all we want to know the amount that we are investing in the business as an associate, we are not owning or we are not controlling, we just have a significant control over the organization, then our percentage is less than 50%. So what we look at, we try to look at the cost or the fair value of the consideration paid. And remember, this consideration, we are going to look at how this consideration is paid, because there are so many ways a company can buy shares in another company. We shall look at them later. But just we may not pay the whole of the amount at once. We may pay the first, maybe the deposit, we keep paying others in installment. But how we compute it, we just get the consideration paid, we add the parent's share of the post-acquisition earnings. That one we shall talk about it later as we go on. When we add the post-acquisition earnings, is basically the post-acquisition earnings is something that we earn from the period the company has acquired control over the other to the time of reporting, because you may find that the organization has acquired an entity maybe 3 months to the end of the financial year. So there is that amount that we have earned in profit that we try to share. We shall look at that and we know how to compute that. So when you add those two, you will be able to get the investment in associate. How is it going to be treated? You will find that some of the, you may find that in these aspects, we find that this value of the investment in associate, we have put it somewhere, but I don't want to go into deep into that because it's not part of what we are going to be looking at, because it is not relevant as far as the financial reporting is concerned. So the last one was an investment. Of course, an investment, we said it is less than 20%, and it is accounted for under IFRS 9 or IS 39, that is financial instrument. We shall look at those ones when we reach there. So what we have actually got is that we have analyzed all the aspects that are within the business combination. And what that brings to us is that having known how we account for this, then at the end of the year, how are we going to be preparing the income statement? Or how are we going to be preparing our financial statements at the end of the year for the group as a whole? Leave alone these other outcomes like the investment and the associate, because we know how those ones are treated. But specifically, we are looking at the parent and the subsidiary relationship, whereby they are forming a group. If at all they are forming a group, how are we going to be making these group financial statements or financial position, the income statement, as we are going to be looking at them? So the next one is going to be around the IFRS 10, as we said, because what we wanted to discuss in this was mainly the point of the company having control to the point that we have actually got the result. And the result here, our emphasis is on a subsidiary. We have a parent and the subsidiary relationship. So if you're more interested in getting to know much about that, make sure you subscribe to the channel and you also hit the notification button so that you can be able to have updates of what we are going to be posting as far as this group accounting is concerned. Remember, these are series, and we made them in series because we want you guys to get these basics, because they are going to be very important for us to be able to understand and pass this paper with ease. Thank you for watching. God bless you. Hello viewers, we are resuming with our series on group accounting, and according to where we stopped, the part 3 of the video we uploaded yesterday, we tried to look at the IFRS 10, that is consolidated financial statements, and we saw from there that it is a requirement, or the standard permits us to prepare the consolidated financial statements when you have a parent and a subsidiary relationship. So as a precursor of what we did in the previous videos, remember we said that if one company buys more than 50% shares in another company, we end up having a parent to subsidiary relationship. And that parent to subsidiary relationship forms what we call a group. So as we are going into our group accounting, it means from that stage we have already formed our group, meaning we have both the parent and the subsidiary company. So this means that parent to subsidiary relationship means that the parent at the end of the year must prepare the consolidated financial statements, which are going to be combining the financial statements of the parent and those of the subsidiary company. So at the end of the day, we need to present the group financial statements. And the only way we can do that by combining the financials for the parent and the financials for the subsidiary, because the two have become a single unit. So therefore, that brought us to the stages or the steps that we go through when we are preparing these financial statements, the one we call steps in group accounting. So these steps, we are going to look at them one by one, and we try to understand these stages, because these are the things that you are going to find in the question. First of all, when you are given any group accounting question, the first thing you look at is determining the group structure. So when you determine the group structure, that is going to be the first stage. But before we look at that, because our main focus here is preparation of those group financial statements, we say those are going to be the income statement, the balance sheet, maybe the changes in equity. But for the cash flow, we say that one we shall do it when you go to advanced financial reporting. So in terms of knowing what should be done to prepare these consolidated financial statements, we have to look at some workings, or we have to do some workings. Since every company is preparing its financials separately, we need to look at some of the steps that we need to go through so that we can be able to prepare these consolidated, or we can combine those accounts for the two companies in order to form what we call a group. So, as I said, the first step is looking at the group structure. And this mainly the relationship between the two or more companies, because we said you may find that it is one company buying shares, buying more than 50% in different companies. It may be buying from company A, company B, company C. So if it is only one company and the company has bought more than 50% of the shares of that company, then we say we are going to be having a parent to subsidiary relationship. We talked about what a parent company is. We spoke about what a subsidiary company is. And the relationship that exists between those two is what we call the group. And it is the financials for the group that we need to prepare at the end of the year. So that's basically the relationship between the two companies in a business combination. When they come together, then we need to know the group structure. So by helping us to know the group structure, or in terms of which one is the parent and which one is the subsidiary company, we mainly focus on the percentages. In the question, you'll be given these percentages that maybe the company bought 50%, or it bought maybe 60 or 70 or 80% of the company, of the shares of another company. So what we look at here is that the percentage should be exceeding 50%, meaning if the company has bought maybe 80%, we say that it has obtained control over that company. So it becomes the parent company. Then we have also the portion that is not controlled by that company, because we say that it has bought 80% of the shares of the company, meaning the remaining 20% is now the non-controlling interest, or the one that is owned by these subsidiary or these other shareholders who are taking only 20%. That's what we call the non-controlling interest. So the controlling interest is, as you've seen, we have an example here. We can see that we have Pichu Limited, which is the parent company. It has obtained 80% of shares from XY Limited, meaning since Pichu Limited obtained 80%, we are saying that this 80% is going to be representing the parent company, and the 20% is going to be the subsidiary, which we call the non-controlling interest. So the next item we look at in the determination of the group structure, we look at also the acquisition date. When is this company buying off the other one? Or when, of course, when you try to look at the acquisition date, you may find that by the time the company is acquiring shares in another company, it will not be maybe at the end of the year. It may be during the period of the year, of a given financial year. So, since it is going to be acquiring this company, and the reason why we try to look at that acquisition date is because we want to determine some of the post-acquisition earnings that will be earned. Because if at all the company has acquired maybe another 80% in another company, we are trying to look at from that date up to the reporting. Actually, that acquisition date, when they have acquired the shares, it is what we call the acquisition date. Then from that period up to when the financial year is ending or the reporting period, you may find that there are some amounts that this company, which is buying shares in the, let's say in the middle of the year, is going to be having some earnings, not for the whole full year, but for that part where it became part of that company. So normally our first working is always to first determine the parent company and the subsidiary company. Then we also look at which one is going to be controlling which one, meaning the parent company is now going to be the controlling interest, and we also determine the non-controlling interest, which is going to be belonging to the subsidiary company. And the last thing we look at is the acquisition date. It is very important because when we move ahead, as we start preparing the financials for the income statement, if at all the company has not been there, or it has not acquired that company at the beginning of the year, it means we have to time apportion the sales that were made, actually the profit that we have acquired, so that we know what was that profit that the company acquired at the point when they joined the company. Because for the income statement, it is always prepared for the year end, meaning it is for the whole financial year. But now what will happen if at all the company was acquired in the middle of the year? It means the first 6 months are not going to be part of that company. The profit that was made in those months will not be part of the parent company, but it will only take a share of the 6 months where it has been part of that group. So that's basically why we determine that acquisition date, and it is very important. So that's basically what we look at as our first step. Then we have the second step that we go to after determining the group structure, and that is preparation of the net asset schedule of the subsidiary at acquisition date and the reporting date. Meaning here we are going to be looking at two scenarios. We look at the acquisition date and the reporting date. So that's what we are going to be looking at in the part 2 of this video, because I don't want to take it very hard for you guys, because this is something that we need to understand, because there is no way you are going to pass any number on group accounting if at all you have not mastered these steps. Because sometimes they will not ask for those combined financial statements. Sometimes they may ask you for these workings. They tell you calculate the goodwill, you calculate the post-acquisition earnings, and those are the things we are going to be going through in this step-by-step model that we take into the group accounting. So it's what we are going to be handling, and basically it will be in our next video, because I don't want to make this video too long, so that you take small time, you can be able to and rewatch, so that you master each and everything until we finish all these steps that are taken within the group accounting. So if you haven't subscribed, make sure you subscribe, you hit the notification button, so that you can be able to get updates on whichever videos we are going to be uploading. So that's the end of our part one of the steps in a group accounting until we meet in the part 2 of these same steps in group accounting. Welcome back to the part 2 of the steps in group accounting. And what we are going to look at today is the second step in group accounting. As a precursor of what we discussed in stage 1, or the step 1, was the determination of the group structure. And in the group structure, we said we look at the controlling interest, that is the parent company, which has obtained more than 50% of the shares in another company. They may be shares or they may be the assets. Secondly, we look at the non-controlling interest, or the percentage or the portion that the parent company doesn't have control. When we've seen that, then we try to look at the acquisition date. When is the asset acquired? Or when is the company is buying shares in another company. So that's an overview of what we discussed in part 1. That is the step number 1 of determining the group structure. But in the part 2, we are trying to look at the preparation of a net asset schedule of the subsidiary. Here we are looking at the subsidiary at the acquisition and at the reporting date. The reason why we are looking at the subsidiary, it's because it's the subsidiary which is selling its assets. That's why we are looking at the subsidiary side, because we want to determine the post-acquisition earnings. And that's the purpose of preparing the net asset schedule. So, as an overview, we said after determining the group structure, we shall now go ahead and prepare the net asset schedule to show the value of the assets of the subsidiary company at the time we acquired them and at the time we are reporting. We look at the time, maybe the asset was acquired in the middle of the year, and we also try to look at the same net asset at the end or at the reporting of the year, but for the subsidiary company. Remember, what we have to look at here is that we always prepare this balance sheet basing on the accounting equation. And the accounting equation is always assets equal to equity plus liability, which implies that the assets of the business are either obtained using the shareholders' money, that is equity, or they are obtained using the borrowed money, that is in terms of the liabilities. That's how we finance the assets we have acquired in the business. So those are the two ways we can hold assets, or we can have assets in the company. So what we are trying to look at here is that, because here we're saying that normally the components of equity comprises of the net assets, and basically we use the component of equity. The reason why they are saying so is that when you get these assets, if you try to interchange the formula, because the general formula is assets equal to equity plus liabilities. If you try to interchange them and you'll be able to get the equity component, equity will be equaling to assets minus liabilities. That is the equity. Assets minus liabilities. But we know that to get the net assets, we also get assets, we less off the liabilities, we get the net assets that are still remaining. Meaning that the component of equity is equal to the net assets, because to get the net assets, we get assets minus liabilities. And also to get equity, we always deduct assets minus liabilities from the general equation. And the reason why we are not taking the assets and the liabilities and we only consider the equity component is because the equity section is always has very few items which can easily be identified in the balance sheet. So they are very easy to look at. Other than looking at the the assets there, then you start looking at the liabilities. It's the same way you take the equity components, because for them, they're always there: share capital, share premium, retained earnings, reserves, and the revaluation gains or revaluation surpluses. There are very few items, so we can be taking the equity components, and that's what the standard says. So now, as we are seeing our net asset schedule, we said we are going to be using the items of or the components of equity. So when we are using the components of equity, we try to look at the items that are within the components of equity, where we have the share capital, share premium, retained earnings, evaluation surpluses or evaluation reserves. We may be having other reserves, but we are looking at those items both at the acquisition and at the reporting date for the subsidiary company. So when you have got that item, we only adjust with one figure, and that is the fair value adjustment. This fair value adjustment, we will get more lights on it because it needs to be explained some. We are going to look at it in the near future as we try to compute some of these items. But just know from the components of equity, we add only the fair value adjustment. I will explain that in the due course as we are proceeding, but just know the fair value adjustment is always adjusted. We either add or subtract. So now the last step is where we shall be adding the totals for the acquisition date, and you add also the totals and we will be getting the difference between what is the total at the end of the year minus the total that we have at the date of acquisition, and that will be giving us the post-acquisition earnings, which we are going to be using in other preceding calculations, because we are going to be using that when you are determining goodwill, when you are determining other aspects as we are going to look at them. Just know these two items: the fair value adjustment, I'll throw more lights on it, and the post-acquisition earnings, which is the difference between the equity components at the end of the year minus the equity components at the beginning of at the acquisition date. That difference, the one we get, is what we call the post-acquisition earnings. It's basically an amount that has been earned by the time the company acquired shares in another company. It's like we are trying to look at the portion, because you'll find that part of the profit that has been made from the date the company acquired shares to the reporting date, this company, the parent company, has earned some profits, which we need to see how we can be able to share that as we go on. So that's basically the step 2, the second step in group accounting, and it is basically where we determine the post-acquisition earnings. Because it is this post-acquisition earning that we are going to feed in other computations as we are going to be seeing them. Because the third step is going to be looking at how we are going to be computing the goodwill. We see the different methods that are permitted or that are allowed by the standard to be used in the computation of the goodwill. And that's what we are going to be looking at in the next video, where we are going to be talking about the different items that we'll go through in determining the goodwill, in terms of the amount, how much someone is going to be paying, and how are you going to be paying the money? Are you going to be paying the whole lump sum of amount at once? Are you going to be paying a part payment, then you complete the payment in the future? So those are the things we are going to be looking at, and that is going to be in our part 3 of this. Now part 3, which is going to be coming very soon. So it's the end for now, as the step 2 in group accounting, which was basically looking at how we determine the post-acquisition earnings, and we determine it from the comparing the figures at the reporting and at the acquisition date, but mainly for the subsidiary company. So it's what we are going to be looking at. We are going to take practical question and we shall be seeing how all these are computed and where do these items feed. Hello viewers, welcome to another session of our steps in group accounting, and we had so far finished the second step, which was the preparation of the net asset schedule to determine the post-acquisition earnings at the reporting and the acquisition date of the subsidiary company. The step 3 or the third step is the computation of the goodwill. And what we have to understand is that goodwill is supposed to be computed at the acquisition date or when we have actually acquired the subsidiary. And the reason is just to determine the gain. We can just quote it as a gain, but just that goodwill is a bit different from the gain. But for consolidation purposes, we look at goodwill as the amount by which the purchase consideration is the amount by which the purchase consideration exceeds the value of the assets acquired. In other words, the purchase consideration is the exact amount we've paid to acquire shares in the company. So what happens is that goodwill, we try to look at it in terms of just the difference between what you paid to acquire control or to acquire shares or to acquire part of the assets of the subsidiary and the assets of the company being acquired. So they are being represented by the excess of the amount paid to acquire control in the organization. We look at the purchase consideration and the value of the asset. In a layman's understanding, we just get the price we've paid, we less the cost. What remains is what we call the goodwill. That is in a layman's understanding. But for consolidation purposes, we take it, or the standard considers the purchase consideration, the excess of the purchase consideration over the value of the assets acquired. If let's say the company has bought maybe 80% shares in company, maybe company C, and it has paid maybe 1 billion, but you find that the assets of the company were worth 800 million. So that difference of 200 million is what we call the goodwill. So we need now to look at some of the things that we need to compute before we arrive at our goodwill. Because what happens is that most of the times the purchase consideration is not always direct. Sometimes it is given the question, sometimes it's the student to compute that purchase consideration. You may be given with the value of the asset or the company shares or the market price of the shares of the company, but you may be not given the purchase consideration and you need to determine it by yourself. So when we try to look at this purchase consideration, and we need to know what exactly purchase consideration is. This is the price paid to acquire shares in another entity. It's exactly what you pay. The challenge that we have to be having different modes of payment. You may find they not received all the money at once, and they have been receiving maybe the money in installment, depending on the agreement or the sales agreement that is signed between those two companies. So in other words, we need to look at the forms of payment the parent company is using to acquire shares in the subsidiary company. And the standard permits us to use 4 forms of purchase consideration, or the ways how the parent company can pay for the shares to the subsidiary company. And one of them will have the cash consideration. Of course, cash consideration, there is no need for anyone to explain. It is where the entity pays cash to buy shares in another company. If they say they are buying 80% of the shares, you compute the market price, you get of the shares, you multiply by the market price, and the money is paid there and then. That is the cash consideration. The second option, we have the share exchange. Share exchange, it's the same way you do the exchange, because it's like you have two companies, a parent and a subsidiary, and instead of the parent paying cash to the subsidiary company, it ends up paying or giving out its own shares to the subsidiary company. How is it done? You may find that they will give you a ratio that we are giving maybe 2 shares for every 4 we are acquiring, depending on whichever ratio they are going to be giving you, or they are going to be using according to the sales agreement that may be available at that particular period. Here you are not paying cash, but you are using your own shares to acquire the other company's shares. Of course, you find that the parent company maybe has a price which is maybe higher, and the subsidiary has a lower. So that the parent is giving less, but is acquiring more. And it may be the other way around, whereby the subsidiary may be having more share price than the parent, and you out more, but you're receiving less. So whichever way it comes, or whichever ratio has been given to you in the question, you look at that ratio, and it's what you use to determine the shares, the number of shares that are going to be exchanged. So this means that the shareholders, if you do a share exchange, it means that the shareholders of the subsidiary company, they are also going to become, or they are also taking a portion of shares that they have received from the parent company. In other words, they are also becoming shareholders in the parent company, and that they are becoming shareholders in the company brings what we call the purchase consideration, because it's like what they have actually paid to acquire also their shareholding that company. Hope you can be able to understand, because we said here the companies exchange shares in a ratio or in a given proportion, and the shareholders of the subsidiary company will be members or will be also shareholders in the parent company, especially when share exchange occurs between companies. If we exchange, I give you my shares, you give me your shares, you are also going to become a shareholder in my company as I'm becoming the shareholder in your company. So the only variance will be in terms of the price. You may find me, I'm going to be acquiring higher, and for you are going to be getting less, which means for you are going to be having a significant interest in my company because you have not acquired or you have not gained more than 50%. And if I exceed 50% in your company, then I'm going to be also controlling your. But our emphasis here is to look at what is that ratio, how much is in that ratio that has been paid to the subsidiary company to acquire shares in that company by the parent company. That's basically what we look at. Maybe you can try to look at this small brief example, and we see we can have. We are saying that the parent company acquired 12 million shillings, one ordinary shares in the subsidiary company by issuing 5 of its own 1 shilling share for every 4 shares in the subsidiary company. The market value of the parent's share is shillings 6. So you are seeing that the parent company acquired 12 million shares. That share was 1 shilling ordinary share from the subsidiary, but it paid of its own, and in exchange they received only 4. So we are seeing, if you try to analyze this question, you may look at this question, and the required is saying we determine the value of the consideration paid to acquire shares in the subsidiary company. Remember, we said whenever we are doing this valuation, we use the fair value. If you didn't get that, please go back and watch our first videos where we started from, because we said we are going to be using the fair value in whichever computations we are doing. And these, we are looking at the values for the subsidiary, but we want to look at how much the parent company paid to acquire those shares. If you try to do the analysis, you will see that the question will always give you the proportion or the ratio of that share exchange between the two companies. And we are going to be using that given ratio to multiply it with the number of shares and then multiply with the market value of the shares of the parent company, because it's the parent company giving out its own shares to the subsidiary company. Hope you can be able to understand that, because they are giving for every 4, meaning it will be 5/4. 5 for every 4, because they are giving out 5 to acquire 4. So if they have, if at all they have actually received 12 million shares, then we multiply by the market value of their shares. And we are seeing that when we do that, we are going to be having shillings 90 million. And someone will be asking now, after computing that, are you going to be stopping there? You do some small double entry, whereby the 90 million that you have actually acquired is going to be the money that is going to be debited, or that is going to be given to the subsidiary, to be debiting the investment in subsidiary of 90 million, because that's what we are giving out in terms of buying shares. Then we create the share capital. But now the share capital, from your shares, computation of shares, we always have a nominal value. Shares are always on the nominal value, but we try to look at whether they have been given at a premium or at a discount. And in this time around, they were at a premium, because each share was 1 shilling. It at 6, meaning they have made a profit of 5. So it will be this 1 shilling times we are going to split this figure, the 90 million we have got, into the nominal share capital and the share premium. We will get the 4 for every 4, 5 for every 4. We multiply by the number of shares, we multiply by 1 shilling. This 1 shillings we are seeing here is the nominal or the face value of the shares, which will give us 15 million. Then the share premium, we also create the share premium with the 5, meaning it is the difference between the 6 that was the market price, we less the 1 is the face value to get a premium of 5 shillings. When you multiply that, you get 75 million. When you add, of course, you are seeing the credit side is equal to the debit side. And that's one way of determining the purchase consideration. Of course, this is now the 90 million is the total that we are going to be paying. Part of it is premium and part of it is the nominal value. So that's how it is for the fair value for the share exchange. Then the other step that we are going to be of determining the purchase consideration, we are going to be looking at the contingent consideration. This contingent consideration, it's something that is contingent. It means it may happen or it may not happen, meaning there are some chances of the person paying the amount. But what does this mean in terms of the computation of the purchase consideration that we are going to give you? Here we are trying to look at the payments, but these payments are going to be in future. The payments are to be made in future, but they are subject to some conditions. Some you may find, maybe they may say that we're going to be paying an extra 10 million if at all the company is profitable by, let's say, by that time when they are going to be paying the money. Or we shall be paying 50 million in 1 year's time if at all the company reaches this such and such profit margin. So those conditions that are attached, the implication is that if at all the company doesn't raise that percentage of maybe 50% of the profit margin, you find that these people, they are not going to pay the extra amount. This purchase consideration, it may not, the contingent consideration may not be necessarily the whole full amount. Someone, they may agree the sales agreement that you pay 50% cash, then the remaining 50% maybe until we get to that condition that we have set by order that we have agreed. So it may happen, we may look at an example, we may say that be paid as a consideration if maybe the company attains profitability in a given period of time. So what we need to look at here is that since this amount is going to be coming in the future or is going to be paid in the future, then we need to know, because the amount is going to be paid in the future, but for us, we are preparing our financials now. So what we have to do is we need to first discount that amount, that future sum, to get to worth now. After knowing how much that amount, if let's say someone is going to be paying 50 million in 2 years' time, how much is 50 million now, if at all we are going to be including in our financials? So we need to discount that figure, the future sum, into the present worth, so that we can be able to incorporate those figures in our financials. The good thing, we learned how to do the discounting depending on the number of years, but we may try to look at a small example just to more lights on what we are supposed to do. That Pichu Limited acquired XY Limited on 1st January 2021. The purchase consideration required the fulfillment of the following conditions. Now this is sales contract looks like. They are saying that an immediate payment of shillings 50 million. You are paying 50 million immediately, meaning you are paying cash payment. Then a future payment of shillings 10 million on 31st December 2021 if profits exceed by 10%. So this is now the condition which we've been talking about. That if at all by the end of 31st December 2021, the company attains profitability by 10%, if at all by the time we are buying the company as of 1st January 2021, maybe it had 100 million. By the time the year ends, 31st December 2021, if at all the condition is met, and we have maybe the profit is now 110, which is now the 10% profit margin, we will say that this need to pay the extra 10 million. But if it reaches by 31st December 2021 and the company has not reached the profit margin, then we can't be able to pay the extra 10 million. We shall use the other 50 million as the purchase consideration. So you take note of that, meaning dates are very important as these computations are concerned. As I said earlier, that some of these questions, they may not come telling you to prepare financials. They may tell you to compute the purchase consideration, determine the contingent consideration that has been paid. Those are the things, and you find that they are carrying maybe five marks, but they are adding up to a certain number of marks. So the question proceeds and says all the projections showed that the target will be met. The rate is 7%. So don't be tempted to use 10% as the discount rate. They have given the discount rate as 7%. So this is what I've been talking about. If the question was stopping here, a further payment of 10 million on 31st December, if the company exceeds profitability by 10%, and it doesn't add this word, all conditions and projections showed that the company will meet the target, then you don't include it because you are not sure whether the company is going to make it. What this means is that they will give you the condition. In the question, they will specify whether the company is going to meet the given target or it is not going to meet it. If at all they remain silent and they don't tell you, whether you consider it, whether you don't consider it, they will mark you right. Because at the end of the day, they have not given you whether the company is going to attain the profitability. But if they remain silent, make sure you don't consider it, because if you consider it, then it means you made your own question. You've set your own question. The simple way is to just ignore that and you take the purchase consideration to be only 50 million. But if they go ahead and say that all the conditions are going to be met, then you make sure you include the other amount. So that's what we mean by the contingent consideration. It is based on certain conditions. If they are not fulfilled, we don't consider. So here is now the logic. The amount is going to be paid in 1 year's time, because from 1st January 2021 to 31st December 2021, we are seeing that it is now a 12-month period. That's a 1 year. It means we are going to discount this figure for only 1 year. If I told it was going to be paid in 2 years' time, you make sure you discount for years. So you be careful on that, the number of years that are there. We get the 10 million, we take, this is now the discount factor, which is 1 plus R. And our R, we said that is the discount factor, which is 0.07 power -1. Or the other person may say it is value over 1 plus R power n, and you remove this negative. So when you discount this, the 10 million will be getting 9.3, and that is the present value of the future of the 10 million as of 31st December 2021. So meaning, if we are recording our data, we need to put in the 9.3, which is now the present worth. So we add that to the cash consideration, you add that to the contingent, and you get the total consideration. We have a note here that says that the contingent consideration is payable in 1 year's time. It will therefore be discounted to the present value in order to establish the consideration at the acquisition date. That's what because we said earlier that the goodwill is always computed at the time they are acquiring the company, meaning it is at the acquisition date. If they have given us the 10 million that will be paid at the end of the year, yet we acquired the company at the beginning of the year, we need to discount that figure to its present worth. So we also need to take note of that. We have to be careful about the timing flow. If at all the cash flow is going to be coming in more years, we make sure we discount those figures in their respective periods as the question may suggest. Then the other item which we can use, which the parent company can use to pay the shares, is now the deferred consideration. Deferred, sometimes it is just amount that is going to be paid in the future. Instead of paying now, you pay in the future. It may happen in the sales agreement. You may say, instead of paying you or paying maybe for the shares, let's first start operating. We first use the money we have to finance the company, but we will pay the money, the purchase consideration, later. Because you may find that the company doesn't have the whole sum amount of money they are asking. Because by default, when you pay the company, you are going to start running that company. If at all you don't have cash, what you can do is to forego, to postpone the payment and use that amount to finance the operations now. Then by the time you reach that point where you have agreed, you make sure you clear all the amount. And that's the end of the 4 forms that we discussed that we can use to determine the consideration. Here you agree on certain or on make payment in the future, and the difference here is that this is not subjected to any condition. The difference between the contingent consideration and the deferred, the contingent is subject to certain conditions, but this one is not any condition. Whether the company doesn't achieve profitability, you still pay money. So that's the difference. It is in the same way. The same way we did the other one is the same way we do this one, because all of it suggests that the amount is going to be coming in the future. So it is coming in the future. We need to discount and we get the present value of that figure at the acquisition date. We have an example here which says acquired 80% of the shares of another entity on 1st January 2020. It was agreed that the parent pays 200 million in 1 year's time on 1st January 2021. The discount rate is that. This one we just discount the whole 200 million. It is not attached to any condition. But since the amount is going to be paid in 1 year's time, we discount up to 1 year. So that will give us a 190 million after discounting, and that will be our deferred consideration. So the next one, we are going to look at the methods of computing the goodwill. These ones, the standards permits only 2 methods, but this one is going to be in our next video, where we are going to be looking at how we can determine the goodwill. Remember, there we have been determining the purchase consideration, and we said the purchase consideration, the amount that exceeds the value of the asset, is what we call the goodwill. So we've been determining only the purchase consideration. We looked at how we can be able to determine the purchase consideration that the company is going to be paying to acquire shares in a given company. So that's where we are going to start from in our next video, because we want to make sure that these things we take as we be brief, and we make sure that everyone is going to be picking. So if you haven't subscribed, make sure you share, you comment, and you can also suggest on how things can be done, and we improve our. So it's bye for now. Hello viewers, this is now brings us to the end of our step 3, that is computation for goodwill as far as group accounting is concerned. From our introduction, we said goodwill is computed by getting the difference between the purchase consideration and the value of the assets that are acquired. So we've seen the previous videos how we can be able to determine the purchase consideration. So now we are looking at the share that is going to be exceeding the value of the asset, which we call the goodwill. But the standard gives us 2 methods that we can use to determine goodwill. Not forgetting our general formula that on a layman's understanding, goodwill is just the difference between the purchase consideration, or the money that has been paid, and the value of the assets. But the standard gives us 2 methods. One is the full goodwill method. It's also called the fair value method. The full goodwill method is one of the methods that we can use to determine goodwill. And for it, we are looking at the shared goodwill. In other words, we are looking at the share between the parent and the non-controlling interest. And we say the non-controlling interest is the subsidiary. And to take also note is that the non-controlling interest is always measured at the fair value at the date of acquisition. So after determining the amount of the net or non-controlling interest at the acquisition date, then we add its share of the goodwill. Because remember, when you're valuing this, you value the whole assets of the company. So if the whole assets of the company is, let's say, 1 billion, but maybe the company is buying, the parent company is buying shares up to the tune of 800 million, you will see that the other 200 that is remaining is the non-controlling interest. But remember, when this parent company is paying, it will not pay exactly 800 million. It will not, because the reason of why they hire is because the company has been there, the company has been established there, it has its own customers, the branding name, everything is there in place. For you, when you buy the company that is already existing, you start enjoying those benefits. So the reason why they put in an extra amount is because they are buying for that extra loyalty, the customers who are there. You had even the suppliers themselves, they have been trusting you. So those reasons as to why goodwill exists whenever they are doing buy-offs. Make sure you go and research about, and those are the theoretical aspects that you also need to understand. So without wasting more time, let's try to dive in and we see how the goodwill method works, what we need to know from it, and how it's. We are saying that goodwill here, the goodwill under full goodwill method or the fair value method, the goodwill is shared between the parent and the non-controlling interest. And we say the non-controlling interest is measured at fair value at the acquisition date, and they gain their share of the goodwill. Hope that one is very clear. But don't forget that the goodwill is just the excess amount that is paid by the parent company to acquire shares in the subsidiary company. So how do we get that excess? Is by getting the purchase consideration as last video, because we discussed how we can be able to the different models, the 4 forms of purchase consideration where the parent company can use to pay the purchase consideration or to pay the amount to acquire shares. We get that purchase consideration, we less the parent's share of the net asset schedule, the net assets at the acquisition. Here, this is the format. This is the way we go by that, because we try to look at the purchase consideration, which is this we first computed in our first video. From there, we less our parent's share of the net assets. At acquisition, if let's say the company acquired 80%, you get 80% of the net assets, we less it from there. This is the was paid, we less the cost of the assets. Then what we will be getting will be the parent's share of goodwill, and that will be A. That is, you can put it to be A, capital A. Then we have to get also the fair value of the NCI, that is the subsidiary, at the acquisition. Remember, we say the goodwill is always computed at the acquisition date, and that this is now the percentage that is not controlled by the parent company, that is the non-controlling interest, and we get value at the acquisition date. Then we also less, because we want also to determine what is the goodwill for the other subsidiary. We get its value, meaning this fair value of the NCI at acquisition date. They will give it to you in the question. If they don't give it to you in the question, they will give you a way how you can be able to compute this. Otherwise, this fair value of NCI at acquisition, if it is not given in the question, and they have not maybe given you the market value of the shares, the market price of the shares, they have not given you any way you can compute it, meaning there is no way you can use the full method. You will be going by the other method, which we are going to see. Meaning, in all these methods, it's only this that separates both of the methods. The fair value of NCI at acquisition must be given in the question. If it is not given in the question, they must give you the market price of the shares of the subsidiary company. Because if you have those ones, you can be able to determine the fair value. We said we less the NCI's share of the net assets at acquisition date. What we do here is that if less was the parent acquired 80%, meaning it will be 20% of the net assets. Remember, we net assets in our second step where we prepared the net asset schedule. So the reason why we determined that, it was because we wanted to determine some of the things. When we less that, then we will be getting the subsidiaries goodwill, that is the NCI's goodwill, and we denoted that one as B. So what we get after getting the goodwill for the subsidiary and that for the parent, we come here and add the two. We get the total goodwill at acquisition. We add the A, that is the parent's share of the goodwill. We add the B, which is the subsidiary's share of goodwill. And the answer we get, we test for impairment. You know, these goodwills, these intangible assets, they are always, sometimes they are impaired. If the impairment loss has been given, you less it, we less the impairment loss. If it is not given, it will be the total, will be the goodwill at the reporting date. Because what happens is that we are determining the goodwill at the beginning of the period. But remember, the financials we are preparing, therefore, at the end of the year. So what has happened to the goodwill during the year? If it has lost value, then we make it to be, we remove that impairment loss. We deduct it so that we get the goodwill at the reporting date. By the time we report, this is the goodwill that we are going to be having. Hope you've got that. We maybe we can try to look at the practical number and we see, but this is the format. We get the purchase consideration. Now, this purchase consideration is the money that has been paid by the parent company. We less it's the share they have acquired. Maybe it is 80% of the net assets. We less that, we get the difference. We get the fair value of the market, the fair value of the NCI, that is the non-controlling interest at acquisition. We less also its share, which is the 20%, the remaining percentage from the assets that were bought by the parent. We less that, we add the two, we test for impairment. If impairment is there, we less it out, we get the goodwill at the end of the period. So these are the things you are going to be looking at in the question. But take note that they may tell you to compute the goodwill, but when in actual sense they have not given you the purchase consideration, and you need to compute each and everything. They may give you the purchase consideration, but they don't give you the fair value of the NCI at acquisition date. Meaning, but they have given you ways how you can determine. When they have given you maybe the market price of the shares of the subsidiary at acquisition. So there are so many things as we are going to be seeing them when we start doing those practical numbers. So let's have maybe a small illustration that can help us to pick what we are talking about. We can use this example, which is going to be using the full goodwill method. And it says ABC Limited paid 900 million to purchase 75% shares in XY. The fair value of XY Limited is identifiable net assets at acquisition is 700 million. Remember, we spoke of the identifiable net assets. You know, the assets that are identifiable, they can function on their own. We talked about those identifiable assets in our previous standards. Hope you know what we are talking about. And they have given you the fair value of the NCI at the date of acquisition is 190 million. Then they have given the impairment loss of goodwill was 20 million for the year. Then the required says determine the value of the goodwill using the full goodwill method. So when you try to analyze this question, we are seeing that what we have to first get, we have to first get the purchase consideration, and they have given us in the question 900 million. That is what was paid to acquire 75%, meaning it was that 75 that was paid to obtain 75% of the shares in XY Limited. Then we have to less on this 900 million, we less the parent's share of the net assets. They have given us the net asset value, which is 700 million. So we shall get the 75% times the 700 million. This 700 is the net assets at acquisition subsidiary company. This is the fair value of XY. Remember, this XY is our subsidiary. Then we try to look at these two figures. When you get 75%, the 700 million, you'll be getting 525 million. When you less this, we are getting a parent's share of goodwill, that is 375 million. And this figure is going to be our parent's goodwill denoted. We can denote it as letter A. Then in the question, they have given us the fair value of the NCI at acquisition. Here they are saying that the fair value of the NCI at acquisition date is 190 million. I said they will always give you that question, that figure, or they will give you the market price or the ways you can be able to compute those figures. Because the other way you can get it, if they give you the market value of those shares and they give you the number of shares, even if they have not given you the number of shares, but they have given you the market price of shares from the share capital. You look at the equity section and you look at the share capital. We shall see, because there's those questions that are having those kind of things. It's not always direct like the way you're seeing, but I just want you to appreciate the concept and we'll be able to grasp some of the risks. So we said we less the fair value of the NCI on debt, that is 190. Then we also take the percentage or the non-controlling interest. They have told us that the controlling interest or the parent is taking 75%. Meaning, if you get 100 minus 75, you remain with the 25. The 25% is now the non-controlling interest. So 25% of the 700 million will give us 175 million. Now this 175 million is not owned by the parent company, is owned by the subsidiary. So we are just splitting the goodwill, the total goodwill, into the one that belongs to the parent and the one doesn't belong to, that belongs to the non-controlling interest. So if you get the difference, we shall get 15 million, and that 15 million is going to be our non-controlling interest goodwill. So we get now the total goodwill by adding our parent's share plus the subsidiary share. When you add the two, you are getting 390 million. But they told us during the year we had an impairment of 20 million. So when you less the goodwill impairment of 20 million, you are remaining with the goodwill of 370 million. And that's going to be the goodwill at the reporting date. So that's basically what that method is requiring us to do. Maybe we can try to look at the other method, which is the proportionate, or the proportion, or the partial share of the net assets. Partial, as the word it is a part. We are now not allocating all the goodwill to one entity. We are all the good to the parent company, all of it, because at the end of the day, it is the parent company that is paying that lump sum amount that they are receiving. So what is the difference between what we had up and this one? The format for this is we get the purchase consideration, we less the parent share of the net assets at acquisition, then we get the goodwill at acquisition. Now this is for the parent. What we do now here, we don't bring in the fair value of or we don't split, we give all the goodwill to one entity. Then what we do, we just less the impairment loss and we get the goodwill at the reporting. So someone is going to be wondering, how do I know that I'm going to be using such and such a method? You look in the question. If they have not given you, I've told you the item that differentiates these two methods is the fair value of the NCI at acquisition. If they have not knew that in the question and you have no way you can determine it, make sure you use the partial method or the proportionate method. Hope we are clear there. In other words, if they don't give you this component, the fair value of them, if they don't give you this component, the fair value of NCI at, make sure you go by the proportionate and you don't share the goodwill to, you allocate all the goodwill to the parent company. So that's the difference. We can maybe I can maybe try to elaborate some of the things. They're saying that under this method, the goodwill arising at acquisition date is only attributable to the parent and is determined as follows. That's how we go by the proportionate method, get the purchase consideration and we less the parent's share of goodwill at acquisition. For example, it may be, maybe it is 70% of the net assets. Then we get the goodwill at acquisition if we less consideration from the net assets. Then what will be left for us is to test for impairment. If the impairment loss is not given in the question, don't deduct. Just leave that figure to be the goodwill at the reporting. So this basically is what we should have covered in step 3 of group accounting. Maybe you can take a practical example. It is the same like the one we had up. The only difference is that we have this goodwill right now is 25 million. It is limited paid 900 million to purchase 75% of the shares in XY. Then the fair value of the XY limited identifiable net assets are 700 million. Then they have given us goodwill. So if you try to look at this question, they have not given you any additional information. They have not given you ways you can determine the fair value. So you don't go by the first full goodwill method. The question says required, determine the value of the goodwill using the proportionate share goodwill method. And here you can try to first identify which one is the parent company, but they may give you a question whereby they have not given you the fair value of the net assets. They have not given you those assets, but they have given you information of how you can get them. How you can get them, we said we use the what? We use the equity component. Hope we are together on that. The first step is to identify which parent, which one is the subsidiary, and the percentage of control, then the acquisition date. That is the first step. We are seeing that ABC Limited paid 900 million to purchase 75%, meaning the 75% has already more than 50%. So, which qualifies the point that ABC Limited is now the parent company and XY Limited is a subsidiary, which takes only 25%. They have given us the fair value, but if you are not given with that, you go by the second step and you determine the net assets schedule to determine that amount. Our net assets. If you are given that in the question, then you'll be lucky for that. Then it is the same way we did. We said we just get the purchase consideration, which is 900 million. We less the parent's share. Now we are not sharing, but we are taking all of it, which is 75% of the 700 million, which is 525. When we get that, we remove from the 900 million that was paid, we are getting 375 million as the parent's goodwill. Then we less the impairment loss of 25 million and we remain with the 350 million as the goodwill at reporting date. Remember, this goodwill is supposed to go to the balance sheet. We shall know how that is supposed to be placed, where it's supposed to be placed. But logically, you can try to understand before even you say the things are hard. If you say that the company has paid 900 million, but it is acquiring the value of the asset they are buying. They are buying only 700 million, but they had an extra 200 million. But that 200 million, it is belonging to both of the groups. Hope you get the concern. This 700 million is for the entire company. Those are the value of the company. But this ABC is not buying the whole 700 million. It's buying only 75% of the assets. That's why here you are seeing it's not just a matter of getting 900 million minus 700. No, because if you get this minus this, you'll be getting a lesser figure. You will be assuming that the company acquired 100%, yet it only acquired 75%. Hope we are clear there. The last part we are going to the second last part we are going to be looking at. Actually, if you finish this intercompany transactions or intra-group transactions, we will build only 2 steps that we shall look at. So what is going to be in the next video? The intercompany transactions. As you hear the intercompany, meaning a transaction coming from the parent going to the subsidiary, or coming from the subsidiary going to the, maybe you know of the examples you may say that a parent company is transferring its old machines to a subsidiary. It happens in a real world. You find that the other company, they have been doing the same industry. So they have all the equipments they are giving to the subsidiary to use, because for it can actually use them. For them, they buy new ones instead of selling them. So if we have such kind of transactions, we need to eliminate all of those transactions, because those 2 companies have now become 1 company. So we need to eliminate such intercompany transactions so that we'll be able to get the reliable values for the group or for the combined financial statements. So that marks the end of the step 3 in group accounting, that is computation of goodwill. But make sure you understand how these are done, because sometimes they don't ask the question to determine maybe the balance sheet or the statement. They may tell you to just compute some of the things. You compute the goodwill, you compute the purchase consideration. You see, you show how these intercompany transactions are going to be treated. That's how they just ask for those double entries. Of course, you do the double entries as you explain. When you're explaining, of course, you do the calculations, you show where you're supposed to be going, why is it supposed to be like that, and things will be very easy for you. But all of it starts from understanding the steps. If at all you don't pick these steps right, you won't be able to do these numbers as they're supposed to be done. Thank you for watching. If you haven't subscribed, or if you have just started following our tutorials, make sure you subscribe, you comment, you can also share to others, and we see how we can be able to improve our learning.